minus 3,670 minus 1.5. We proceed to the illustration on computation of VAT, that is August 2024, question 5C. We read the question. Explain the term reverse charge, that is basically already given on notes. Then you go to 2. The following information related to lesser. The following information related to lesser limited, a company engaged in supply of taxable goods for the month of May 2024. The company was registered for VAT on 1st May 2024. So we have inventory in trade as at 1st May 2024, valued at 13,000. So we, on the opening stock, we can claim input VAT. So the second, we are being told that the company purchased goods on credit. The company purchased goods on credit and cash worth on credit. So credit is 4,750,000, and on cash is a figure of 2,980,000 respectively. So when you talk about purchase and the opening stock, those are basically input VAT. Those are VAT on purchases and expenses. So goods purchased on cash worth 180, goods purchased on cash worth 180, did not have supporting fiscal receipt. So when you have these goods purchased on cash, we can do our working. Purchased on cash, goods purchased on goods purchased, we say purchased on cash. So basically these goods purchased on cash did not have supporting documents. So those cash, we had a figure of 2 million. We had a figure of 2,980,000. We less the ones that did not have documentation. That's a figure of 180. A figure of 180. We pick our calculator. We basically have 2,980 minus 180,000 minus 180,000. So we have a figure of 2.8. 2.8. This is where we are going to claim input VAT. The ones that do not have the documentation, a figure of 180, we cannot basically claim input VAT on them. So then we proceed to additional information, number 3. The company sold goods worth. The company sold goods worth 8,768,000 during the month. During the month of May, the company basically sold goods worth 8,768,000 during the month. These goods included exempt sales of exempt sales worth 3,670,000 and export to South Africa, which was 1.5. So we can get the standard rate sales. So we have our working two. We are getting the standard rate sales. Standard rate sales. So it tells that the total sales is basically what we have as 8,768,000. 8,768,000. We less the exempt, which is 3,670,000. This is basically exempt, and exempt, that is 3,670,000. Then we less the zero rated. Zero rated in this case is about a figure of 1.5. Zero rated is a figure of 1.5. So we get the standard rate. We get the standard rate. So for the standard rate, we pick that, and we will say 8,768,000 minus 3,670,000 3,670,670 minus 1.5 minus 1.5. So we have the standard rate sales to be 3,598,000. 3,598,000. An explanation on that. So we know that standard rate, those are taxable, and the zero rates are also taxable or vatable. But zero rate, we know we claim VAT at 0%. Exempt rate, exempt sales, we do not charge VAT at all. But we're saying that these figures on sales are basically what we call output VAT. And I've explained that exempt, we don't charge VAT, not chargeable to VAT. Zero rate, import, export is zero rated. Then standard rate, we charge VAT at a standard rate of 16%. So then you're being told that the company received a credit note. A company received a credit note and a debit note worth 600,000 and 540,000 respectively. So if I just indicate here, just to indicate working three, we say that a credit not received, remember this, credit not received affect purchases, affects purchases. We know that this basically affect the purchases. This basically affect the purchases, and credit note will reduce the purchases. That will definitely reduce the purchases. Then the second, we have debit note. Debit note received. That also affect purchases. And we know that debit note is used to correct an undercharge. So this definitely will increase purchases. This will increase the purchases. That is analysis for that. That definitely will increase what you call purchases. So then we are being told that during the month, the company purchased a motor vehicle on hire purchase at shillings 4.5 million to be used in business. The cash price was 3.8. If you have the hire purchase and the cash price, we basically use the cash price to claim input VAT. So the input VAT will be on the 3.8 and not 4.5 So we proceed to the additional information number 6. The company imported goods valued. 2.4, that is cost, insurance, and freight. They incurred clearing. They incurred what you call the clearing. The company incurred the clearing and transport of for 50,000 and 150 respectively. Respectively, this import was not included in purchases above. The import duty rate during the year was 25%. The import duty rate was basically 25%. So we go to working for on import. Remember, when you talk about import, we say that import basically has a cascading effect, meaning that we charge VAT after charging import duty. So import duty is charged. Import duty is charged on what you call the CFI, cost, insurance, and freight. So we have the cost, insurance, and freight to be a figure of 2.4. So 2.4 to get the import duty 25%. So we get 25%, we can get the 25% and add, or we just have plus 125 over 100. Instead of getting 25, then we get 2.4, 125 over 100, meaning the figure plus the import duty. We can test that with our calculator. So we have that 2.4 The figure is 2.4 times 125 over 100. So the figure is basically 3 million. But you know that imports are exclusive of VAT. Imports are exclusive of VAT. Imports are basically exclusive of VAT. And when you look at the figure for the transport and clearing, those are also input, but we're going to charge them. Those are basically input. VAT. So we proceed to 7, additional information number 7. So the company incurred the following expenses. Expenses are basically input VAT. So the first expense is what we call legal expense. Legal expense is vatable. We charge input VAT. Salaries and wages are exempted from VAT. Office rent, that is chargeable to VAT. That's how we claim an input VAT. Then we have water from the county. That is basically exempted from VAT. Water from the county, that should not be charged to VAT. Then we have electricity, that is chargeable to VAT. Then we say 8, the company could not identify. We're being told that the company could not identify a goods sold as exempt when they purchase, and therefore restricted deductible input VAT. So we have restriction in that. Then the last additional information, that is additional information number 9, transactions are inclusive of VAT at a standard rate of 16%. So when you're told transactions inclusive of VAT, transactions inclusive of VAT. So means that VAT is already charged. So we say into bracket use 16 over 116. Use 16 over 116. If the transactions are inclusive of VAT, it means that VAT is already charged on that. So we basically use 16 over 116. So we proceed to what is required. Determine the value added tax payable or refundable to lesser limited for the month of May. So we can say VAT payable or refundable to lesser. We say to lesser limited, payable or refundable to lesser limited. Particularly on questions that we have restriction, one of the best approach to take, especially on questions that you have on restriction, is basically to do the output separate and do the input separate. Sometimes students mix them, but the best approach to take when it comes to questions that basically deals with restriction is to have the output separate, and also do the input separate. So we go to the output, we get the output VAT. So on the output VAT, we have standard rate. We have amount here. Then we have the VAT rate. Then we have the VAT. So we have item on that. So the first item is standard rate cells. And the standard rate cells, we had done the figure as we rotate the camera. As we rotate the figure for the standard rate, we less the exempt and zero rated. We had the figure of 3,598,000 times 16. Transactions are inclusive of VAT. So we have our calculator, and 3,598,598, then times 16 over 116. So the figure that we have for that should be a figure of 496,276. That is for the standard rate cells, a figure of 496 to 76. The next items on cells, we have what we call zero rated, zero export. And when you read the additional information number 3, export to South Africa. So export was a figure of 1.5. Export was a figure of 1.5. Remember zero. That's zero rated. So that is 0. That is 0 on that. Then you have exempt. Exempt we have at a figure of 3,670,000. We don't charge VAT at all. So then down here we have what we call total output VAT. Total output VAT. That should be a figure of 496 to 76. 496 to 76. We proceed to the input VAT. We get the input VAT. We proceed to what we call input VAT. We have what we call input VAT. So on the input VAT, we have item on this. Item, amount. We have the VAT rate. Then finally we have the VAT. And we move sequentially. So the first item that we had was credit sales, credit purchases. We charge VAT on the credit purchases. So credit purchases a figure of 4,750,000. The VAT rate, because it's inclusive, 16 over 116. So we pick our calculator, and we have that. We pick our calculator. So we basically, as we pick our calculator, we know that 4,750,000 times 16 over 116. So we have, on that we have a figure of 655. 655 to all number, that should be 172. 655, 172. We proceed to what we call the cash. We call it cash purchases. So on the cash purchases, there is a working basically on the cash purchases. There's a working on the cash purchases. We say that some of the purchases did not have physical document. So the working basically will list 180. So for the cash purchases is a figure of 2.8. So we have the 2.8 at this point. Then we multiply by the rate which is 16 over 116. We get the figure on that. So we have 2.8 times 16 over 116. So that should be about a figure of 386, 207. 386, 207. 386, 207. To round it to all number. We proceed to the next. We had what we call credit not received. That's the reduction of purchase. So we have credit not received. Credit not received. We had a credit not received. So on the credit not received, the company received credit note and debit note. So credit note received was a figure of 600,000. That is additional information number 4. So credit note basically reduces the purchases. So times 16 over 116. So what do we get when you have that? So 600,000. 600,000 times 16 over 116. So that should be about a figure of 82, 759. 82,759. Then debit note received. That is used basically to correct an undercharge. An undercharge that should increase the purchases. So we have a figure of 540. A figure of 540. 16 over 116. A figure of 540, 16 over 116. So 540 times 16 over 116. So the figure that you have, that should be about 74. 74, 483. 74, 483. 483, 74, 483 as the figure. 74, 483 as the figure. Then there was an entry that was not basically added. Opening inventory. So we had the first entry on opening inventory. On the first month, you can claim that opening inventory. Opening inventory. So the opening inventory was, we had a figure of 813. 813 times 16 over 116. The opening inventory. 816. 813 times 16 over 116. So that should be a figure of 112, 112, 130, 112, 138 as the figure. 112, 138 as the figure. So proceed to the next. We had, during the month, the company purchased motor vehicle on hire purchase. We use the cash price. Motor vehicle. We have the motor vehicle. So motor vehicle is basically a figure of, we use the cash, which is 3.8, 16 over 116. 16 over 116. So we have the 3.8 times 116 over 116. So that should be about a figure of 524. That should be a figure of about 524. 524, 138. 524, 138. 524, 138. The next item was basically on import. We know that import, we have done the working. As we rotate the camera, import, we basically are done the working. Import plus import duty, we have a figure of 3 million. And you know that import are normally exclusive. Even if the question is inclusive, they're normally exclusive. So we have import. Import, a figure of 3 million. 3 million. Then that 3 million, we have times 16 over 116. Times 16 over 116. So 3 million, 16 over 100, sorry, because that is exclusive. So that's 3 million. Times 16 over 100. So that should be definitely about 480. 480. That should be 480. Then you have those transport. We have the transport. Remember, those are the point of entry. So that those are basically inclusive. Transport. Transport cost. Clearing. We have clearing. We have clearing cost. So clearing cost and transport clearing is for 50. So for 50,000 times 16 over 116. 16 over 116. So we're having 450 times 16 over 116 for the clearing. So the figure should be 62. 62, 069. 62,069. Then we have the transport. Transport. Transport is a figure of 150. 16 over 116 for the transport. So transport should be 150. 150 times 16 over 116. So we have a figure of 20,690. That should be a figure of 26,690 for that. So then we proceed to the additional information. We have legal. Legal, we said legal are not exempted. Legal we have the legal expenses. So legal expenses, which we claim VAT. So that should be 350, 16 over 116. 16 over 116. 16 over 116. So 350 times 16 over 116. So the figure for the legal, that should be 48. We have 48 to 76. 48 to 76. 48 to 76. Then you have the next, salaries are exempted. You know, salaries and wages, salary and wages. We know that salaries and wages, these are basically exempted. So the figure was 133400. We know that these are exempted. Then we have office rent. Office rent. We claim input VAT. That should be 580. 580. 16 over 116 for that. 16 over 116. So we have a figure of 580 times 16 over 116. That should be about 8,000 for that. Then the next we have what we call, we don't even to put it there, that is water from the county, that is basically exempted. Then you have electricity. We can have the electricity. Electricity is a figure of 54, inclusive of VAT, 16 over 116. 16 over 116. So electricity is 54. 54 times 16 over 116. So the figure should be, that should be 7448. So that was 655, 172 plus 386, 207, 386, 207, 207, then minus 82, 759. So start again, 655, 172 plus 386, 207, then minus 82, 759, then plus 74, 483. 74, 483 plus 112, 138, 112, 138, then plus 524, 524, 138, then plus 480,000, for 80,000 plus 62, 069, 069 plus 20, 690 plus 80 plus 80,000. Then plus 7448. When you add that, that provides total. We have a total input VAT, total input VAT of 2,367,2,367,367 367 862. 2,367 862. 2,367 862. Look back at our statement. That is statement 8. The company could not identify goods sold as exempt when they were purchased and therefore restricted deductible input VAT. So there is restriction. So we need to restrict input VAT. So how do you restrict input VAT? We say that taxable supplies over what we call total supplies times total input VAT. So we say that taxable supplies is equals to standard rate plus zero rate. Standard rate plus zero rate. Then you say that total supplies is standard rate plus zero rate plus exempt. And when we are restricting NB, when restricting standard rate cells should be exclusive of VAT. When restricting, the standard rate cells should be exclusive of VAT. So we have a figure of the standard rate cells. The figure for the standard rate cells. This is a figure of 3,598,000. Remember, this figure was inclusive of VAT. So that implies that the figure is 116%. We make that figure exclusive. Exclusive is 100%. So 100%, basically we say 100% over 116 times 3,598,000. So exclusive standard rate exclusive of VAT. So we have that figure. So we have our calculator. That should be 100 divided by 116. Then we multiply by 3,598,000. So we have a figure of 3 million. We round it off. 101,724. 724 as what we call the standard rate exclusive of VAT. So we can get taxable supplies. So we can get taxable supply, which is zero rated plus zero rated taxable supply, zero rated plus standard rate. Taxable supply should be 3,101,724 plus 1.5, which is zero rated plus 1.5. So that gives us total taxable supplies to be, so plus 1.5. Plus 1.5, we have a figure of 4,601,724. 724. Then you can have total supplies. Total supplies, we say that should be a standard rate, which is 3,101,724 plus zero rate, which is 1.5, plus zero rate, which is 1.5, plus the exempt. Exempt is a figure, if you look at that paper, on additional information number 3 is a figure of 3,670. 3,670. So we get the figure. Then plus 3,670,000. So that should be 8 million. Total supply should be 8 million to 8 million. 8 million 271. 8 million 271. 271. 8 million 271. 724. So we restrict. At that point we restrict. We restrict. At that point now we can restrict. We can restrict at that point. We can restrict at that point. We have our formula for restriction. Taxable supplies. Taxable supplies is 4,601,601. 724. 724 over what you have as 8,271,271. 724. Then times total input VAT, which is 2,367,820, 862. So that is deductible or restricted deductible. Deductible input VAT. The input VAT, deductible input VAT. So we have a figure of 4,601,724 divided by 8,271,724. So the figure is 0.55 times 2 million, 367, 862. 862. Having a figure of 1,317,289. 1,317,289. So then we can get VAT payable or refundable. VAT payable, stroke refundable, stroke refundable, stroke refundable. That should be output VAT minus deductible, what you call the deductible input VAT minus the deductible input VAT. So we have the output VAT still here. That should be 496,276 minus 1,317,289. So we have, this is basically a refund. So when you say VAT payable, then you put it into bracket. But when you say VAT refund, this is basically VAT refund, VAT refund, VAT refund, VAT refund, VAT refund. So that should be a figure of 821,013. When you say VAT payable, when you say VAT payable, that should be into negative. That should be that. So that is how we particularly. But maybe just an emphasis on how an approach is very important. When you look at these values, remember what is of key is the entries. These are entries that are being marked. For exempt may not be marked. When you have this these figures are the ones that basically constitute the solution. The most important part is those figures, understanding those figures. That is what basically would provide us with the solution. So as a learner, very important to understand is that to follow the procedure. You may not understand a few points here and there, but as long as you are doing your entries perfectly well, you can have about, let's say, 80% to 100% of the entries, you are in a good direction. So the key thing is to understand those entries and make sure that you make as many entries as possible. And when we do that, we will perfectly be handling those questions pertaining to the administration of VAT. That marks the end of our session. We meet in our next session.
Welcome to Manifested Publishers.
Hello learner, welcome to Manifested e-learning platform. My name is F.A. Emlyn Ngwiri and we are discussing about portfolio management. The focus of today's class is on introduction to portfolio risk and return. So what we're going to do, we're going to narrow down that discussion to assess the determinants of required rates of return. Now the determinants of required rates of return can be broken down into three. The first determinant of rate of return is the time value of money. The second determinant of the rate of return is expected level of inflation. The third and final determinant of required rate of return is the risk itself. So we are going to break down or try to understand how those factors influence the required rate of return and also investment decisions for investors. So we move over on this other side and start off our class. We mentioned that investors' required rate of return, investors' required rate of return, investors' required rate of return is one of the factors to consider, is one of the factors to consider when selecting securities for an investment portfolio. Securities for an investment portfolio. Continue and say, it is the minimum required rate of return that an investor would actually require so that they can be compensated for deferring the usage of funds today. So we say that it is the minimum. It is the minimum rate of return. Rate of return is the minimum rate of return an investor should accept. An investor should accept. Minimum rate of return that an investor should accept from an investment in order. From an investment in order to compensate them for deferring consumption. From deferring consumption. So let's just recap what we've just written. Investors' required rate of return is one of the factors to consider when selecting securities for an investment portfolio. It is the minimum rate of return an investor should accept from an investment in order to compensate them from deferring consumption. So now since we've already now explained or introduced what the investor's required rate of return is all about, we now start by assessing the components. The first component that I had mentioned to you, number one, is time value of money. Time value of money. That's the first determinant that an investor should consider before investing or making an investment decision. So we say that the value of the sum of money at a future date that has been that has been invested at a certain rate, at a certain rate of compound interest, certain rate of compound interest over a certain period of time, We'll stop. Let's stop there. We are saying that TVM, time value of money, is the value of the sum of money at a future date that has been invested at a certain rate of compound interest over a certain period of time. A shilling today is not what it was a shilling, say, 10 years ago. So that is that concept of time value of money. Very important determinant for required rates of return. Investors therefore prefer to receive money more sooner than later. Why? Because investors can reinvest those funds or those proceeds they've actually received at a different at a different rate of return. So we can say that investors, we move over on this other side, prefer to receive money sooner rather than later. The reason being is that receiving money sooner can allow them to reinvest at prevailing rates of return so that they can be able to earn inflows as opposed to waiting to earn it much later on. The second determinant of required rate of return, very important, is number two, expected inflation. Expected inflation. This is the rise and fall of the level of purchasing power, or the purchasing power, whether it actually increases or decreases. When inflation levels actually go down, or when the inflation is, say, manageable or slightly low, it means that what you can buy with 100 shillings or 1,000 shillings is going to be much more as compared to when the inflation levels are actually high. This is an important factor to consider. How much money you'll actually receive. Will it have a higher purchasing power or will it have a lower purchasing power? So we say that the rise and fall of inflation, must be included in any calculation in order to reflect the value of the investment, value of an investment at a later date. Rise in prices, a rise in prices of general price of commodities leads to lower spending power. leads to lower spending power, and vice versa. So we note that the rise and fall of inflation must be included in any calculation in order to reflect the value of an investment at a later date. Nominal value, the real value. The real value factors in that element of inflation. A rise in prices of commodities leads to lower spending power. That is the second most important determinant of the required rate of return. The third one, ladies and gentlemen, is risk. 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 Risk factors, we can say, risk factors may vary. Risk factors may vary from instrument to instrument, from instrument to instrument, instrument to instrument. Risk of investing in a venture capital firm might be high, but the expected returns from that investment need to compensate the investor for deferring the usage of funds today to place to make an investment or that investment in that risky venture. So we can say that the risk of investing in a venture capital firm, please note that a venture capital firm is considered to be maybe a firm that has just begun and that is actually considered to be, say, a startup, not a startup from the grass. So we are saying that it's like, so there at this level, it's moved from that level over there to this level over here, and in terms of the assets or in terms of say the size of the company has moved from that smaller level to this. So this is what we're considering a venture capital firm over here, or we can be able to say a venture capital firm is generally like considered to be a startup there. So the risk of investing in a venture capital firm is high, but returns should compensate. But returns should compensate. Returns should compensate for the higher risk taken, compensate for the risk taken. Risk taken right there. So we are saying that risk factors may vary from instrument to instrument, or from investment to investment, or from asset class to asset class. The risk of investing in a venture capital firm is high, but the returns generated from that investment should compensate for the risk taken, right there. And this brings us to the end of this subsection that we are talking about determinants of required rates of return. Three major ones. And the first one is the time value of money. The second one we've already discussed over here is the expected level of inflation. And the third one is risk. As usual, I will leave you with an assignment. So come over on this other side. Explain giving or citing examples, the determinants of required rates of return. The determinants of required rates of return. Required rates of return. That is the assignment that I have for you today. We hope you've enjoyed in this class. Thank you and be blessed.
Welcome to Manifested Publishers.
We pick it up on illustration, that is the taxation of trustee. Our first question comes from April 2023. April 2023. Question 5C. Question 5C. April 2023, question 5C. We'll read the question. Malezi Trust was formed in the year 2021 for the benefit of Alex Malezi's two children, Mona and Nora. The following information was provided to you by the trustee in respect of the trust income and expense for the year ended 31st December 2022. Additional information 1. The trustee reported trading profit of 160,000 for the year. This was after deducting the following expense: printing and stationery, 1 million shillings, legal fee out of which 1,200 was in respect to defending, out of 1,200 was in respect of defending one of the trustee involved in illegal business deal. Then we have tax consultancy, a figure of 2.4. We have the next, that is purchase and installation of a software, a figure of 2 million. We have trustee salary as per the trust agreement, that was 10 million. Then you have loan repayment, into bracket, interest included, a figure of 1.1. The total was 8 million. Then you have lease charges were shillings 3 million, out of which 600,000 was in respect to drafting a 10-year lease agreement. Then you have what you call preliminary expenses in respect of the trust formation was 3.4. Then we move to the additional information number 2. The trading profit was before taking into account the following capital expenditure: a warehouse, that is from 1st April 2022, a figure of 3.5 million. Then we have delivery van from 5th May 2022. We have a figure of 1,750,000. We have saloon vehicle from 1st January 2022. The figure is 3.8 million. Then we have the sports pavilion from 1st September 2022. The figure is 1.2 million. So we're being told that trustee received a gross rental income from the commercial properties of 120 million. And the gross interest income from fixed deposit of 20 million. Then you're being told that fee paid to investment manager in charge of the rental property was a fixed deposit amount of 12 million. Additional information number 4. We're being told that each beneficiary is entitled to a quarter share of the net distributable income. That each beneficiary, we know that there are two sons, that is Mona and Nora, is entitled to a quarter share of the net distributable income. Then you're being told that the fixed annuity of each beneficiary was shillings 10 million. The figure is gross. Then you say that trustees made 6 million to Nora and 3 to Mona and 3 million to Nora as discretionary payment as per the agreement. Then required. One is that compute the income tax payable on the trust income for the year ended 31st December 2023. Then compute the amount due to each beneficiary for the year ended 31st December 2022. We begin the analysis. Malezi Trust was formed in the year 2021 for the benefit of Alex Malezi's two sons, that is Mona and Nora. The following information was provided to you by the trustee in respect of the trust income and expenses for the year ended 31st December 2022. So the first additional information, we're being told that the trustee reported a profit of 160 million for the year. This was after deducting the following expenses. At that very point, we noticed that for this particular question, the method that we need to get the taxable income is basically what we call the net profit method. And the reason that underlie that is because we have been provided with the accounting profit. So the first expense that was subtracted, we are being told that printing and stationery, a figure of 1 million, that should be allowable expenses, that should not be adjusted. Then I have our number 2, additional information 1.2, legal fee of 6 million, out of which 1.2 was in respect to defending one of the trustee involved in a legal business. So there's a 1.2 that we treat as non-allowable. If we have a 1.2 that we use to defend a trustee that was engaged in a legal business, then that should be what we call a non-allowable expense. And note that we say that for this particular question, we are using the net profit method. It means that we need to add back a figure of 1.2, which is a non-allowable expense. The implication of subtracting a non-allowable expense is that you understated the net profit that was provided as 160. So we need to add back that figure of 1.2 to get the right position of profit. Then we have what we call tax consultancy fee was 2.4. We say from tax expenses like the tax consultancy, those should be non-allowable expenses. By subtracting that 2.4, you underestimated the profit. So the correction would basically be to add it back. Then the next we have purchase and installation of accounting software. We know that accounting software that we've been told that is a capital expenditure. So we need to add back that figure of 2 million. Then you're being told that trustee salary as per the trust agreement, that's 10 million, that should be allowable. Then we have loan repayment. We are told that out of that there's an interest of 1.1. So the loan repayment total was 8 million. So interest on loan is allowable expenses, but loan repayment is a non-allowable expense. So we can do our first amount. We get our first working. We say that loan repayment, we need to get the figure of the loan repayment. Loan repayment, less interest on loan, less interest on loans, less interest on loans. So we say that loan repayment is a non-allowable expense, but the interest that accrue from a loan is allowable. So if we had a figure of 8 million, we need to less minus 1.1. So this figure of 6.9, which is loan repayment, the figure of 6.9, which is loan repayment, that should be non-allowable. So non-allowable, we need to add it back to adjust it to get the taxable profit. Then the next, we're being told that a lease charge was 3 million, out of which 600,000 was in respect to drafting a 10-year lease agreement. So when you talk about a 10-year lease agreement, when you're drafting, renewing or drafting a lease that is less than 99, then that should be allowable. So the figure is allowable expense, so we do not need to adjust it. The next is what we call preliminary expenses in respect to the trust formation was 3.4. Expenses that are incurred before the inceptions of the trust are basically an allowable expense. So the figure of 3.4, that is a non-allowable expense. The figure of 3.4 is a non-allowable expense. Then we have additional information number 2. The trading period was before taking into the consideration of the capital expenditure. One thing that we need to understand that when you talk about the capital expenditure, when we talk about capital expenditure, we need to claim what we call investment allowance. In taxation, we do not have an expense called depreciation, but in place of depreciation, we claim what we call investment allowance. So being told that we have assets, we have a warehouse, we need to understand that warehouse qualify for an investment allowance called IBD, Industrial Building Deduction, that we claim at the rate of 10%, that we claim at the rate of 10%, at the rate of 10%. But mark this, he said from 1st April 2022. I know this is a lot of time based on the present rate, we need to not to apportion. Initially, we used to apportion wear and tear and the IBD, but don't apportion. claim the whole amount. For that warehouse, we have a figure of 3.5. So we claim 10% of the 3.5. I know if you look at some of the areas previously based on previous question, and sometimes you'll find these ones who are being apportioned, but based on the present rate, you need to claim the whole amount. Very important for learners to understand. Then we have delivery van, delivery truck. Remember that is wear and tear because that's motor vehicle at the rate of 25%. We need to claim it at the rate of 25%. At the rate of 25%. And we also claim the whole amount. We don't apportion. Previously, it was being apportioned. Then we have saloon car. Very important, you need to understand for saloon car and SUVs. We say that for saloon cars and SUV, if the value is more than 3 million, we restrict to 3 million. So we're going to claim 3 million out of that. We are going to claim 3 million out of that. That 25% of the 3 million. Then lastly, we have what we call the sports pavilion. Sports pavilion in this case, that is also IBD at the rate of 10% on the straight line. So then additional information number 3. The trustee received a gross rental income from commercial property of 120 million. That is additional taxable income, and a gross and what you call gross interest income from fixed deposit. That is an interest income that is subjected. We call it the non-qualifying interest, still subjected to further taxation. Fee paid to investment managers in charge of the rental property. We need to understand that we need to get the net because fee paid to investment manager, that is allowable expense. We need to less it from what you call the gross rental income to get the net rental income. Then lastly, on additional information number 4, we are being told that each beneficiary is entitled to a quarter share of the net distributable income. But there's a fixed annuity. Those are contribution to the beneficiary, who in this case is Mona and Nora. So there's a fixed annuity for each beneficiary, that is Mona and Nora. Each is going to get 10 million. Then we have trustee made 6 million. Trustee made 6 million to Mona and 3 million to Nora as a discretional payment as per the agreement. That is tied to the amount that is due to the beneficiary. So we begin with our first calculation. Compute the income tax payable on trust income for the year ended 31st December 2022. So we begin it on this other part. So we begin it on that other part. So we have trustee, that is for and Nora. Taxable income. Taxable income for 2022. Taxable income for 2022. So we say we use the net profit method, accounting profit provided. So accounting profit provided, we have shillings here, but we can round it off to 1,000. We had a figure of 160 million. So we have it as 160, we round it off to 1,000. Then we say add back. Why are we adding back? Because this accounting profit was already provided. What do we add back? Non-allowable expenses. Expenses in P and L, non-allowable expenses in P and L, comma, taxable income, not in the P and L, not in the P and L. Taxable income not in the P and L. So the first one is what we call we say that printing and stationery, that was allowable. We don't need to adjust that. We have what we call legal fee, 6 million, out of which 1.2, 1.2 was in respect to defending trustee on illegal business. Defending, that is an allowable defending what you call trustee on what you call illegal business. So we add that back. The figure, that figure was, we rounded to thousands. So if you round it to 1,000, that should be 1,200. That was 1.2. Then the next we have what we call, purchase and installation of accounting software. Before that, there's tax consultancy. We say expenses related to tax are non-allowable. Tax consultancy. 2.4, we round it to 1,000. That is 2,400. Then we have the next. We have the next, which we call purchase and installation of accounting software. That's capital expenditure. Purchase and installation of what we call accounting. Purchase and installation of accounting software. That should be 2 million, but we round it off to thousands. So we proceed to this at the end. So the next one we have, we're being told that trustees' salary as per the trust agreement, that is okay. Then we have what we call loan repayment. So loan repayment, interest on loan is allowable, but the loan repayment is not allowable. So we have loan repayment. So loan repayment, that was 8 million. We round it off to 1,000, then we less 1,100. Interest on loan is allowable, that should be 6,900. So then we have lease charges worth 3 million, out of which 600 was in respect to drafting a 10-year lease, that is allowable. Then we have the last one, preliminary expenses. Preliminary expenses. Expenses incurred before the formation of a trust, those should be what you call non-allowable. So we add them back. We add them back. So those are the non-allowable expenses. Unfortunately, we do not have taxable income that has not been included. So we add 1.2 plus 2.4 plus 2 million, rounded to 1,000, plus 6, plus 6,9, plus 6,9, plus 6,9, then plus 3.4. Giving us a total of 15,900. Then we say less allowable expenses, not in the P&L, allowable expenses not in the P&L. We have taxable, non-taxable, what you call non-taxable, taxable, operating incomes in P&L. Then you have what you call investment incomes in P&L. For the exam scenario, this is for the purpose of learners understanding what you're doing. But for an exam scenario, just say less. You don't need to write the whole thing. But for the sake of learning, we need to understand what needs to be less. We are saying allowable expenses which are essentially in the P&L, non-taxable operating incomes in P&L, and investment incomes that are in P&L. That is what we less. That is what we less. We pick our paper. And we are saying the first one that we have is investment allowance. Remember, investment allowances. We have the investment allowances. So the first one was non-allowable, the one that we had as non-allowable. That was a purchase of installation of accounting software. Accounting software. Remember that is investment allowance at the rate of 25%. So 25% times 2 times 2,000, that should be 500. That should be 500. Then we have the next, which is warehouse. Warehouse. So warehouse, those are buildings, IBD. That is IBD. IBD. IBD, that should be 10%. So 10%, 10%, the figure is 10% times 35. Initially, we used to apportion this figure based before the rate changes. We used to apportion this figure. For example, for the IBED, if it was April, we would have looked for about 9 months. So April, May, June to April to December, that should be 9 months, and say times 9 over 12. But with the present rate, we don't apportion, so we have it as 350. So when you get somewhere, it's a portion. Notice that with the changes that were effected, we don't apportion. Then we have what you call delivery truck. We have the delivery truck. Remember, these are motor vehicles again at the rate of 25%. So 25% times 1750. 25% times 1750. 25%, 0.25 times 1750 times 1750. So that should be, we have it as 437.5. We have it as 437.5. We have the next that we call saloon car. Saloon car. Saloon car. Remember, this is restricted. Saloon car is restricted. If the value is more than 3 million, you restrict to 3 million. So we have, that is 25% times, and that should give us 750. That should be 750. Then lastly, we have what you call sports pavilion. Sports pavilion. So sports pavilion, that's also IBD, that should be 10%. But I have emphasized that based on the present rates, you don't apportion this figure, you claim the whole amount. Previously, these figures were being apportioned. But with the changes that were effected, you claim the whole amount. So times what you call 1.2. Remember, the figures are rounded to thousands. The figures are rounded to 1,000. So that should be 120. So these ones were less. There's not any investment income that were included. The investment that were there are treated separately. So what do we less? The total that we less. So we have 500 plus 350 plus 437.5 plus 750 plus 120. So this should be 2157.5. So the only allowable expense were investment allowance that were essentially not included in getting the accounting income, which is 160. So we have net operating incomes. So we have the 160 plus 15,900, then minus 2157.5. So that gives us a figure of 173,742.5. That gives us 173,742.5. Then you add what you call other taxable income. Add other taxable income. We proceed and have it. Add other taxable income. So we read the additional information. Number 3, trustee received a gross rental income from commercial property. So other taxable income, we have the gross rental income. Gross rental income. So that should be a figure, that was 120 million, so that we have 120 at that. Then we also have what you call gross interest from fixed deposit. Gross interest from what you call from the fixed deposit. So if it was net, we get the gross. So that is a figure of 20 million. So we have 20,000, rounded to thousands. Then you're being told lastly that fees paid to investment manager in charge of the rental. We need to less that fee paid. That should be to get that fee paid. Fee paid to investment managers in charge of rentals, in charge of what you call the rental. So we less that figure. That is a figure of 12 million. So we have it as 1,000. So what is the net operating income? Net operating income, we had a figure of 173,742.5. Then you had plus 120,000 plus 20, then minus the 12. So this should be, this is a figure of, we have total taxable income, total taxable income. So we have the total taxable income, that is 301,742.5. That is what you have as the total taxable income. But if you look keenly to that question, income tax payable, after getting that, we get the income tax payable, the income tax payable, the income tax payable. So the income tax payable, we say that the taxed at the rate. So tax payable, we have it at the rate of 30%. Tax payable, we have the tax payable. Tax payable in this case, we have 30% times 301,742.5. We round it now to the whole figure. So we multiply by 1,000, so that is 500. So that is 301 million. The essence of this is, remember, we're rounding to 1,000. So when I come here, use the whole figure, that will basically be 301,742,500. We get 30% of that. So 301,742,500 times 0.3. So what do we have? We have a figure of 90,95,22,750. Then we less what? We less tax credit. So the tax credit is on gross interest from fixed deposit, withholding from what you call interest on fixed deposit. So the key thing is not the answer, but the key thing is a learner being able to understand that what is being checked there is the ability to understand that we tax them at 30%. So we get that. So the gross dividend, that was 15% times 20 million. So 15% of 20 million, 0.15. So that should be around a figure of 3 million. So we have the net tax payable. So the net tax payable, so we have 90,522. So that should be 87. So that is the net taxable for the trustee. That is how we sort part one of that particular question. So very important, just a recap of what you did. that one of the most important things as we do these questions is to focus. The focus is essentially on the entries that emanate from these particular questions. So at the end of the day, we got the tax payable. So we move to what we call compute the amount due to beneficiary for the year ended December 2022. So we say amount due to beneficiaries. 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 So we have Mona. One of the beneficiaries is Mona, Nora, and we have the totals here. Remember, we round these figures to thousands so that we don't have a huge figure. We round those figures to thousands. So we look at additional information. Number 4. Each beneficiary is entitled to a quarter of the net distributable income. We need to get that net distributable income. So we have a fixed annuity to each beneficiary. So we have the first one is fixed. What is distributable fixed? What we call fixed annuity. Fixed annuity for each. That was 10 million, so we're rounding it to thousands. That is 10. So that should be 20. We have 20. Then we have the next, we have discretion of payments. Trustee made 6 million to Mona and 3 million to Nora as discretion of payment. So we have discretional payment. So for Nora, that was 6 million. So this should be 9. So then we get what we call the net distributable income. So net distributable income. What we call the net distributable income. We have the net distributable income. So being told that the net distributable income, each beneficiary is entitled to a quarter share of the net distributable income. So what is the total taxable income? The total was 301,742.5 minus to get the net distributable, that is 20, then minus 9,000 in order to get that net distributable. So we're saying to get the total taxable income was 301,742,500. So that when you less the fixed annuity and the discretion of payment, we get what we call the net distributable income. So on that net distributable income, the examiner tells us that each beneficiary is entitled to a quarter share of the net distributable income. So we get the net distributable income, then we get a quarter for each. So that is 742.5 minus 20 minus 9,000. So that is 272,742.5. Then we multiply a quarter, we get a quarter. Each was entitled to a quarter. So a quarter of that, that should be 68. That should be 68. We have 68. 185.63. So 68, 185.63. The total for that. We have the total for the two. The total for the two times. So that should be about 136. 136. 371.25. So the total amount due. Total amount due to each person. total amount that is due to each person. Total amount that is due to each person. So we have just have it as it is. So total amount due to each, so that is 10 plus 6 plus 68, 185.625. So that should be 84, 185.625. This should be 81. That is for Mona. We have it there, sorry. Mona and Nora. So we have 81, 185.6. So that should be 165. So that is amount that is due to each. That is amount that is essentially due to each beneficiary, which is Mona and Nora, the figure that they get. So that is how we essentially get the part 2, the amount that is actually due to the beneficiary. So that marks the end of that question. We pick it on our next illustration.
Greetings and welcome back to the meetings compliance and administration lesson. Today we are going to study the subtopic complying with requirements of various meetings. Complying with the requirements of various meetings. And candidates, complying with the requirements of various meetings we know is a cornerstone of good corporate governance and legal validity. And in the context of companies in Kenya, compliance is mandatory. And this compliance is primarily governed by the Companies Act of 2015 and the company's own articles of association. So companies candidates are required to comply with the various laws and rules in relation to meetings. And this compliance I'm saying is governed by the Companies Act and the company's own articles of association. And failure to comply with these requirements can have serious consequences, including invalidation of the said meetings, invalidation of resolutions that are made in the meetings. It can have consequences like legal action, fines, and even reputational damage. So in this lesson, we are going to study, first of all, the general requirements for all company meetings. Then we will go ahead to analyze the specific requirements for different meetings. So we begin with the general requirements for all company meetings. What are the general requirements for all company meetings? General requirements. So one is a general requirements. General all right. Companies are required to comply with a certain laws or rules in relation to meetings. Now, there are fundamental principles that must be adhered to regardless of the meeting type. That's what we want to analyze here. But later on, we are going to analyze the specific requirements for different meetings, like the annual general meeting, the board meetings, the creditors meetings, extraordinary meetings, and so on. Because before we get to those different types of meetings, let's first of all analyze the general requirements for all meetings regardless of the type. You understand? Now, the first requirement is proper notice. Proper notice. Proper notice. Before any meeting is held, before any company meeting is held, there ought to be a proper notice that is given out. This is the most critical requirement. A notice must be given to every person that is entitled to attend the meeting. And it must be in writing, right? Which can be in hard copy or electronic form. And it must specify the date. The notice must specify the date, the time, and the place of the meeting, as well as the general nature of the business that is to be transacted in that meeting. So the first general requirement for holding company meeting, regardless of the type of a meeting, there has to be a proper notice that is issued to those who are required to attend the meeting. That's number one. The second general requirement is proper authority. There has to be proper authority. Proper authority. What do we mean by proper authority? Now, the meeting must be convened by a person or a body with the legal authority to do so, as stipulated in the company's articles of association or in the Companies Act. Not anyone can convene a meeting. The laws are very clear on who can convene a meeting, be it an annual general meeting or a meeting of creditors or an extraordinary meeting. The Companies Act and the Articles of Association of the company stipulates clearly who is to convene such meetings. So that is the second general requirement of holding any company meeting. The third requirement is in relation to quorum. Quorum. Now, a valid meeting cannot proceed without a quorum. A quorum means the minimum number of members or directors that are required to attend or to be present during the meeting. And this number is typically specified in the company's articles of association. There are meetings that require a certain minimum number of members who are to attend such a meeting. So if the members are not present in that meeting, then that meeting cannot be held. That meeting cannot be held. And if a quorum is not present within the specified time after the schedule starts, then the meeting must be adjourned. The meeting has to be done what? The meeting has to be adjourned. That is the third general requirement. Now, the fourth general requirement is in relation to chairman or chairperson. The chairman or the chairperson. There has to be a designated person. There must be a person, a designated person. In other words, a designated person must chair the meeting to ensure it is considered an orderly and the meeting is held in an orderly and a fair manner. You understand? That's a requirement. A meeting must be chaired by a designated person. And this person ensures that the meeting is held in an orderly and fair manner. Chairman. 5 minutes. That's another requirement for holding a meeting. Minutes. There ought to be detailed minutes of the proceedings that must be kept, and these minutes, the minutes, okay? The business that is conducted in the meeting must be documented. Detailed minutes of the proceedings must be kept. And these minutes are a legal record of the meeting and must accurately reflect the decisions or resolutions that are made during the meeting. They should be signed by the chairman. These minutes must be signed by the chairman of the meeting or the chairman of the next meeting. Minutes. That is general requirement number 5. And these are the general requirements of holding meeting regardless of the type of meeting. So first of all, I said we are studying the general requirements, the first one being proper notice. Number 2, proper authority. Number 3, quorum. Number 4, chairman. Number 5, minutes. That is the first part of this lesson. Then number 2, we want to study the specific requirements for different meetings. Specific requirements for different meetings. Specific requirements for different meetings. There are different kind of meetings that a company can hold. One such meeting being the annual general meeting. Number 1, we have the annual general meeting. The annual general meeting. What are the requirements for annual general meetings? Annual general meeting, or AGM. Now, an AGM is a formal meeting of the company's members that is held once a year. That's why we are referring to as annual general meeting. Companies are required by law to hold an annual general meeting. So, in studying the requirements of holding a general meeting, then we need to ask ourselves, who must hold an AGM? Who must hold an AGM, an annual general meeting? Now, every company, except for a single member company, every company must hold an annual general meeting each year. And we have even public companies that are required to hold their annual general meeting within 6 months of their financial year end. You understand? Private companies are not legally required to hold an AGM unless the articles of association say so. But public limited companies are required to hold an annual general meeting. Private companies are not required by law to do so. But if the articles of association states that there ought to be an annual general meeting, then such an annual general meeting must be conducted. So then number 2, we need to study the notice. Remember, we say that one requirement for holding any meeting, regardless of the type, is having a proper notice. Now, for a private company, the notice period must be at least 14 days or 21 days as per the Companies Act. But for the public companies, the notice period is at least 21 days. The company articles can specify a longer notice period, but the Act specifies that it has to be at least 21 days. So that is the requirement when it comes to notice of an annual general meeting. Then number 3, the third requirement when holding an annual general meeting is in relation to the business transacted. Business transacted. Business transacted. Now, an annual general meeting typically deals with routine matters, including approval of the company's annual financial statements and reports. Another routine matter could be declaration of dividends. It could be the appointment of the directors or appointment of auditors or appointment and fixing the remuneration of auditors. These are routine matters that are transacted during annual general meeting. So the law is also clear on what businesses or what business ought to be carried out or conducted during the annual general meeting. So that's the third requirement in relation to the meeting we are referring to as the annual general meeting, the A. Then number 4, we can study the procedures. The procedures. Now, to comply, the company must ensure all required documents are circulated to members along with the notice. Now, to carry out candidates an annual general meeting, there are procedures that have to be followed. For example, is ensuring that those who are to attend the meeting have access to the required documents like the annual report, like the financial statements, that ought to be circulated to members along with the notice. Along with the notice. So these are the requirements of an annual general meeting. Let's now analyze the requirements of the extraordinary meeting. Extraordinary meetings. This is another type of meeting that can be held by a company. Now, an extraordinary meeting is a meeting of members convened to discuss special or urgent business that cannot wait until the annual general meeting. That's why it's called extraordinary. So the question we need to ask ourselves is, who must hold or who can convene such a meeting? The first requirement, who can convene such a meeting? One, who can convene an extraordinary meeting. Now, the directors can convene an extraordinary meeting whenever they deem it fit. You understand? The directors can convene an extraordinary meeting. But members also have a right to requisition such a meeting. Number two, members' right to convene. The shareholders, apart from the directors, the shareholders may also have a right to do so. The Companies Act gives members a right to convene an extraordinary general meeting. You understand? Members holding a certain percentage of the company's voting shares can compel the directors to convene or to call a meeting. And if the directors fail to do so within a specified time frame, and this time frame is 21 days, then the members can call the meeting themselves at the company's expense. So directors can convene this meeting. The members can also convene the meeting. We are calling the extraordinary meeting. Understand? Yes. Then let's discuss the notice in relation to extraordinary meeting. Notice. Now, the notice period for an extraordinary meeting is generally 14 days. So the notice here is 14 days. 14 days. Then what of the business that is to be transacted? Business transacted? Business. What business is transacted during an extraordinary meeting? Now, an extraordinary meeting deals with specific non-routine matters such as altering the company's articles of association, approving major transactions, or removing a director, and so on. These are non-routine matters, as opposed to the annual general meeting that deals with the routine matters like the appointment of directors, auditors, and so on. So that is a business that may be transacted during extraordinary meeting. Understand? And it is important to note that a resolution that is passed at an extraordinary meeting is often a special resolution. If resolutions are passed at an extraordinary meeting, it is usually a special resolution. Special resolutions are issued at an extraordinary meeting, okay, which requires a 75% majority of the votes that are cast. And the notice must clearly state that a special resolution will be proposed at the extraordinary meeting. So that's all we can say about extraordinary meetings. This is the second type of meeting. The first type is the annual general meeting. Candidates, we are studying the special or specific requirements for different types of meetings. The first one is the annual general meeting. The second one is the extraordinary meeting. The fourth one is the board Board meetings. Board meetings. Now, board meetings are meetings of the company's directors to discuss and make decisions regarding the company's management. So what is the frequency of this meeting? So the first requirement is in relation to frequency. How frequent are these meetings held? Now, the company's articles usually specify how often board meetings should be held. So it could be 2 times in a year, 3 times. It depends with the articles of association of the company. What of the notice? Notice. Now, are there notices that are required? Yes. The company's articles of association typically also sets the notice period for board meetings, which can be much shorter and less formal than for general meetings. Then number 3, we have quorum. Are there any requirements in relation to quorum of board meetings? Yes, the quorum for a board meeting is usually specified in the Articles of Association of the company. The Article of Association of the company will specify the quorum that is required for board meetings to be held. Then lastly, we have minutes. Minutes. Now, the Companies Act requires that minutes of all proceedings at board meetings are recorded and kept at least 7 years, for at least 7 years. The minutes must be kept for at least 7 years. And these minutes are a key legal document and can be used as evidence of the board's decisions. You understand? Yes. Then lastly, we have the director's duties. What are the director's duties in relation to these meetings? Director's duties. Director's duties. Director's duties. Now, at all times, directors must comply with their fiduciary and statutory duties to act in the best interest of the company. So when dealing with board meetings, there is a requirement that the directors have to be loyal. The directors are required by law to comply with their fiduciary duties and statutory duties, and these duties require that these directors act in the best interest of the company. And their deliberations and decisions at board meetings must reflect these duties. They must reflect fiduciary and statutory duties. You understand? Yes. So this is the meeting we are referring to as board meetings. Then lastly, let us analyze creditors' meetings. Creditors' meetings. Creditors' meetings. This is a meeting of creditors. Creditors' meetings. Apart from the board members, apart from the shareholders, the auditors may also convene a meeting. And these are meetings that are held during the company's liquidation, administration, or restructuring. When the company is restructuring, when the company is facing liquidation, then the company may have to conduct what we are calling the creditors' meeting. So what is the purpose of this meeting? One, purpose. What is the purpose of creditors' meetings? Now, the purpose of conducting a creditors' meeting by a company is to inform creditors of the company's financial status. It may also be to approve the scheme of restructuring or arrangement, or to appoint a liquidator. When a liquidator is to be appointed, then the creditors must be involved, and they can only be involved when a creditors' meeting is called. So I've identified for candidates the purposes of a creditors' meeting. Number 1 is to inform creditors of the company's financial status. The second purpose is that the meeting can be held when approving a scheme of arrangement by the company. Or number 3, when the company seeks to appoint a liquidator. So these are part of the requirements we are discussing. You understand? Yes. Then let's analyze the legal basis. What is the legal basis of holding a creditors meeting? Now, the process for creditors meeting is governed by the Insolvency Act of 2015. So that is a requirement. When conducting a creditors meeting, then the meeting has to be conducted in line with the Insolvency Act of 2015. Compliance. The administrator or the liquidator must comply with the strict procedures and timelines that are outlined in the Insolvency Act, including sending notices to all non-creditors, including preparing statements of affairs, and also conducting the meeting in a manner that allows for a fair vote. So these are the requirements for holding a creditors meetings. And that's the end, candidates, for today's lesson on complying with the requirements. Complying with the requirements of various meetings. And at the beginning, we did state that complying with the various requirements of various meetings is the cornerstone of good corporate governance. We did also state that failure to comply with these requirements can have serious consequences, including invalidation of resolutions that are made during the meetings, including legal action and also fines and reputational damage. We've gone further in this lesson to analyze the general requirements that companies are required to comply with, regardless of the type. There are fundamental principles that companies must adhere to, regardless of the meeting type. And one such is proper notice, proper authority, quorum, chairman, minutes. Then we've analyzed the requirements for specific meetings. The first meeting type is the annual general meeting. We've studied the requirements of extraordinary meetings. Then number 3 is the board meetings. Then lastly, we have the creditors meetings. Creditors meeting, the requirements for creditors meetings. Now, in closing, we can state that compliance with the meeting requirements is a detailed process that requires strict understanding of the Companies Act, the Insolvency Act, the Articles of Association, and the various laws that pertain to meetings. And that requires the company secretary to be quite skilled. A skilled company secretary here becomes an invaluable asset in ensuring that these requirements are met, which then protect the company from legal and financial risks. So that's why we are studying the subtopic on complying with the requirements of various meetings. So as a company secretary, you need to understand what are the requirements of various company meetings, which include the annual general meeting, what are the requirements for the extraordinary meeting, what are the requirements for the board meetings, what are the requirements for the creditors meetings. And that's the end of today's lesson on complying with the requirements of various meetings. Bye-bye. Bye. Greetings, candidates, and welcome to the Manifested eLearning platform. The subject is Advanced Financial Management. We continue with the topic mergers and acquisitions. In our today's session, we're going to discuss the arguments for and against the use of mergers and acquisitions as tools for corporate expansion. Why would companies choose to merge? Why would a company choose to acquire another one as a tool for corporate expansion? Because by now we are aware that mergers and acquisitions are tools that companies use for corporate expansion, but these tools come with both potential benefits and significant risks, benefits and disadvantages, advantages and disadvantages. These advantages are what we are calling arguments for mergers and acquisitions. So what are the arguments for the benefits? We begin with the benefits, then we'll move on to the disadvantages. Why would companies choose to merge or companies choose to acquire other companies? One reason is to increase market share. Increase market share. One obvious benefit that may accrue to a company, increasing the market share. Acquiring or merging with a competitor can rapidly expand a company's customer base and market presence. That is one benefit. Second benefit for mergers and acquisition is the economy of scale. Economies of scale. Combining operations through merging can lead to cost savings through shared resources, bulk purchasing, and streamlined processes. That can lead to economies of scale. Access to new markets. New markets. Mergers and acquisition can provide a company access to new markets and technology. Mergers and acquisitions, in other words, can provide a quick entry into new geographical regions or access to innovative technologies that would take years to develop organically or internally. Instead of a company waiting to grow organically, to grow internally, the company can choose to merge with another one so that the benefits can be enjoyed quickly. Access to new markets. Technology. Number 4 benefit is diversification. Diversification. How is diversification a benefit? Now, acquiring companies in different industries can reduce risk by diversifying revenue streams. Diversification. 5 is enhanced competitive advantage. It can lead to enhanced competitive advantage. Mergers and acquisitions can lead to enhance competitive advantage by combining strengths. When companies come together, companies combine strength, that can create a stronger and more competitive advantage. 6, faster growth. Faster growth. Mergers and acquisitions can lead to faster growth. Mergers and acquisitions, in other words, can allow for rapid expansion compared to organic growth. Now, the list is not complete without mentioning synergy. Synergies. The combined company, after merging, often achieve more together than the individual companies could separately achieve. We always say two are better than one. What two companies can achieve together far much outweigh what each individual companies can achieve separately. That's what we're referring to as synergies. So these are 7 benefits. Let's discuss the disadvantages of mergers and acquisitions. Disadvantages or arguments against use of mergers and acquisitions. What are the disadvantages? One is the disadvantages or challenges. We have integration challenges. When companies merge, there is always that difficulty or challenges when it comes to integration, merging different company cultures, merging the different systems of a company, merging the processes. That can be a complex exercise, and that is one challenge that comes with mergers and acquisitions. How to merge the different corporate cultures, company cultures, the processes, the systems, and so on. 2, cultural clashes. Cultural clashes. Differences in corporate cultures can lead to conflicts. It can lead to employee dissatisfaction and also decreased productivity. Cultural clashes. 3, financial risks. There are also financial risks that are associated with mergers and acquisition transactions, which may involve significant debt. For a company to purchase another company, the acquirer or the predator may be required to seek for debt, which can lead to financial risks. So mergers and acquisition transactions often involve significant debt, and there is a risk of overpaying the target company, which may lead to financial risks. We also have challenges associated with complying with regulations. M&A deals are subject to regulatory scrutiny, particularly the competition laws, which can delay or even block transactions. Another challenge is associated with employee morale, employee morale and turnover. This is yet another challenge associated with mergers and acquisitions. Employee morale and turnover. Mergers and acquisitions can create uncertainty among employees, and that can lead to anxiety, that can lead to decreased morale, and ultimately high turnover is a challenge which the management should take note of during mergers and acquisitions. When employees are told that the company is going to be acquired, that can lead to anxiety, uncertainty, and that affects productivity, and it may increase turnover. That is disadvantage number 5. Number 6 is valuation difficulties. Valuation challenges. During mergers and acquisitions, it may be necessary for the company that are merging or the company that is being acquired to be valued. So accurately valuing a target company can be challenging, and we've seen in the past companies overpaying. That is a common risk, overpayment, because payment is based on valuation. If no proper valuation is done, then company may end up being overpaid and so on, and that can be a great challenge. 7, failure to achieve synergies. Failure to achieve synergies. One of the main reasons for merging and acquiring companies is to achieve synergies. But sometimes the anticipated benefits of mergers and acquisitions may not materialize, which may lead to financial losses. That is number 7. The 8th and last disadvantage here is disruption of core business. Disruption of core business. Disruption of core business. Mergers and acquisitions can sometimes affect the operations of an entity. They can divert the management's attention. Mergers and acquisitions can also divert resources from the company's core business, and that is a challenge. So these are 8 disadvantages or arguments for and against use of mergers as tools for corporate expansion. There are other tools that companies can use when planning expansion, like what we call developing the internal processes can also be another way to expand. You understand? What we call organic growth. A company can grow organically, or company can choose to merge or acquire another one in order to achieve corporate expansion. In our next session, we will be discussing the mergers and acquisitions versus organic growth. For now, we take a break from our today's lesson, where we've discussed the arguments for and against the use of mergers and acquisitions. Thank you for attending the lesson. Bye-bye. Hello and a warm welcome to the lesson. The subject is meetings. Today we are going to the second chapter, which is professional framework of the corporate secretarial profession. This chapter has 12 sub-chapters. One is evolution of the corporate secretarial profession. Number 2, legal and regulatory framework. Number 3, role and mandate of corporate secretarial professional bodies. Number 4, procedures on registration and deregistration of a member. Number 5, professional qualifications and qualities of a secretary. Number 6, required knowledge, skills, and competencies. Number 7, appointment and vacation of office of the secretary. Number 8, professional engagement and clearance of a corporate secretary. Number 9, rights, statutory and contractual obligations of a corporate secretary. Number 10, role of a corporate secretary. Number 11, continuous professional development. And number 12, disciplinary procedures of corporate secretary. So these are 12 subchapters under the chapter Professional Framework of the Corporate Secretarial Profession. In this lesson, we begin with the first subtopic, which is the evolution of the corporate secretarial profession. And in studying the evolution of the corporate secretarial profession, we will first of all focus on the global perspective. Global perspective. Global perspective. Then we'll move to case study of Kenya. Global perspective. Global perspective. Now, candidates, the evolution of the corporate secretarial profession marks a shift from a humble clerical role or to a high-level strategic position. Initially, that is to mean that the corporate secretary played clerical duties, but today the corporate secretary sits at the board of a company. The modern company secretaries are now seen as the chief governance officers, or to put it in another way, they are now seen as the guardians of integrity. But traditionally, the corporate secretary performed clerical duties. They had a clerical role. So let's first of all begin with a global perspective of a corporate secretary, beginning with the scribes to strategies. Okay? They were initially scribes, or just individuals in organizations who performed clerical duties, but today they are now strategists because they sit at the board of companies. So the profession has evolved through three distinct historical phases. The first phase is the ancient origins and the scribes. Initially, these were just scribes. So we have the ancient civilization where the secretaries were merely scribes, right? So the first phase, let me put it in phases. Phase 1, the first phase is the ancient origins, all right? Now, candidates, don't forget we want to look at the evolution, how the corporate secretary has evolved from ancient origins and the scribes origins and scribes to the modern day strategies. That's phase 1. And in phase 1, candidates, we have the ancient origins or the ancient civilizations. So we have to first of all identify ancient civilization, because we are studying the evolution. So we are going into the history of the corporate secretary from the ancient civilizations. Candidates, the term first of all secretary comes from the Latin secretarius, which means a person who is entrusted with secrets. The word secretary is derived from the word secrets. So initially, the corporate secretary was an individual who was entrusted with the secrets of an organization. You understand? The word secretary is derived from the Latin word secretarius, meaning a person that is entrusted with the secrets. And in ancient Egypt and even Rome, secretaries were highly educated men who served as confidants to rulers, and they recorded private state matters. You understand? That is ancient Egypt. Ancient Egypt and Rome. These were men. It's important to note that, because later on we'll be seeing how there was a shift in gender. Initially, it's only men who performed this role of the secretary. In ancient Egypt and Rome, these were highly educated men as the male gender. They served as confidants to rulers, and they recorded secret state matters. Important to know that is in ancient civilizations. Then we have the Middle Ages. When we fast forward to the Middle Ages, in the Middle Ages, the role was largely clerical. All right, the role was largely clerical. The role was largely clerical. The role of the secretary was largely clerical and conducted by the clergy. And conducted by the clergy. The role of the secretary was highly or largely clerical, and it was conducted by the clergy. It was conducted in the Middle Ages by the clergy. It was conducted by the clergy, and they were responsible for record keeping and bookkeeping for the church and the nobility. Largely clerical and conducted by the clergy. That's where we get the origin of the word clerk. The word clerk is derived from the word clergy. So in the Middle Ages, the secretary duties were highly clerical, and they were conducted by the clergy. They were conducted by the clergy. They were responsible for record keeping and bookkeeping for the church and nobility. So that is phase one. This is phase one. Then moving to phase two. Phase two. Candidates, are you following? We are describing the evolution of the corporate secretarial practice. So we've analyzed phase one. We are moving to phase two, which comprises the Industrial Revolution era. Industrial Revolution. This is the Industrial Revolution. During the Industrial Revolution, this is around towards the end of the 17th or 18th century. Industrial Revolution. Industrial Revolution. Most of you have studied history. If you are Kenyan, you must have studied history. You must have come across the era we refer to as the Industrial Revolution, which began in the United Kingdom in the 19th century. All right, so here we have the 19th century. After the Middle Ages, we move to the 19th century. We want to see what was the role of the corporate secretary. Now, as we know very well that during the Industrial Revolution, there was the emergence of many factories, many companies that were jointly owned. The joint stock companies, right? As joint stock companies emerged, the Joint Stock Companies Act in the United Kingdom introduced the need of formal records. There was formal need for records. And that is when the company secretary was born. Though primarily as a servant of the board, the corporate secretary was tasked with organizing meetings. The company secretary was tasked with filing records and so on. You can see the role has now shifted during the Industrial Revolution, where many joint stock companies were introduced. In the United Kingdom, the United Kingdom had to enact an act of parliament known as the Joint Stock Companies Act in 1844. In 1844, the United Kingdom enacted an act known as the Joint Stock Companies Act. And through the act, there was formal need for records. The act insisted on a company having formal records. And these formal records were to be kept by the company secretary. The act stated that the company secretary's role, one of the roles was to organize meetings of the board and also to file records. That is the 19th century. Right? You understand? Yes. The Industrial Revolution and legal reforms. That is 19th century. 19th century in UK. United Kingdom. Then it's important at this point to note the shift from the role that was played by men. There was a gender shift. In phase 2, there is now the gender shift. Initially, it was only men that were entrusted with secrets of the state. But with the emergence of industries in the UK, then the role shifted not only to, it was not restricted to men, but also the women. Now, until the late 1880s, the role was male-dominated. But with the invention of the typewriter and the telephone, women entered the workforce, and the role became increasingly associated with administrative support. Before 1880s, it was male-dominated. After 1880s, the field was now open. Women also joined the workforce with the introduction of the typewriter and the phone. And the role of the corporate secretary became largely administrative. That is phase 2. Now moving to phase 3. Phase 3, this is phase 1, then there is phase 3. Now phase 3 is now the current phase, the 21st century. All right, this is the 21st century. In phase 3, we are now in the 21st century, and this is the century of governance professional. In this phase, this is the phase of the governance. This is the phase of governance professional. Governance profession. The governance profession. This is the post-financial crisis. All right? the post-financial crisis. Following major corporate scandals like the one witnessed with the two companies, the Enroll and the WorldCom, global governance codes like the Cadbury, the Sarbanes-Oxley, they redefined the secretary's role. I know you understand what I mean by governance codes. Global codes of governance. Post-financial crisis. Let me put here an S. Post-financial crisis. After the Industrial Revolution later on, the world experienced crisis in major companies. And to address those the crisis and the financial crisis that was that happened, there was need to put in place global governance codes, which then guided on how companies are to be managed and run. The governance professional phase. Understand? That's when now we have at this moment what we call strategic advisory. Today, the secretary is a board level officer. Strategic advisory. Strategic. At the moment, the company secretary is a board level officer. They are no longer just note takers or just taking minutes. No, they advise the board on matters to do with law, matters to do with ethics. They advise the board on sustainability issues. They advise the board on strategic matters and so on. That is the 21st century. So currently, in a nutshell, this is the global perspective of the evolution of the corporate secretarial practice. Now we shift gears to the case study of Kenya. This is global perspective. We move to the case study of Kenya. Case study of Kenya. We are studying Kenya in relation to the evolution of the corporate secretarial practice. Case study of Kenya. Case study of Kenya. What is the Kenya's professional journey? Now, Kenya's secretarial profession has followed a path of rigorous professionalization and legislative reform, and we have had various milestones. Now let's discuss the milestones that Kenya has undergone in relation to the evolution of the corporate secretarial practice. So milestone number 1. We study here the milestones. Milestones. Milestone 1. Milestone 1. The evolution of corporate secretarial practice case study of Kenya. Milestone 1 is pre-1988. That is the pre-1988, the colonial legacy. That's the first milestone, pre-1988. Number 1, pre-1988, the colonial legacy. Colonial legacy. Now, under the old Companies Act that was based on English law, the company secretary was largely a clerical role. There were no strict professional qualifications, and the person was often a lawyer or an accountant performing secretarial duties on the side. This is pre-colonial era. This era, the colonial era, happened up to 1988. Before 1988, which we are referring to as the colonial legacy, under the old Companies Act, because the Companies Act was changed in 2015. Okay, so before then, the company secretary played largely a clerical role. Understand? Then you have milestone 2. Milestone 2. Milestone, the second milestone. Milestone 2, the second milestone, is professionalization. Professionalization. This is the milestone, we can call it professionalization. And this came about with the enactment of the Certified Public Secretaries of Kenya Act in 1988 that turned things around. The enactment of the Certified Public Secretaries Act in 1988 was a turning point because it established the Institute of Certified Public Secretaries of Kenya. Understand? The enactment of the Certified Public Secretaries of Kenya Act. All right? Let me put it down. The enactment of the Certified Public Secretaries Act 1988 established, this act established the Institute of Certified Secretaries, the Institute of Certified Public Secretaries of Kenya, which now is known as the Institute of Certified Secretaries. Okay, it established, which we now know it as the Institute of Certified Secretaries. Because you cannot have professionalism without an institute, without a professional body that regulates the conduct of these professionals. So this act established the formation of the Institute of Certified Public Secretaries, which is now known as the Institute of Certified Secretaries. It created a professional body to regulate, examine, and also license secretaries, ensuring that only qualified individuals would act as secretaries for public companies. That's a very big milestone. Before 1988, the role of the company secretary, we've said, was largely clerical. It was largely clerical. That is the pre-colonial era, colonial legacy. But there is that milestone of professionalism. Then the third milestone is the Companies Act, which is the modern era. The Companies Act. The Companies Act. This is the third, 2015. This is the modern era. In the modern era, we now have the Companies Act. The current Companies Act significantly modernized the role of the company secretary. The company secretary is now has what we call an officer status. The Act explicitly recognizes the secretary as an officer of the company. The company secretary is now recognized by the Act as the officer of the company, right? Carrying legal liability for non-compliance. The company secretary now carries a legal liability for the company for non-compliance. the Act introduced a threshold where only private companies with a paid up capital of, say, 5 million or more are mandated to have a secretary. That is the threshold. For companies, for private companies, there's a threshold. Understand? But all public companies must have a company secretary. That is the law. All public companies, number one, this is the schedule. All companies, public companies, are required by law to have a company secretary. But for private companies, there is a threshold of 5 million Kenya shillings or more. A company with 5 million shillings or more paid up capital is also required to have a company secretary. You understand? Yes. That is a big milestone. The third milestone. The third milestone, the Companies Act, the modern era. You understand? So there is, first of all, official status. I've mentioned official status. The company secretary now has an official status. Is recognized as an officer of the company. Officer status. Officer status. The company secretary now has officer status. That is number one. Number two, the second thing that the Act did was to introduce thresholds. It introduces thresholds. Then the third important thing here is the strategic shift. There's a strategic shift. Because here we've seen pre-corona era, the company secretary largely played clerical role, but here is playing strategic roles. So there is a shift during the third milestone. So these are three important points that we draw from the Companies Act of 2015. That is during the modern era, and we are discussing today. This is 2026. In 2026, after the enactment of the Companies Act of 2015, during the modern era, 2016, we are deferring to the modern era. In the 21st century, the company secretary is recognized as the officer of the company, is explicitly recognized as a secretary, as an officer of the company, carrying legal liability for non-compliance. There is also thresholds where all public companies are required to have a company secretary, and all private companies with paid up capital of 5 million or more are also required to have a company secretary. So that is the modern era. Then there is a last milestone, which is the fourth milestone. Milestone number 4. Milestone number 4. Now, milestone number 4 is the milestone of the governance codes. Here we have governance codes. Governance codes. For example, now that we are discussing case study of Kenya, we have the Mwongozo Code. For example, the Mwongozo Corporate Governance Code. The Mwongozo Code for state companies. The Mwongozo Code for state companies. Code for state companies. Then we have the Capital Markets Authority, right? The introduction of Mwongozo Code for state corporations and the CMA Corporate Governance Code. CMA Corporate Governance code. The fourth milestone is a milestone of governance codes. And kindly don't forget, we are studying the evolution of the corporate secretary practice, the Kenyan case study. So we have the fourth milestone, which is the governance codes era. We have two codes that we can cite, the Mongozo Code for state corporations. Then we have the Capital Markets Authority Corporate Governance Code for listed companies. Right? This code is for, let me be specific, for listed companies. For listed companies, which has placed the certified secretary at the center of institutional integrity. Which has placed the company secretary at the center of institutions integrity. We are talking about governance codes, the code of governance. How these are guidelines that govern how companies ought to operate. And the certified secretary has been placed at the center of institutional integrity. They are now tasked with conducting governance audits, and they are also tasked with the responsibility to ensure that the companies are run ethically. They are to ensure organizations are ethically sound. So that is the evolution candidates of the secretarial practice. Global perspective and Kenyan case study. That's the end of the lesson on evolution. And in studying the global, just to do a recap, global perspective, there are how many phases? 3 phases. The first phase is the ancient origins and scribes. This is the era of ancient origins and scribe, which we did indicate that during the ancient civilization, number one, we have ancient civilization. During ancient civilizations, particularly in Egypt and in Rome, the profession, I mean, the term secretary, we've said, is derived from the term secretarius, meaning a person entrusted with the secrets. And these persons were entrusted with the secrets of the state. The ancient Egypt enroll. And these persons were men during that time. Men. That is ancient civilization. Then there is the Middle Ages. During the Middle Ages, the role was largely clerical, and it was conducted by clergy. That's where we get the word clerk. They were conducted by the clergy for the church. They were conducted by the clergy for the church. They were responsible for record keeping and bookkeeping for the church and for the nobility. That is during the Middle Ages. So during phase 1, we have 2 things: ancient civilizations and the Middle Ages. Then in phase 2, global perspective, we have the Industrial Revolution, with the emergence of many factories and farms which were jointly owned, the joint stock companies. Then there was a gender shift with the introduction of the typewriter and the telephone. The women joined the workforce, and at this point, the role of the secretary was largely administrative. During the 19th century, particularly in the UK, the Industrial Revolution happened in the UK, where we had so many joint stock companies that were formed. Understand? Yes. Then phase 3 is the governance profession. We have the post-financial crisis. We had many companies experiencing financial crisis, like the Enroll and the Welcome. Many of them experienced crisis because there was no experience on how to manage companies. Before Industrial Revolution, there were no industries before towards the 18th, end of the 18th century. So there was no experience on how to manage companies. And we know companies are run by human beings. And human beings, they have the tendency to be corrupt. So because of corruption and fraud, many companies experience financial crisis. And as a result of that, then there was as a result of this crisis that happened, following major corporate scandals, global governance course like the Cadbury redefined the secretary's role. There was need to have governance on how to manage companies. So there were roles that were introduced. There was now the strategic advisory role that was to be played by the company secretary. Understand? Yes. Today, the secretary is a board level officer. They are no longer just take notes or take meetings. They advise the board in law, in sustainability strategy, and so many areas. That's it for the global perspective. Then we've gone through the case study of Kenya. There are 4 milestones. Milestone 1 is a pre-1988 colonial legacy era, which the company secretary role was largely clerical. Then there's milestone 2, the era of professionalism. That was the enactment of the Certified Public Secretaries Act, which introduced the Institute of Certified Secretaries. With this institute, then this institute regulates the conduct of these professionals. That is milestone 2. Milestone 3, there is the Companies Act. All right, this is the modern era. In the modern era, under the Companies Act, the company secretary is recognized as the officer of the company. There are also thresholds in the Companies Act where all public companies are required to have a company secretary, and the private companies that have paid up capital of 5 million and above are also required to have a company secretary. The role now again shifts here to strategic. There is a shift. Kenyan perspective, the law gives now given that the officer of the company sits at the board, he now plays strategic role at the board. That is milestone number 3. Milestone number 4 is the governance codes. We have in Kenya now the Mwongozo Code for state corporations. Then there is a Capital Markets Authority corporate governance for listed companies, which has placed the company secretary at the center of institutional integrity. So that is the journey, okay, the Kenya's professional journey as far as company secretaries are concerned. That's the end of the lesson. In our next session, we are going to proceed with this chapter on professional framework of the corporate secretarial practice. We are going to study the legal and regulatory framework. Bye-bye. Hello and welcome to the lesson. The subject is business and data analytics. Today we are going to study the various types of data analytics. By the end of this lesson, you should be able to explain at least 3 types of data analytics. Types of data analytics. Types of data analytics. Data analytics, learners, is a broad field, and there are 4 main types of data analytics. There are 4 main types of data analytics. Number 1 is known as descriptive analytics. Number 2, diagnostic analytics. 3, predictive analytics for prescriptive analytics. 4 types: descriptive analytics, diagnostic analytics, predictive analytics, and prescriptive analytics. Now, each type here has a different goal and a different place in the data analytics process. Descriptive analytics is the first one. Descriptive analytics helps answer questions about what happened. Answer questions about what happened. What happened. And the techniques here summarize large data sets to describe outcomes to the stakeholders. And by developing the key performance indicators, all right, the strategies can help track successes or failures. And we may also have specialized metrics that are help to track the successes or the failures in an industry. We could have metrics such as return on investment, which is used in many industries, and so on. So the process here requires the collection of relevant data. Here it requires the collection of the relevant data, the processing of the data, data analysis, as well as data visualization. And the process here provides essential insight into the past performance, because data analytics answers the question, what happened? It looks into the past, the history, what happened in the past, what is the past performance, and so on. So descriptive analytics looks into the history, into the past, what happened. The second type of data analytics is diagnostic analytics. And here, diagnostic analytics helps answer the questions about why things happened. Why things happened. This is what happened. Diagnostic answers the question, why things happened. And the techniques here supplement more basic descriptive analytics. They take the findings from the descriptive analysis and digs deeper into the cause of what happened. And the performance indicators are further investigated to discover why they got better, why things got better, why things got worse, and so on. And there are various steps in the diagnostic analytics. The first step being the identification of anomalies in the data. And the anomalies may be the unexpected changes in a metric or a particular market. The second step in the diagnostic analytics is the collection of relevant data. Collection of relevant or related data. This is data that is related to the anomalies. Okay? So first of all, I've said the first step in the diagnostic analytics is to identify anomalies in the data. Then number two, data that is related to the anomalies is collected. Identify anomalies in the data, then collect data related to the anomalies in the data. Then after that, statistical techniques are used to find relationships, to find trends that explain the anomalies. That is diagnostic analytics. I repeat, identify anomalies, step number one. Step number two, collect data related to the anomalies. Then number three, use statistical techniques to find relationships, to find trends that explain the anomalies or the cause of the anomalies. Let me put that down. One, identify anomalies in the data. Two, collect data related to anomalies. Three, use techniques to do what? To identify the, or to find relationships, to find trends that explain the anomalies. Use mathematical or statistical techniques to find relationships and trends in the anomalies. The third type of data analytics is predictive analytics. Predictive analytics, on the other hand, helps answer the question, what will happen in the future? Predictive analytics helps answer the question, what will happen in the future? And the techniques, the techniques here use historical data to identify trends, then determine if they are likely to recur. The predictive analytical tools provide valuable insight into what may happen in the future, and its techniques include a variety of statistical as well as the machine learning techniques, such as the neural networks, the decision trees, the regression, and so on. So based on historical data, the predictive analytical tools can help the firm answer the question, what will happen in the future, by looking at trends in the historical data, the past performance. Predictive analytics, from the word predict. These tools may help a company to answer the question, what will happen in the future. Tools such as regression, machine learning, and so on. Do you understand? Yeah, that is pretty clear. Predictive analytics. Then the last type of data analytics is prescriptive analytics. Prescriptive analytics helps answer the questions about what should be done. What should be done? What should be done? Prescriptive analysis. Prescriptive analysis helps answer the questions about what should be done. What should be done. And by using insights from the predictive analytics, data-driven decisions can be made. Data-driven decisions can be made based on predictive analytics. Data-driven decisions can be made, and that allows businesses to make informed decisions in face of uncertainty. And candidates, prescriptive analytics techniques rely on machine learning strategies that can find patterns in large data sets. Patterns in large data sets. And by analyzing past decisions, by analyzing past events, the likelihood of different outcomes can be estimated. All right? Prescriptive analytics help answer the question, what should be done? This type of data analytics provide insights about insights that businesses need to make effective and efficient decisions. They provide insight that businesses need to make effective and efficient decisions. So these are 4 types of data analytics. We've said data analytics is a broad field. We've briefly described 4 types of data analytics. The first one being descriptive analytics, which we've said answers the question, what happened? Diagnostic analytics answers the question, why things happened. Number 3, predictive analytics answers the question, what will happen in the future. And lastly, prescriptive analytics helps answer the question, what should be done about what should be done by using insights from predictive analytics. We've said also that data-driven decisions can be made. Data-driven decisions, because the decisions are based on past data, on past big data. So these are 4 types of data analytics: descriptive analytics, diagnostic analytics, predictive analytics, prescriptive analytics. Here is your today's assignment. Explain 4 types of data analytics, and when doing the assignment, make sure your notes, you don't make reference to notes, you don't make reference to videos. Try and see if you can recall what you have learned from your memory. Thank you. Bye bye. Greetings, candidates, and welcome back to the Advanced Financial Management class. Today we continue with the topic mergers and acquisitions. So far we've studied the nature of mergers and acquisitions. We discussed the arguments for and against the use of mergers. We went ahead to highlight some of the evaluation models, the defense tactics against hostile takeovers. Today we move on to the next subtopic, which is financing of mergers and acquisitions. Now, after the evaluation of a target, the company has to figure out which method to use to finance the acquisition. And there are various ways the company can choose to do what we call outright purchase using cash. There could be share for share exchange, share debenture exchange, and share preference exchange. In this lesson, we're going to discuss the various methods that can be used in financing mergers and acquisitions. And the first method is outright purchase using cash. Outright purchase using cash. The second method is share for share exchange. Number 3, we have the share debenture exchange. Share debenture exchange. 4 is the share preference exchange. Outright purchase using cash, number 1. Number 2, share to share exchange. Number 3, share debenture exchange. Number 4, share preference exchange. In this lesson, we're going to highlight the advantages and disadvantages of these methods. We're going to also discuss how the methods can be used. First of all, let's begin with the share purchase using outright cash. Share purchase using outright cash. After valuation of a target, the acquirer may decide to pay or to purchase the target using cash. So when discussing the financing of mergers and acquisitions, an outright purchase using cash refers to the straightforward transaction where the acquiring company pays for the target company entirely with cash. Entirely with cash. If the agreement is, say, 100 million, the acquirer pays the 100 million transaction in cash. Straightforward. Do you understand? So the target company shareholders receive immediate cash. They receive immediate cash payment for the shares. They receive immediate cash for their shares. So shareholders of the target company receive immediate cash for their shares. They receive immediate cash for their shares. So that is one feature of outright purchase using cash. It is a very simplified transaction compared to other financing methods like stock swaps or cash acquisitions. And cash acquisitions tend to be simpler compared to share, compared to share debenture exchange, compared to share preference exchange. This one is simpler. It is a simpler transaction. It's like going to a yard and just paying for a car, or going to a market and you pay for a commodity. It is simple. You pay the seller and the transaction ends there. There are very few complexities related to valuations and potential fluctuations in stock prices. Another aspect here is control and ownership. Control and ownership. The acquiring company gains full control full and immediate control of the target company. And there is no dilution of ownership. There is no dilution of ownership for the acquiring companies, existing shareholders. Control and ownership is immediate. Financial resources. This method requires financial resources for the target company to effect this transaction. For the acquirer to effect this transaction, then the acquirer has to have financial resources. Financial resources. The method requires the acquiring company to have substantial cash reserves, or the company should have the ability to raise significant capital. You understand? So this method comes with the advantages, what we call pros, and disadvantages, what we are calling cons. Now, the first advantage of financing of mergers and acquisitions using outright purchase using cash, is certainty for the seller. Certainty. Certainty is an advantage for the seller. The target company shareholders receive immediate and guaranteed payment. Immediate and guaranteed payment, which then eliminates uncertainties associated with stock fluctuations. There is that element of certainty. Simplicity, speed and simplicity is another advantage. Speed and simplicity. Here we say that is a simple transaction. Cash transactions tend to be quicker and less complex than those involving stock exchanges, like the share-to-share exchange, the share debenture exchange, and so on. Simple and quick. Speed and simplicity. Clear valuation. Clear valuations. Now, how is clear valuation an advantage associated with the outright purchase using cash? Now, the price is clearly defined. Before the payment is done, the price is clearly defined. Clearly defined, which reduces then valuation disputes. Clear valuations reduces valuation disputes. Maintains control. Is also an advantage associated with control. Control. The acquiring company retains full ownership and avoids diluting its existing shareholding or its existing shareholders' equity. Another advantage is positive market perception. Positive market perception. Positive market perception. How is positive market perception an advantage? Positive market perception. How is it an advantage? Now, candidates' cash deals can often signal financial strength to the market. When the market hears that company A has acquired company B with an outright purchase using cash, then it sends a signal, an indicator that company A is doing well, and investors would want to be associated with companies that have strong financial muscle. So these are 5 advantages, but you also have disadvantages. There are some disadvantages that are associated with the financing of mergers using outright cash. One is financial strain. It can lead to financial strain, particularly where the target is overvalued. Large cash outlays can deplete the acquiring company's financial reserves, which then potentially hinders future investments or operations. Opportunity cost. opportunity costs. Using cash for acquiring a company means that those funds are unavailable for other potential uses, such as research and development, such as expansion, and so on. Funding requirements, number 3. Funding requirements. If the acquiring company lacks significant cash, it may need to borrow. It may need to do what? To borrow. It may need to increase debt. Then that leads to what we call debt load. And debt load, we know, is associated with the interest expenses, which are fixed. That is a disadvantage. The company lacks money from its internal sources, then the acquiring company may be forced to borrow, and that increases its debt load, and it increases the interest charges that are associated with debt. Funding requirements. There could also be tax implications. Tax implications. For the seller candidates receiving cash creates an immediate taxable event. Okay, there is an immediate taxable event, and that could lead to capital gains taxes, which will be due to the seller. So that is all we can say about outright purchase using cash when financing mergers and acquisitions. So this is the first method. Now the second method is share-to-share exchange. Share-to-share exchange. B, share-to-share exchange. Share-to-share exchange. Share-for-share exchange is another method that a company may use to finance mergers and acquisitions. Now, when discussing the financing of mergers and acquisitions, a share-for-share exchange is a crucial method to understand before settling on which method to use. Companies have to consider the share-for-share exchange method. And in essence, share-for-share exchange is a transaction where the acquiring company offers its own shares to the shareholders of the target company in exchange for their existing shares. Share-for-share exchange. It's self-explanatory, is it not? The acquiring company offers its own shares to the shareholders of the target company in exchange for their existing shares. So if company A is acquiring company B, so this is the acquirer and this is the target, the predator. This company has shareholders, this company has shareholders. This company is buying company B. This company B is owned by existing shareholders. So instead of paying the existing shareholders cash, as we saw in the first case, this company can offer its own shares to company B. because once company B is acquired, this company ceases to exist. So instead of these shareholders being granted or given cash, they become shareholders of company A by virtue of the shareholding that they receive in exchange to their existing shares. So they have to relinquish their own shares in company B, and for them to relinquish these shares in company B, they are given company A shares. The acquiring company offers its own shares to the shareholders of the target company, and that is in exchange for their existing shares. So they are not given cash, they are given shares of company A, the acquirer. And that means that instead of receiving cash, the target company's shareholders become shareholders of the acquiring company, to put it differently. And a critical element here is the exchange ratio. Okay, there has to be a ratio. A critical element in share for share exchange is the exchange ratio, which determines the target company. You understand? The exchange ratio, which we will be learning how to calculate later on, but you have to get that understanding. You need to understand what is a share for share exchange. Now, one of the key features of share to share exchange is that it is equity based. This method is equity based. We are talking about share to share exchange. It is equity based. It's based on equity. The method primarily involves the exchange of equity rather than the exchange of cash or debt. Another feature associated with what is dilution. Another feature associated with the exchange, the share to share exchange, is dilution. Now, the acquiring company issues new shares, which then dilutes the ownership percentage of its existing shareholders. If, for example, there were only 10 shareholders, when new shareholders are introduced, say 20 shareholders are introduced, then there is dilution of shares. There is dilution. The existing company, after issuing new shares, dilutes the ownership percentage of its existing shareholders. So these ones were holding equally, say equal, maybe each is a tenth of the shareholding. When you have 20, they will no longer be controlling, each shareholder will no longer be controlling 10%. The percentage will be diluted by virtue of having many shareholders in the company. Dilution. Another feature associated with the share to share exchange is the aspect of valuation. Valuation. Accurate valuation of both companies is essential in order to determine a fair exchange ratio. The companies must be properly valued in order to have a fair exchange ratio. There could also be tax implications. In some jurisdictions, this type of exchange can be structured to be tax deferred, which can be a significant advantage. Now, why would a company then prefer share-to-share exchange and not outright cash or share to debenture exchange. Why do we have some companies preferring share to share exchange? That is a question that we may want to answer. Companies use share to share exchange in mergers and acquisitions for various strategic reasons. And the reasons are structured around financial flexibility. They are structured around alignment of interests and also tax advantages. One reason is to conserve cash. Companies would prefer share to share exchange as opposed to outright purchases in cash in order to conserve cash. That is the primary reason. The primary reason a company will opt for share to share exchange is to conserve cash. Instead of paying cash for the target company, the acquiring company offers its own stock. And that is especially important for companies that want to preserve their financial resources. So that instead of paying the target company, that money can be invested. That's one reason. Another reason is associated with large acquisitions. Large acquisitions, another reason. Now, large acquisitions, a cash purchase might be prohibitively expensive, which makes share for share exchange a more viable option if you have a large acquisition. If the target company, if the acquirer is to pay large sums of money to the target, the only viable solution will be share to share exchange. Yet another reason is aligning of interests. Aligning of interests. Aligning of interests. Now, when the target company shareholders, for example, receive shares in the acquiring company, they become shareholders in the combined entity. And that aligns their interests with the acquiring company's interests, which then encourages them to support the integration process. You understand? Yes. Because they are now part of the ownership of the acquiring company. To align the interests of both the target company and the acquiring company, the share to share exchange method is preferred. Tax advantages. Now, candidates, in some jurisdictions, a share for share exchange can be structured as a tax deferred transaction. It can be structured as a tax deferred transaction, which means that the target company's shareholders do not have to pay capital gains taxes until they eventually sell the shares of the acquiring company. Deferred. That's why I refer to it as deferred. It is a tax deferred transaction. Tax deferred transaction. Because it is a share to share exchange, the shareholders of the target, as opposed to the cash method, they are not required, may not be required to pay capital tax gains after selling off the company. They may be required to to pay tax gains after selling the shares that they receive from the acquiring company. So that is another reason. There are no capital gains taxes that are paid when this transaction is being carried out. And that is a tax advantage. That tax advantage is attractive to the shareholders. It makes the deal more attractive to the target company's shareholders because it allows them to defer paying taxes on their gains. They gain by joining the acquiring company without making any taxes, without paying taxes. So that's an advantage. That is a reason. Reason one is conservation of cash. Number two, we've said it aligns the interests of the shareholders. Number three, we've seen it has tax advantages. Number four, the fourth reason why share-to-share exchange is attractive is flexibility in negotiations. There is flexibility in negotiations. Offering shares can be a flexible transaction tool, allowing companies to structure deals that meet the needs of both parties. Because using shares can help when there are disagreements on valuations. If there are any disagreements on valuations of both the companies, the disagreements can be resolved when financing using share-to-share exchange method. You understand? It allows for flexibility in negotiations because the target company shareholders are not being paid off and they go away. No, they still become part of the new entity. They become part of the shareholders, the owners of the acquiring company. So it becomes very easy to negotiate or to iron out any disagreement that may arise during valuation. Understand? There is also another reason. It maintains financial stability. Financial stability is maintained. You understand? Share for share exchange prevent the acquiring company from having to take on large amounts of debt. So these are the advantages. These are the reasons why share to share exchange is preferred or may be preferred. But does that not mean that this method does not have disadvantages? There are also some disadvantages that are associated with or challenges that are associated with the method. So what are the disadvantages? Now the first challenge of share-to-share exchange method is dilution of ownership. Dilution. It's obvious. Dilution of ownership. Issuing new shares dilutes the ownership stake of the acquiring company's existing shareholders. That is obvious. There could also be valuation challenges. 2, valuation challenges. Valuation challenges. Determining a fair exchange ratio can be complex and contentious because it requires accurate valuations of both companies. And there could also be fluctuations in stock prices which can further complicate the process. Market volatility is another disadvantage. Market volatility. The value of the shares received by the target company's shareholders can fluctuate, which creates uncertainty and potential losses. Complexity. is a challenge? How is complexity a challenge? Share for share exchange can be a complex transaction which requires careful legal and financial planning. There is dependence again on stock performance. E, dependence on stock performance. Dependence on stock performance. The value of the deal is tied to the performance of the acquiring company's stock. And if the stock performs poorly, then the deal becomes less valuable to the shareholders of the target company. So candidates, that's all we can say about the share to share exchange. We highlighted the features, the advantages and the disadvantages. Let's move on to the fourth or the third method. The third method, that is C. Share debenture exchange. Share debenture exchange is yet another method that can be used in financing mergers and acquisitions. Now, a share debenture exchange refers to a financial transaction often occurring during mergers and acquisitions where a company offers a combination of its own shares and debentures to the existing shareholders of another company. And at this stage in your professional journey, I know you have you fully grasp the meaning of a share. Shares, we know, represent ownership in a company. When you hold shares, you own a portion of that company. So shareholders may receive dividends, which is a portion of the company's profits, and may have voting rights. That is the meaning of share. A debenture, on the other hand, these are debt instruments. They are essentially loans that are issued by a company. And debenture holders are creditors and not owners, like the shareholders. They are not owners, they are creditors to the company. And they receive fixed interest payments. Debentures, something to note again here, are essentially unsecured. They are typically unsecured, meaning that they are not backed by specific assets. And therefore, a share debenture exchange involves providing the target company shareholders with a mix of ownership and debt in acquiring the company. In the acquiring company, that is. So the existing shareholders of the target, after the deal, they are given a mix of ownership and debt in the existing acquiring company. You understand? The share debenture exchange, I repeat, involves providing target company shareholders with a mix of ownership, which is represented by shares, and debt, which is represented by debentures in the acquiring company. And this strategy, candidates can be particular. it offers a blend of potential for capital appreciation through shares and stable income stream through debentures. You understand? By having a mix of shares and debentures in the acquiring company, the shareholders of the target company can enjoy the benefits that come with capital appreciation, but they also enjoy some level of fixed interest payments because of the debentures. So the question we need to ask, why companies use this method? We know companies use share debenture exchange for various strategic reasons. And one main reason is to offer a more appealing and flexible deal structure. So one reason or advantage is to attract a wide range of investors. Attract wide range of investors. To attract a large or wide range of investors. This method appeals to investors with varying risk appetites, because we've seen that debentures offer a stable income stream through interest payments, while shares provide the potential for capital appreciation. So you may have investors who are looking for both capital appreciation and the potential for the fixed interest payments. Flexible financing. It is a flexible financing method. There is flexibility. The share debenture exchange allows for a greater flexibility in structuring the mergers and acquisition transaction, because companies can tailor the mix of shares and debentures to meet the specific needs of the target company's shareholders. 3, there is a reason in relation to the lowering of interest costs. Lowering interest costs. Often candidates, the debentures offered are convertible. The debentures that are offered to the shareholders of the target company are convertible debentures, meaning that after some time, the debentures are converted into shares. They can be exchanged for shares at a later date. That's the meaning of convertible debentures. The debentures that are mostly used in these transactions are convertible debentures. And this conversion feature can make debentures more attractive to investors, which allows the acquiring company lower interest rates. Deferred equity dilution. Deferred equity dilution. Deferred equity dilution. What does that mean? Now, the equity dilution from issuing new shares occurs only upon conversion of the debentures. So if debentures are converted after 10 years into shares, then the dilution is deferred. Dilution can only happen after 10 years. That's an advantage. Deferred equity dilution. And that allows the acquiring company to manage the dilution over time. Next, bridging valuation gap. Another reason why this method is attractive is the aspect of bridging valuation gaps. In situations where, for example, there is a disagreement there could be a disagreement on the valuation of the target company. But you see, this method is offering a mix of shares and debentures which can serve as a compromise. Number 6 is provides income and growth potential. Provides income and growth potential. This method provides income and growth potential. Income and growth potential, and is more appealing to investors. So this aspect provides income via the debentures and growth potential via the shares, or the conversion of the debentures into shares. So a share to debenture exchange comes with the advantages. 1, attracts wide range of investors. Number 2 is flexible financing. Number 4 is lowest interest cost. There is the deferred equity dilution. It bridges valuation gaps. It also provides income and growth potential. There is potential for income through the debenture interest payments, and potential for growth through the shares that are offered to the shareholders of the target company. All right. Now let's move on to the last method, which is the share preference. The share preference. The share preference share exchange. Share preference share exchange. The share, this is the ordinary share, this is the preference share. The share preference share exchange. The share preference share exchange. Now, share preference share exchange, context of mergers and acquisitions. In the context of mergers and acquisition, the share preference share exchange, what does that mean? What does it mean? Or what does it involve? This one currently involves offering preference shares of the acquiring company to the shareholders of the target company in exchange of the existing shares. So the acquiring company offers its preference shares to the target company shareholders in exchange for their common shares in the target company. And this exchange provides the target company shareholders with a more stable and predictable income stream, because we know preference shares the preference shareholders are paid fixed dividends. All right. And if the preference shares are convertible, there is also the ability to convert the preference shares at a later date into common shares of the acquiring company. And there are very many reasons why companies also prefer preference share exchange. Companies use the share preference share exchange in mergers and acquisitions for various strategic reasons. And the main reason is to appeal to specific investor preferences, and to achieve certain financial objectives. One reason is to attract conservative investors. One reason is to attract conservative investors. Now, preference shares offer a fixed dividend, providing a predictable income stream, and this is attractive to investors who prioritize stability over high growth potential, such as retirees or risk-averse individuals. It may also reduce risk. Preference shares have a higher claim. The preference shareholders have a higher claim on dividends and assets in liquidation than common shareholders. So reduces risk, to reduce risk to the investors of the target company. It may also facilitate M&A deal or transaction. Understand? Offering preference shares can make the M&A transaction more appealing to target company shareholders who are maybe hesitant about the volatility of the common stock, or who desire a more stable income. There's the aspect again of bridging valuation gaps. Bridging valuation gaps, which I explained earlier. This method can help bridge valuation gaps. Right? Bridging valuation gaps. Another point is related to capital restructuring. Capital restructuring. This method can be very essential in capital restructuring, adjusting capital structure. A company may use share preference, share exchange to adjust its capital structure, potentially reducing the number of outstanding common shares or even altering its dividend obligations. There could also be tax considerations, as explained earlier. Tax considerations. Depending on the jurisdiction, there may be tax advantages associated with the preference shares that make them attractive to certain M&A scenarios. So there are many reasons, candidates, why preference share exchange may be preferred in mergers and acquisitions. So in this lesson, we've discussed the 4 methods. One is outright purchase using cash. These are methods in financing mergers and acquisitions. The second one is share to share exchange. The third one is share debenture exchange. And lastly, we've discussed share preference share exchange. Thank you for attending the lesson. We continue to learn more about mergers and acquisition in our next session. Bye-bye.
Hello class, welcome to lesson number 4 of topic number 5, share capital. So in this 4th lesson, I want to talk about the purchase of own shares, by a company. Then I will also talk about dividends, the dividend law in respect to companies. So let me begin on the first of those items where we are talking about by purchase of own shares, purchase of own shares by a company, purchase of own shares by a company, where we are asking ourselves the question, can a company purchase its own shares? Or could a company, by extension, finance the purchase of its own shares? Now, we notice that there is a direct prohibition against companies purchasing their own shares or financing the purchase of their own shares. At common law, this is the rule in Trevor versus Whitworth, the rule in Trevor versus Whitworth, where the direction of the court is that a company must not purchase its own shares. A company must not purchase its own shares. Now, this is consistent with the rules that relate to the company's maintenance of its own capital. That the company's capital is the creditor's fund of last resort, and as such should be maintained. And all those matters, all those transactions of the company that go towards threatening the company's share capital, transactions such as reduction of share capital, transactions such as the company's purchasing its own share capital, all these are extremely regulated transactions by law in a bid to ensure the company's share capital remains fixed and known, remains unreduced, that there are measures that have been taken to ensure that the company does not waste its own capital. Now, despite this direction that a company must not purchase its own shares, the Companies Act gives us some special exemptions under which a company may be purchasing its own shares. So these exceptions include exceptions to the rule, that is exceptions to the rule in Trevor versus Whitworth. These exceptions introduce us to circumstances where a company may purchase its own shares. Now, one of those circumstances is during a redemption of redeemable preference shares. During the redemption of redeemable preference shares. This is if allowed by the articles, and all rules relating to redemption of redeemable preference shares have been followed. Rules that we have discussed earlier, such as the shares being fully paid, the shares being redeemed either out of the proceeds of a new issue, or if no fresh issue has been issued by the company redeeming them out of reserves and creating the share redemption reserve fund. We could also have a company purchasing its own shares in case of a valid surrender of shares by a member. This is a rare case, but very much possible, particularly where a shareholder holds partly paid shares, that the shares held by this member are partly paid. The fact that they are partly paid, they present a further obligation on that member to make payments for the balance, for the unpaid part of those shares. In the case this member is unable to make these further payments, in the event that this member is not able to discharge this liability, this obligation to pay for the balance outstanding on their shares, then they can surrender such shares to the company. This surrender, in a way, is to absolve them from that liability to pay for the outstanding amounts on their shares. The other possible circumstance under law where a company would be purchasing its own shares would be following a court order for protection or for the purposes of protecting minorities. Where we have circumstances in the company, imagine circumstances such as a variation of class rights that is proposed and even voted accordingly, but we have some minorities who are contesting the variation of class rights on the basis that it is prejudicial to their own interests. We may have a court order directing that the interest of these shareholders minorities actually, these protesting or these objecting minorities be absorbed by the company. In such an incident, the court could be directing the company to purchase the interest of these minorities, which the resulting transaction would be a company purchasing its own shares. So class, in these exceptional cases, they are presenting us to a scenario where we are going against the directions given by the rule in Trevor versus Whitworth, where the direction is a company must not purchase its own shares. However, we are saying in these exceptional circumstances, we can have a company purchasing its own shares. Now, by extension, we are also saying that a company must not finance or provide a guarantee, must not finance or provide a guarantee for the purchase, must not finance or provide a guarantee for the purchase of its shares, must not finance or provide a guarantee for the purchase of its own shares on the basis, on the same premise that we were not to purchase our own shares for purposes of capital maintenance requirements. However, we are also finding ourselves running into exceptions to this rule, that we have exceptional circumstances where a company may finance the acquisition of its own shares. Now, these exceptions include where providing finance or guarantee is part of the ordinary business of the company. So this could be a company in the financial sector where part of their business is the provision of financial assistance, that they're in the business of giving loans. So a loan has been obtained by a customer in the normal circumstances under which normal loans would be borrowed, where such customer also proceeds on to purchase the shares of this company with the proceeds advanced by the company. Then we have a situation, an exceptional circumstance, where a company has financed the purchase of its own shares. The other exceptional case would be where the company has a scheme, to advance, money or funds to trustees, to a trustee or trustees to acquire shares for the benefit of its employees, Now, this exception presents us with a situation where this company has set up a trust fund or has set up a trust for the benefit of the members. And this trust, part of the things it does is investments for the purposes of the members. Remember, these investments could be through the purchase of shares, securities in companies. So we are saying funds have been advanced to the trustees by this company, where the trustees invest for the purposes of the members' welfare. These trustees could proceed on to use these funds in buying the shares of this company, advancing the funds. Now that presents us with an exceptional circumstance where the company is seen advancing funds, which funds are subsequently applied in the purchase of its own shares. Then finally, we have an exception where the company has a scheme. The company has a scheme to advance funds to employees. This is with an exception of directors, except directors to purchase shares in the company, for beneficial ownership. So company law recognizes that companies could have a scheme an arrangement within the company that they advance funds, they advance money to the employees of the company, with an exception of directors. Directors are excluded from this fund. They are excluded from this scheme, this arrangement of advancing money to employees to purchase shares of the company for beneficial ownership. This scheme is to make the employees of the company feel part of the company, where they have been advanced money for the purposes of owning a stock in the company that they work for. So this is the idea of purchasing of own shares by the company, that it is generally prohibited in the interest of protecting the company's capital. However, we have seen ourselves running into exceptional circumstances where companies can directly purchase their own shares. We have also seen circumstances where companies are allowed by law to finance the purchase of their own shares. Let me now look at dividends. Dividends. We are describing a dividend to be a member's return. This is a member's return for their investment. A member's return for their investment in the company. A member's return for their investment in the company. It is also seen as a share of the company's profit, a share of the company's profit that is paid to the members. The share of the company's profit that is paid out to the members. Now, the Companies Act presents us with certain rules relating to the payment of dividends to members, relating to the sharing of profits or paying of this return to the members. Rules of paying dividend. Rules of paying dividend. Now, as part of this continuing story of maintaining the company's capital, one of the paramount rules relating to the payment of dividend is that dividends can only be paid out of profits. Dividend can only be paid. Dividend can only be paid out of profit. Dividend can only be paid out of profit. That unless a company has realized a profit, then this company cannot pay dividend. And by the way, inherently, companies are not under obligation to pay a dividend. It is financial year end, we have made profits. The company is not under obligation to pay dividend to the members. But we are saying, should we be paying dividends? Dividends must always be paid out of profit. It is unlawful. It shall be wrong. It shall be against the law to pay dividends where the company is not making profits. It shall be seen as paying dividends out of capital. Now, what will be considered profits? The company has what we call the realized profit of the company. Now, from the company's realized profit, it may create some part of this realized profit as the profits available for distribution as dividend. Now, in arriving at the company's realized profit, it could be considering any gains. We talk about realized gains. Any realized gains from revaluations. Any realized gains from revaluations of assets can also be considered as the company's realized profits in this year, including the exclusion or the deduction of any realized losses from revaluation of assets that this company has done during this year can be excluded from the company's annual realized profit that year. So from the company's realized profit, the directors will designate part of the company's realized profit as profit available for payment of dividend. Profit available for payment of dividend. The other rule is that dividend is recommended. Dividend is recommended by the board. Dividend is recommended by the board of directors. Dividend is recommended by the board of directors. These are the persons charged with the day-to-day management of the company. So they are best placed to know how much this company can afford to pay as dividends. So it shall be their responsibility to recommend how much dividend is to be paid. Still relating to the payment, we are saying that dividend is approved. Dividend is approved by members. Dividend is approved by members at a general meeting. Dividend is approved by members at a general meeting. Now, this meeting could be the company's AGM, at which dividend is usually approved by the members. So the directors have recommended a dividend, then we have a meeting of members where that dividend is approved. Relating to the approval, we are noting another rule that the members cannot recommend. The members cannot, let me withdraw the word recommend and replace it with the word approve. The members cannot approve a dividend above the rate, cannot approve a dividend above the rate recommended, above the rate recommended by the board. Above the rate recommended by the board. So the board's recommendation on what dividend is payable shall be final. That in the GM's, the general meeting's approval, they cannot approve an amount beyond that which is recommended by the board. We are also noting that the company cannot pay dividend. The company cannot pay dividend if such payment will result to inability to meet its financial obligations. A company will not pay dividends to be unable to pay its salary to employees. A company will not pay dividends to be unable to pay rentals. A company will not be paying dividends to be unable to pay such expenses as are necessary for the running of this company. Now, once a dividend has been declared, something also happens that declared dividends, let's add the approval, declared and approved dividends, shall not bear interest against the company if there is a delay, if there is a delay in payment. That the board has recommended a certain rate of dividend, which has subsequently been approved by the members at a general meeting. Now, the usual practice is that once the dividend has been declared and approved, within 42 days of such approval, the dividend should be payable. If there is any delay in payment of such dividend, the suffering members shall not claim interest against the company for delay in paying them the dividends due. The other rule still relating to payment of dividends is that the company may deduct any amounts the company may deduct any amount owed to it by a member from the dividend payable. That the company can deduct any amounts that they are claiming from a member from the total amount they are to pay them as dividend. For instance, imagine a case where we have borrowed some money from our company and we have been unable to pay them. We have not repaid such borrowed amounts of money. So this company has some claim against us. So this rule is empowering them to deduct such amounts that they are claiming from any dividend that is payable to us after the declaration of the dividend. Now, from these rules, we can start imagining a procedure that companies follow in the payment of dividend. What procedures do we follow when we are paying dividend as a company? We will begin from a board meeting being held to recommend a dividend. After a board meeting has been held to recommend a dividend, the company will prepare and update the company's register of members, because it is on the basis of the register that this dividend is payable. Then we shall proceed on to convene a meeting of members where this dividend payment is to be approved. So once the dividend has been approved, then we have a preparation and closure of the register of members so that we have no more additions to the register after the approval of the dividend. Then the company can proceed on now to prepare the dividend warrants, which are to be counter-checked against the company's register of members. Then checks can be prepared and sent to members in respect of the dividend payable to them. So class, that brings us to the end of our lesson number 4. If we can recap what we have looked at so far, we have looked at the purchase of own shares by a company, where expressly such purchase has been prohibited, including the financing of the purchase of the company's own shares. But we have also looked at exceptional circumstances where such purchase can be done and the financing for the purchase can also be done. We have also looked at dividend, what it is. We have looked at the rules relating to payment of dividend, and we have also made a mention of the procedure to be followed by companies when paying dividends. I now want to send you to the revision partner questions, just to show you some of the questions that we have had from this particular topic. We have a question here asking candidates to advise shareholders on the distinction between nominal capital and reserve capital. We have a question asking candidates to explain 5 ways in which a company might alter its share capital. We have also a question here asking candidates to discuss the actions and omissions that are considered to contribute to criminal behavior in relation to preparation and issuing of prospectuses. So there are many questions here that I would wish to refer you to help you in the revision of the content in this topic. Thank you.
Hi candidates, welcome to another session of Manifested Online Classes. In this session, I want us to look on an illustration question regarding how to prepare the group accounts, whereby we have a disposal of interest. And the illustration I want us to go through reads, Pareto Limited is a holding company of a listed group of companies with its year ended on 30th of June 2021. So Pareto Limited has made a number of acquisition and a disposal of investment. So the following summarized draft statement of financial position relate to the group companies for the year which ended 30th of June 2021. So we are given the statement of financial position for 3 companies, Pareto, Paba and also Dafu Limited. Non-current assets include property, plant and equipment. Then we have investment in Paba, investment in Dafu. We have financial assets, and then we have the current assets. We have the total assets. At the equity, we have ordinary share capital, share premium, retained earnings, and then we have non-current liabilities and current liabilities. Then we have some additional information. Number one, where we are told on 1st of October 2020, Pareto Limited acquired an 80% equity interest in Paba Limited when its retained earnings stood at 3,500 million. The purchase consideration comprised of 1,250 million of Pareto Limited shares with a nominal value of shillings 1 each and a market price of 6.8 each. At the acquisition of Paba Limited, the only adjustment required for to the identifiable net asset of Paba was for land which had a carrying amount of 625 million, less than its fair value. So number two, we are told the group policy is to measure non-controlling interest at fair value. That information definitely is to guide you how to compute the goodwill. If you come across that information that the group policy is to measure NCI at fair value, it means that when computing the goodwill, we then compute that goodwill using the full goodwill method. And then you're told at the date of acquisition of Paba Limited, the non-controlling interest had a fair value of 21.25 million. Number three, Pareto Limited had acquired 100% equity interest in Dafu a number of years ago when it retained earnings amounted to 1750 million. At acquisition, the fair value of identifiable net asset of Dafu approximated their carrying values. The purchase consideration comprised cash amounting to shillings 5750 million. Number four, you're told Pareto Limited disposed of 60% of its investment in Dafu on 1st of April 2021 for shillings 4,700 million, when the fair value of identifiable net asset of Dafu were shillings 6250 million. The fair value of the remaining 40% equity interest was 4,300 million at disposal. Pareto Limited has not accounted for the disposal. And then number five, you're told none of the companies had issued any shares since Pareto Limited acquired its shareholding in them. And number six, you are told neither the goodwill on acquisition of subsidiaries nor investment in associate, that is, had been impaired. So from that information, what you're required to do, number one, is we compute the goodwill arising on acquisition of the investment in the subsidiaries. Number two, to compute the gain or loss arising on disposal of the investment in Dafu as reported, Roman 1, the individual financial statement of Pareto, Roman 2, consolidated statement of profit or loss, and finally part C of that question we are required to prepare the consolidated statement of financial position as at 30th of June 2021. So these are questions for group account, and as usual what we need to do first of all is to come up with a group structure. Then we go through the additional information, we see whether there are workings which we need to do, and then from there we prepare, or basically we compute what is required. So therefore, let's first of all we come up with the group structure here, which will be working one, group structure. A group structure. So where do we get that particular information about the group structure? So that information, we have it from the additional information number one, whereby we are told on 1st of October 2020, Pareto Limited acquired 80% equity interest in the company which is called Paba Limited on 1st of October 2020. 1st of October 2020, and also we are given the retained earnings of Paba on that date. That one will be used in the computation of goodwill, including the purchase consideration. That one will be used in the computation of goodwill. But let first of all we go to the additional information number 3, whereby we are told Paba Limited, not Paba but rather Pareto Limited had acquired 100% equity interest in the company which is called Dafu Limited a number of years ago. So in this case, we are not given the specific date of acquisition, but we are told Pareto Limited had acquired 100% shareholding in Dafu sometime back, or basically a number of years ago. So basically what that means is that from this group structure here, Pareto Limited, this will be the parent company, and automatically the parent company is the one which is supposed to prepare the group account. Then PABA is a subsidiary, and also Dafu here is a fully owned subsidiary, a fully owned. Fully owned means that the parent company acquired all the shares or hold all the shares in that particular subsidiary. So we have that information, but also before we go maybe back to note number 1, there is another information which is given and which is very, very important in note number 4, sorry, where we are told Pareto Limited disposed of 60% of its investment in Dafu on 1st of April 2021. So that is information about disposal of interest. Disposal of interest. Disposal of interest, whereby we are told Pareto Limited disposed 60% shareholding in what? In Dafu. So we have disposal of interest in Dafu Limited. Dafu Limited. So, and automatically this particular disposal of interest, this usually take place during the current financial year. Now, first of all, if we go to the information we have at the paragraph 3 up there, so the current financial year was all ended on 31st of or that is June 2021. So basically what that means is that this year started on 1st of July 2020. But now if we go back to the information we have in note number 4, we are told Pareto Limited disposed 60% of its investment in Dafu during the current year. So that is the 1st of April 2021. 1st of April 2021. So how many months do we have here to the date of consolidation? We have April, May, June. So here we have 3 months, and automatically here we have what? 9 months. So what that means is that for the first 6 months, this particular company here, that is Dafu, this was a subsidiary, because you can see in the first 9 months, the parent company had 100% shareholding. But on this date, we are told the parent company disposed 60% of its shareholding in Dafu. So that what that means is that the parent company retained 40% shareholding in Dafu, and therefore Dafu in the last 3 months was an associate. And therefore, if for example in this particular question here, the examiner was requiring the candidate to prepare the consolidated income statement, is very, very important to note that this company here, that is Dafu, for the first 9 months you treat it as a subsidiary, meaning that you take into account its revenue and expenses for the first 9 months, for the first 9 months, and then you add that to the revenue and expenses of the parent and the revenue and expenses of what? Of PABA. But in the last 3 months, that is, Dafu Limited will be an associate, and therefore what you need to include in the consolidated income statement is the parent company share of Dafu Limited profit after tax in the last 3 months. And also in this case, because the parent company lost the control, you have to determine the gain or loss on disposal, which then you recognize in the income statement as part of the profit or loss. But in our case, if you check on what the examiner was requiring here, specifically in part C, we are only required to prepare the consolidated statement of profit, the consolidated statement of financial position. So what that means is that in preparing that, we check the status, we determine the status of Dafu at the end of the year. Dafu Limited at the end of the year will be an associate, and therefore in preparing the consolidated statement of financial position, we are going to add similar items of asset and liabilities, those of Pareto, the parent, and those of PABA, but we are not going to take into account the asset and liabilities of Darfur because it's an associate. So what we are going to do is we are going to determine something called the investment in associate, and basically that is the only item we are going to include in the consolidated statement of financial position as far as Darfur Limited is concerned. See, yes, that is why the group structure here is important. But before you do that, maybe you can just go through this additional information again. We see whether there are some workings which are required. Note number 1, we go back to note number 1. We are given information about the acquisition of PABA, and actually the retained earnings, the purchase consideration, all that will be used in the computation of goodwill, which you are required to compute as per part 1 of that question. And also we are told that at the date of acquisition, PABA Limited, or at the acquisition of PABA, the only adjustment required to the identifiable net asset of PABA was a LAD with a carrying value of 625 million less than the fair value. So basically what that means is that this company on the date of acquisition devalued the asset, and remember that process we refer to it as the fair value adjustment or the fair value exercise. So this is by PABA Limited, and the asset it revalued was LAD, and we are told that this LAD had a carrying amount of its carrying amount was 625 million less than the fair value. So in this case, the carrying amount was less than the fair value with an amount of 625 million. In other terms, we can say that the fair value, we start with the fair value, was greater or was more than the carrying amount with 625. So automatically, what is this? This is the revaluation gain. And this particular revaluation gain, which occurred on the date of acquisition, automatically was not accounted for by PABA. So therefore, in preparing the consolidated statement of financial position, this one we add it to the group PP, and number 2, this one we treat it as a pre-acquisition revaluation reserve, pre-acquisition revaluation reserve. In computing the goodwill on acquisition, that will be one of the component of the net worth asset of PABA Limited. So I think we have that particular information there. And then it is also important to note that this particular asset here, that is LAD, this is not a depreciable asset. LAD is not depreciated, and therefore in this case, no depreciation other charge. No depreciation other charge to be computed here, simply because LAD is not depreciable asset. But if this was a depreciable asset, we needed to compute the depreciation other charge. So let's move to, but we will still come back to that particular point, specifically in answering part A of that question when computing the goodwill. So in number 2 is about information regarding the computation of goodwill. We will still use that in answering part A. And then part additional information number 3, we are given information about the acquisition of Pareto, where we are told the parent company, that is the acquisition of Darfur, whereby we are told Pareto Limited had acquired 100% shareholding in Darfur some time back. We are given it retained earnings there, and also the fair value of identifiable assets, which we are told equaled to the year carrying amount. So mean that at the date of acquisition, this company revalued the asset, and the fair value of identifiable asset was equal to carrying amount. There was no revaluation gain or loss. And then you're given the purchase consideration, which was 5750. All that information, we're going to use it in answering part A, specifically in computing the goodwill. And then we're given information number 4 about the disposal of some disposal of interest in Darfur. And also this one, we're going to use it in answering part B of that particular question. And then we have note 5. Note 6. I think no working which is required here. So I think we can go straight to part A of that particular question. Part A of the question. So what we are required to do is to compute the goodwill arising on acquisition of of investment in subsidiaries. Investment in subsidiaries. So we start by computing the goodwill arising on acquisition of the first subsidiary here, that is PABA. So let's start by computing the goodwill arising on acquisition of investment in PABA Limited. PABA Limited. Equally, remember, as per the information which are given in note number 2, we are computing the goodwill using the full goodwill method. That's the first thing you need to appreciate, or basically to note. So how do we compute the goodwill using the full goodwill method? Number 1, we take the cost of investment. The cost of investment. So how much purchase consideration was paid by the parent company in acquiring the shares of PABA? So that information, we have it in the balance sheet or in the statement of financial position of Pareto, specifically under the non-current asset. We are given the amount of the amount invested by Pareto in PABA, which is 8,500. 8,500. So to this, then we add the NCI at fair value, because you're using the full goodwill method. So this figure is also given in note number 2. Additional information number 2, the last sentence, we are told at the date of acquisition of PABA, the non-controlling interest had a fair value of 21.25. So we add the 2. So this will give us 25, 10, 6, 10, 6. So let's confirm whether that is correct. So we have 85 plus 21.25, so which will give us 10,625. That is correct. So then from there we proceed and we less fair value of net assets, fair value of net assets acquired. So how do we compute this one? Because it's not given, so we have to determine the fair value of a net asset of PABA on the date it was acquired, and we determine that by taking the ordinary share capital of PABA plus pre-acquisition reserves. Pre-acquisition reserve. So therefore, where do we get this? Let's go back to the statement of financial position of PABA, specifically under equity. Under equity. So under equity, number 1, we are given the ordinary share capital of PABA. The ordinary share capital of PABA is a figure of 25. Still, in that case, we also have a share premium. Share premium of a subsidiary company, unless told otherwise, is always taken to be a pre-acquisition. Then the retained earnings, which we have there of 5250, that is at the end of the current year. That is not what we're interested with. We're interested with the retained earnings of PABA on the date it was acquired, and that is now what we refer as the pre-acquisition retained earnings. So that one is given in the additional information number 1, whereby we are told when PABA Limited was acquired, its retained earnings stood at 35. And then to this, other than taking now the items in the statement of financial position, specifically under equity, you also have to check whether this company revalued its asset on the date of acquisition. In case it revalued its asset, was there a revaluation gain or loss? So like in our case, remember here, PABA Limited revalued land with an amount of what? 625. This one we have said is a pre-acquisition revaluation reserve. A pre-acquisition revaluation reserve, which is 625. Yes, I think that's what we have. And basically what we need to do here, we get now the total. So we have 25 plus 1,000 plus 35 plus 625. So this will give us 7625. And because we are using the full goodwill method, we take 100% of this. 100% of this will be 62, that is 7625. We less it from the figure up there. We less it from 10,625, which will give us goodwill on acquisition of what? over 3,000. So that is the goodwill on acquisition. And remember that is a full goodwill. Basically the goodwill determined using the full goodwill the full goodwill method. So basically that is what is required there, and basically the items which are marked in such a case are those items which we have there. Then we need to proceed and compute the goodwill on acquisition of the other subsidiary, that is the full goodwill on acquisition of goodwill on acquisition of Darfur Limited. Darfur Limited. So we need to have two columns here, and even before you compute now the goodwill on acquisition of Darfur, it is very, very important for you to note that in Darfur there is no NCI here. There is no NCI because you can see that the parent company acquired all the shares, acquired 100% of the shares issued by what? By Darfur. So therefore in Darfur we don't have what? NCI. And that's why you can see, despite the group using the partial goodwill method, the full goodwill method in computation of goodwill, we are not given the NCI at fair value in Darfur, simply because there is no NCI. So therefore what we do here, we take the cost of investment, the purchase consideration paid by the parent company, that is Pareto, in acquiring shares of Darfur. That one is given in the statement of financial position of Pareto under the non-current asset, which is 750, and then in this case we should add the NCI at fair value, which you are saying is 0 because we don't have NCI. We don't have NCI. We get 5750, and then to this we proceed with less fair value of net assets acquired. Equally, to compute this, we take the ordinary share capital of Darfur plus pre-acquisition reserves plus the reserves it was having on the date it was acquired. So where do we get that? Let's first of all we go to the statement of financial position of Darfur, specifically at the equity section. So the ordinary share capital of Darfur is 2,000. Also Darfur had a share premium of 500, and then the retained earnings in the statement of financial position of Darfur 5750 is at the end of the current year, but that is not what we're interested with. We're interested with the retained earnings of Darfur on the date it was acquired, and that is given in the additional information number 3. Pareto Limited acquired 100% equity interest in Darfur a number of years ago when it retained earnings. Earnings stood at 1750, and also you check whether Darfur Limited revalued its assets. So basically, as per the information which are given in note number 3, this company revalued its asset, but you're told their fair value was the same with the carrying amount. There was no revaluation gain or loss. So what we do, we get the total here, and then we less that from the figure we have down there. So we have 2,000, which will give us 2,500 plus 1,750. So which will give us 4,250, and then we take 100% of this. 4,250. We less it from this figure minus 5750. 5750, which now will give us a goodwill of that, which will give us goodwill of 1,500. So basically that also what was required there, and automatically the items to be marked there include what we have there, that, and that. And basically by computing the goodwill on acquisition of the two subsidiaries, the marks allocated there were 4. So let's move to part B of that particular question. Part B, we are required to compute the gain or the loss on disposal of investment in Darfur Limited, Roman 1, as it was reported in the individual financial statement of Pareto, as it was reported in the individual financial statement of Pareto. Now, in this case, when Pareto Limited basically invests, or the parent company invests in a subsidiary, to the parent company, that investment in a subsidiary is like an asset. And therefore, once the parent company sells some of the shares, or basically all the shares in a subsidiary, the parent company in its individual financial statement, not in the group account, in its individual financial statement, it will need to recognize the gain or the loss on disposal. Now, that gain or loss on disposal is computed by taking the sales proceeds. The sales proceeds is basically the amount of money which was received by the parent company after selling some of the shares or all the shares in the subsidiary, minus the carrying amount of investment disposed. Investment disposed, or basically investment sold. And this one is very simple because all these figures are given. So let's go to the additional information number 4, and you're told Pareto Limited disposed 60% investment in Darfur on 1st of April 2021 for 4,700. So that 4,700 is the sales proceeds, the amount of money received. Yes, and then to this, what we know is that the amount of money which Pareto Limited had invested in Darfur is 5750, which is given in the balance sheet of Pareto. The amount invested in Darfur was 5750. In the statement of financial position of Pareto and current asset, the amount invested in Darfur 5750. But in our case, we know the parent company only disposed 60% of that. So that is the carrying amount of the investment sold. So that's how we compute the gain or loss to be recognized in the individual financial statement of Pareto. So this will give us what? 60%, 5750. We less that from 4,700. So this will give us 12 what? 1200. And basically that is a gain. That is what? That is a gain. That is a gain. So basically by doing that, the candidate here were allocated how many marks? Were allocated 2 marks. 2 marks for computing that. You can see that was quite straightforward. Also, in part B, we are required to compute the gain or loss to be, or as it will appear in the group account, as it will appear in the consolidated statement of profit or loss. So this is now the gain or loss to be recognized in the group account. So this is something we discussed in our previous session, how to compute the gain or loss arising from disposal of interest. So in terms of how we compute this, we take a number of figures here. Number 1, we take the fair value of consideration which was received. How much amount did the parent company receive after selling the 60% stake or interest in Darfur? So that figure, we already have it in note number, additional information number 4, and which was 47. And then to this, we add the fair value of investment retained. Fair value of investment which was retained. Still, we have that in note number 4 as a figure of 4,300. The fair value of the 40% equity interest which was retained was 43. After adding those two figures, we proceed and we less 2 items. Number 1, we less the parent company unimpaired goodwill. parent company an impaired goodwill, and that is something we have already computed here. The goodwill arising on acquisition of Darfur, this figure here. And we also have to note that this particular goodwill here, despite computing it using the full goodwill method, this is a goodwill attributable to the parent company, because in this Darfur we don't have NCI, because generally here what we take into account is the parent company goodwill, which is not yet impaired. So this goodwill was not impaired as per the information given in note number 6, and the full amount is the goodwill attributable to the parent company. So that is what we less there. And then we also less the fair value of net assets at date of disposal. So what was the fair value of the full limited net asset on the date of disposal? That information we also have it in note number 4. We are told on 1st of April 2021, the fair value of identifiable net asset of Darfur was 6250. So that's how we determine the gain or loss on disposal to appear in the consolidated, or to be recognized in the consolidated statement of profit or loss. So we have 47 plus 4700 plus 4300 minus 15 minus 6250. Is that will give us 1250, which is a positive figure, and that is the gain on disposal. The gain on disposal. And actually that what was required in that part there, and basically by doing this, the marks allocated there were 2. So these are the items automatically which were marked. So let's move to part C of that particular question, whereby we are required to prepare now the consolidated statement of financial position, which you have said is simple, because what we need to do is to appreciate the fact that this will be a subsidiary at the end of the year, and then Darfur Limited at the end of the year, it will be an associate. So therefore, in preparing a consolidated statement of financial position, we combine similar items of asset and liabilities, those of the parent and those of the subsidiary. And then for Darfur, we just compute something called the investment in what? In associate. So therefore, let's do that. Part C. So the name of the group here will be Pareto group. This is a consolidated statement of financial position as at 30th of June 2021. So here we just need to have a single column, and our figures are in thousands of shillings, in million of shillings. So we start with the non-current assets. So first of all, we have the PPE. So of PPE, we are taking the PPE of the parent, recall that, of the parent, that of PABA. We are not including those of Darfur. Darfur is an associate. We don't consolidate asset and liabilities of an associate with those of the parent. What we include here, as far as the associate is concerned, is something called the investment in associate. So therefore, we are only adding the PPE of Pareto and those of PABA. We have 4900 plus 9250, and then we check whether we have any consolidation adjustment affecting the PP. Do we have any consolidation adjustment? Yes, this one. On the date of acquisition, PABA Limited revalued its asset upward with an amount of 625, which was not accounted for. So we add that here, 625. So remember, we don't have any depreciation other charge, which would have been deducted there. So then below the PP, we'd have investment in PABA, investment in Darfur. So those investment, we don't include them here, but as far as PABA Limited is concerned, which will be a subsidiary at the end of the year, we include its goodwill here. So the goodwill on acquisition of PABA is 3,000. And then for Darfur at the end of the year, remember, it will be an associate. So what we include here as far as the associate is concerned is investment in associate or investment in Darfur Limited. So in our previous session, we looked on how to compute this, and actually we said to compute investment in associate, we take the investment, that is, we take the fair value of the investment which has been retained. So which is what you are given here, 43. And then to this, what we add is the group share of the post-acquisition net asset in that DAFU. So how do we get the group share or the parent company share of the post-acquisition net asset in DAFU? So what we do is that we take the net asset of DAFU at the end of the year, and basically by now we know that the net asset of a subsidiary is always equal to equity, share capital and reserves. So what is the equity of DAFU at the end of the year from its statement of financial position? You can either take the asset minus liabilities, or you just take equity. The total equity of DAFU, which is the same with the net assets, is 82.50. This is the net asset of DAFU at the end. But now the date DAFU Limited became a subsidiary, became an associate, sorry, its net asset, you have to recall in note number 4, we were given as a figure of 62.50. So therefore, whatever the difference here is the post-acquisition net assets. So we get the parent company share of this, which will be 40%. Which will be 40%. So this will give us a difference of 2,000, 40% of 2,000, 40% of 2,000. This one is 800. We add it to this, which will give us 5,100. So that is now the investment in what? Investment in DAFU, which you are saying will be included here as an item of non-current asset. Okay, so then below that we also have the financial assets. Financial asset, no adjustment for this. We just take the financial asset of the parent, 31, plus those of the subsidiary, 28. This will give us 59. And then from there we have the current asset. Actually, for current asset, we are given the total, 3850 plus 4425. Do we have any adjustment to the current asset? We check for things for like intercompany debts. We don't have things like unreleased profit. We don't have. So mean that no adjustment for this. So what we just need to do, we get the final figure. We get the final figure. We have 3850 plus 4425, which will give us 8275. We get the total assets. The total assets. So let's first of all we compute the figure for PP there. We have 14,900. There is something we have forgotten here before we add here. So this particular purchase consideration which was received, that is a figure for 47. This amount was not yet accounted for. So therefore is amount receivable. It was not yet paid. So we also include it as part of the current asset. We also include it as part of the current what? Asset before we get the final figure there for PP. So let's add 47, 82. 75, 8275 plus the purchase consideration received, this one, which will give us 12,975. Okay, so we get the final figure for PP. We have 49 plus 9250 plus 625. Which will give us 24, that is 24,775. Yes, and then we can add all these figures now, plus 3,000, plus 51, plus 59, plus 12,975. So that will give us a total of 51,750. So these are total assets. So we proceed, record equity. So for equity, we record the ordinary share capital, that of the parent company only, which is the 10,000 The share premium for the parent company only, 5,000. Then from there, we will compute the group retained earnings. This one we computed as the last item. And then we will get the total equity. We proceed and compute the non-controlling interest. And the non-controlling interest here will only be computed as far as or in relation to, or we are going to compute this for PABA. PABA is the one which was a subsidiary. Remember, DAFU is an associate. So then from there we have non-current liabilities. So for non-current liabilities, we are given the total. So we have 85 for the parent, and that for PABA, no adjustment here. So we get a total of 14.5. And then we have the current liabilities. Current liabilities, we have 47.75 plus what? Plus 17.25. We don't have any adjustment there. We get total equity and liabilities. Total equity and liabilities. Total equity and liabilities. So let first of all we add these particular figures here. For current liabilities, we have 47.75 plus 17.25, which will give us 65. And then for the non-controlling interest, this one we can compute it directly because the group policy here is to measure NCI at fair value. So when that is the case, then the computation of NCI is quite simple, because what we do, we take the NCI at fair value on the date of acquisition, which is 21.25, plus now the group share. The group share of what? The group share of post-acquisition adjusted retained earnings. So the retained earnings of PABA Limited after it was acquired, how do we get that? We take its retained earnings at the end of the year. The retained earnings of PABA at the end of the year in the statement of financial position is 51.
if we can start with task one. If you have gotten the worksheet, you should probably open it on your computer if you have access to your computer. Then we will start with the tasks. So task one says insert a new row at the top of the worksheet and insert the heading. I think here, this one I wanted to say insert the title, New Day Motors September imports. So there is a car dealer of some sort here. They've imported these vehicles. We have the cost. We probably be asked to do the duty, the shipping, and then the total cost. So what we want to do is to follow these tasks, right? So if there is anyone amongst us, how do we insert a new row up here? We want something at the top of the worksheet. To insert a new row, we had not discussed this before, but I'm sure probably there's someone amongst us who will know how to do this. So I'll point at where the one is, number one, and right click on that and there will be an insert option. So just click that, you get a new row, right? So, and the same works for if I wanted to insert a new column and so forth. We don't want a new column this now, right now. So what we want to do is insert that heading. Let's see, New Day, calling it New Day Motors September imports. So what does the next task say? Format the title to be bold and size 30. So we apply some basic formatting. So to format this, we'll of course highlight it, then go to the home tab and click on bold. Then they want it size 30, we change that here. Sometimes you will find that the size you want to put is not listed here. Like size 30 is not amongst these ones. So what do? We just type it directly and we get a size 30, right? So that's size 30. Then they want the cells merged in the range A1 to G1, right? I can see this font is already quite big. Maybe I should adjust the size. But let's see. Highlight this to merge the title, to merge the cells. We will highlight the range from A1 to H1. Then I will go to the home tab and click on this merge and center. So it merges it within that range. The only issue right now is that it doesn't fit, so I can adjust a bit. What I've done is drag this a little to make sure that the whole of the title shows. Okay, I hope we're together up to that point. So that is formatting. Let's see, yeah, there is one more formatting thing. We're supposed to apply visible table borders on the spreadsheet. We want some visible borders. So this part is going to be visible. So to apply borders, highlight the whole range where you want to apply the borders. Then you can again use the home tab and borders are here. So there is this font group, this ribbon, font group, borders, and click on borders and you have borders there. Okay. That's clear. So let's try do some calculations now. We are applying some of what we have been learning. And this is where I want to get some interactivity out of you. We have been told to calculate duty. The duty, the rate for the duty is 40% for cars that cost 5,000 US dollars and below, and 55% for the rest. That means for vehicles that cost above 5,000, the duty is higher, it's 55%. So if anyone can recall from our discussions, what do we need to do here? What will we be using, a formula or a function? And if it's a function, what function shall we use? Okay, let me review this one for you. Now, we talked about the if function. The if function is a conditional function. Remember here, the condition is the duty changes according to the amount, the cost of the vehicle. So if the vehicle is above 5,000 USD, duty is this. If not, it is this other one. So it just sounds like an English sentence. So we have equals, then we start an if function. If, then we will click this. So it should read like an English sentence. If the cost is above or equal to 5,000. Okay, if the cost is above or equal to 5,000, then what happens? So we have to have a then clause. This is called the condition. If that condition is true, then we have started with a greater than, actually, come to think of it, because here it says 5,000 and below. So we need to change this to answer the question correctly. We are less than or equal to, and notice the order of these symbols. You have to start with a less than sign followed by the equal sign. Sometimes students mix them up. You start with equals and then less than, and it doesn't work. So you put them in the order in which you say them. Less than or equal to 5,000. Then the duty is 40%. If you recall from our last lesson, I remember we did a bit of that function. You have to say 40% of what? If I just wrote 40%, then I'll get the wrong answer. Or rather, I'll just get 0.4 because 40% is 40 out of 100. I need to say 40% of what? 40% of the cost. Okay, so the duty is 40% of the cost. Else, so if this value does not meet the condition, the value in here does not meet that condition, then the duty is 55% of the cost. Right? Very important to remember there. Otherwise, there are some cases where a student will work out this. They will put the 40% and not put the value. Let's just see what would happen. If you didn't put 40% of what you're trying to get, you'll get this. And then you will wonder, why is my formula not working? Because you've not said 40% of what, or 55% of what. So you can use this to actually also check what rates are being used for the duty. Anything above 5,000, you see it is 0.55. This one is 0.55, which is 55%. So we need to specify it is 40% of the cost. That is how we do it. Remember, we have talked times about clicking on the options rather than typing them. Then when you click, that is when you're able to auto-fill like we have done. You can also try the next one, shipping. Shipping is, again, straightforward. It is 15% of the cost for all vehicles. So that one should be a straightforward calculation, equals 15%. Okay, we said you use a percent sign. The percent sign is shift and 5. There are those people who will do 15 over 100 times the cost, which will still work, but there's no need to do that when you have the percent sign. So we use the tools that are available on the spreadsheet. So 50% of the shipping, or rather the cost. Then we drag this down, and then we have the shipping cost, right? Then the total cost, as you would guess, will be the sum of all this, right? So how do I get the total here using one function that we have learned so far? So select everything, including the cell where you want the solution. Then we can click on this auto sum sign. In fact, you can do all of them at the same time. So if I undid that and did this, then click on the auto sum, then you get all the answers. Okay, correct. This, it shows we are learning. Okay, so what we want to do is, so we have answered all that, we've calculated the total cost. What we want to do is also fill out this section here. We want to do a bit of analysis. analysis. Okay, so this analysis, I want to get the number based on every make. Okay, so I want to get, say, the number of Subarus, the number of Toyotas, and so forth. So there are different types of cars here. So I want to use the make field and get the number. So what I actually need to do here is to adjust this. See, instead of having this, do this, and then I'll move this. I can move this around. Again, part of it is, suppose I wanted to move this to the end, let me put them here. So I can do my analysis around there. And instead of this, I will write names of every make. Toyota. Then I have Volkswagen. You can correct that even on the worksheet you received. And I think the last type of vehicle is Nissan. So that one is getting the number based on the make. But we can also do some analysis based on the category. So all of this is make. So I can merge that and put a small title there and say make. And then I've included an extra cell, so correct that by going back there to unmerge and then merge afresh. Then I'll do some analysis here by category. So I'll just type category. And there are how many categories? There is station wagon, then there is SUV, then I have sedan, then I can make this smaller, adjust this a little. Then I have what other categories? Sedan, crossover. And I think I have a van. Let me make this a van as well instead of making it a mini van. Right, so what we want to do is to use some functions that we have learned also the past few days or weeks to fill in, to do some analysis on this. Before we learn new things, we need to master the ones we have already learned. So what we want to do is remind ourselves, what function shall we use if we want to display the number of Subarus, for example? How many Subarus are on this list? What function shall we use? Who remembers the function? Okay, so that is count. Tried, but not quite count. You've gotten it partially correct. What are we counting? When you use count, if I remember correctly, in the last lesson, we said if you use count by itself, count only counts numeric values, all right? We talked about count and count A. So we call these two. This one counts numeric values, and it will count everything in the range that you have selected. This will count, it will count string values or other text values in the whole range that you have selected. So we will need to use count if correct. Count if is a correct. So we are counting with a condition. So equals count if. Open a bracket. Then I like the range, and you need to specify what you're counting. So the criteria, and it gives you a prompt over there. So we have the first one we're counting is a Subaru. Said because we are now familiar with Excel, we don't need to go typing the formula over and over again. We can find a way of auto-filling the formula, copying the formula all the way, say up to here for make. We can even let's put some different colors here so that we see it is different type of data. I can use some green. I can put a green fill of that section and put some borders. And I can put a different fill here to differentiate the sections. Put a light blue fill and apply border. So I want to copy the formula here and here. Can anybody recall again from our discussion in the last lesson? There's something we said. If I tried copying this one directly, I'll get something that doesn't seem to be very right. First of all, I'll get zeros. And another problem is that it's still counting Subarus, right? So even if I change this, let's say I change this to Toyota. Let's see if it will give us the correct answer. Change it to Toyota. I still get a 0. It's still not counting the things I want. But if you look carefully, this range is B3 to B14. But this range is C3 to C14. So it has moved from here to here. It's looking for Toyota here and it can't find any Toyotas because that is a make, right? And you'll even get an error message, right? So what we want to do is to, while we are still here, we use absolute referencing. If you remember, we were pressing Fn and F4 to apply those dollar signs. So that locks the reference to that section, to that range. So if I copy this now, I get some 3s. So there's a bit of hope. At least I have something. It's not showing me zeros. The only problem now is easy to spot, is that it's still counting Subaru when I need to change that to Volkswagen and Nissan. So I'll start with Nissan. I just need to change that to Nissan. I can either type it. If I had a list of those types somewhere here, I could use that range. We'll check. I'll show you that in a minute. So Nissan, it tells me the 2. Then Subarus, need to change that from Subaru to Volkswagen. Right, so it will count the Volkswagen in 5.3. Then we put Toyota and see how that will change. And those ones are 4, right? So, and you'll notice if you make any changes here, it will automatically be reflected. So what I'll say is, if I had this, a list of this somewhere, Toyota, Volkswagen, and I have the next one, Nissan. In categories, so I have Subaru, Toyota, Volkswagen, and Nissan. I can still use a range that is somewhere on the worksheet to do what I've just done. So if I kept this range, then instead of this Subaru here being there, I can click on this. So it will still look for Subaru. My search criteria will be whatever is contained in that cell. I hope that makes sense. Then if I want to drag it across, then it would make more sense if I put this one in this, somewhere in these cells. So if I put them across like that, then I will be able to autofill directly. So because this is referring to L14 now, so that is L14 where Subaru is, then I can autofill like this. And you see the numbers remain the same because this one has Subaru. When I go to the next one, M14 now has Toyota. So that's M14. If I go here, that N14 has Volkswagen, and that O14 has Nissan. So that's one way to do it. Unless this is, I don't think it's very confusing. Sometimes it saves you a few minutes of typing. If I had them here, then I would not have to go typing the names again there. Even typing will still give you the same result, right? I hope that is not too confusing. All right, let's try to apply the same formula to work out how many station wagons there are, how many SUVs there are, and so forth. Get the numbers by category. It will still be the same formula, so I'll do equals count if. Then I open a bracket. Then this time I'm using this range. Then I'll press F4, that is function F4 because I'm using a laptop. Then I put a comma, and I could do one of two things. Write those the different categories here. Alternatively, just type them in directly. So let me just make the other point. So type them in, and I can do that. And if I copy this formula, I then have to go changing them. Like this one now will read station wagon, and I want it to read the van. I have to remember to change that one inside there to tell me there are two vans. Then I want to change this category to crossover to tell me how many crossovers are. There are 3. Then the next category is sedan. And so forth. Close the bracket. And there is SUV and so forth. Right, so we have used the count if formula. Remember, we have used that formula in very many different scenarios. The point is, presented with the different scenarios, you should be able to choose the correct function and apply it. Okay, so what we have done so far is we've kind of gone around the same functions in different scenarios to just make sure that you internalize their usage, their syntax, and their application. Okay, so let's talk about the average cost. We want to get the average cost by make, the average cost of a Subaru, the average cost of a Toyota, the average cost of Volkswagen, and so forth, the average cost of a station wagon, the average cost of a US SUV. Average if given pop. So average if, then we have our criteria. So we want to get the average cost. So we'll use this total cost tool. Where are we looking for Subaru? We'll select that range, then lock it. So I'll not go through the detail of locking again. Then what is the criteria? We are looking for a Subaru. So I can even use this directly. Let me lock that Subaru there. Shift and 4. Or I don't even need to lock it, but if there's no harm, then I'm doing the average of the total cost. So FN F4, that should give the average cost of a Subaru. Okay, it looks like a very long formula, especially when you have the absolute signs. But just to break it down again, is let me expand it so we can make it slightly bigger so you can see it clearly. It says average if this range, it looks at that range for that thing. So it is looking in this range, which is that range, the make for Subaru, and then it will get the average of the total cost. So this is where it gets the value that it is working out the average of. So there's three, they're called parameters. This is a function with 3 parameters. It has the range where you're looking for that thing in the second section, and the range where the calculation comes from. All right. So I'll put that back, smaller size, and remember shortcuts. I'm using Control Z to move backwards. Then I can look at this and see the decimal points are a bit too many, then reduce those decimal points using this. If we have learned, let's make it 2 decimal points because it's money. Then we go to Toyota. We'll use the same idea. If I autofill these ones, let's autofill this and see what the problem is. We get the same answer. So that's not a bad thing. It means there is only one thing we need to change. So those who are getting what I'm saying, what do I need to change in order to get different values here? What do I need to change? Okay, so let me help you see it. So if I double click this, if you look at those variables there, there's range, criteria is the middle one, average range is the last one. So you can tell that this middle one is what is determining what the average will be, because this middle one is the one that represents that Subaru. Okay. So what I need to change is that middle one. Right now it's referring to the Subaru. So I need to change that to Toyota and change it on to Volkswagen and Nissan and so forth. So in fact, to make it easy, let me just use that. So right now it is C18, it means it's referring to that Subaru. If I autofill it, changes. So you'll notice that this changes to D18. That means it is now looking at the Toyota. If I look at this one, it has changed to E18. That means it is looking for the Volkswagen. If I look here, it's referring to F18. So what I needed to do is to change the criteria, because for all of them, it is checking here for that thing and doing the average based on that column there. I hope that makes sense. Right. So just to have a quick peek at that formula again, it has a range, it has a criteria, it has an average range. It works the same way for sum if. Sum if has the range, the criteria, and the sum range. So if you wanted to work out the sum, let's say total cost by, let's add a quick one here, total cost by make. So we'll see total cost by make. We basically need to, I can just copy this formula downwards. You see the logic of it. Let's see, it is going to C19. So I want this to remain as C18. If I do that, it gives me the same numbers, but it's giving me the same numbers because the function is still average if. So I want it to be sum if. I'll just change this to sum, and I'll get a sum of all the costs of the, let's say the first one will be Subaru. So it will take that number, 3875 plus 12,750, then add it to 10,200. That is where that number is coming from. So it works exactly the same way as the average if. It takes three parameters: the range, the criteria, and the sum range. Which range are you summing, right? So we'll use the same idea for getting the sedan. If you want to get the average, rather the category, if you want to get the average cost by category. Average cost by category, we'll use equals average if. It's the same formula. Then the range, this time we are using category, and we lock it. Then our criteria will be this one. Then close that, then we still do the average cost, or rather the cost, total cost. Press enter, and we'll get this cost here, this 5,786 is the average cost of a station wagon. How many station wagons are there? There is 1, 2, 3. So that means it has taken these numbers, it has added that, plus that, and divided it by 3 to get that. So you think about the math explanation for that. And because we have put the right references with this one, I can just copy it across. That is why it's important that you take some time and try this thing yourself. If you try it yourself, then you'll see the logic of what I'm doing, right? And try to get hold of this recording as well. So what I'll do is, this looks like too many decimal places. Again, to review how you do decimal places, you do this, reduce them to 2 decimal places, right? Then total cost, I can use the same formula, similar formula. I'll just copy one of these down. I'll get some error message, and I will look at the formula and know that the thing that has changed is this one. Because these ones are locked, I will be guaranteed that they have not changed. So this G19 is what has changed. And if I look at it, G19 is the average cost, but we do not want or rather G19 is the number here. We do not want that as the criteria. The criteria is meant to be the category. So I just need to change this back to G18, that it's referring to the category. Then if I fill it across, it will give me the same numbers, but before I fill it across, because we are doing total now, we need to change that to sum, the sum function. Press enter, and then I can fill this across. So it is data that kind of makes sense. You want to know what is the average cost of an SUV. If I look at these numbers, they kind of tell me something. An SUV is on average more expensive than all these other types of cars, followed by some types of sedans, right? These are different types of cars. Then it looks like from this list, station wagons have the lowest average cost, okay? And then in terms of the total amount the dealership spent on importing the cars, the amount they spent, I think looking at these numbers, if I apply some formatting, right now they're not very clear. Because they're currency, I can put a comma on them. I put a comma using that. And now I can tell where the thousands are. So I can easily now tell the category that we spent most money on was SUVs, followed by the crossover, followed by the station wagons. Okay, so the total amount was highest on this. And again, like we're saying, this information, this formula can be used in different contexts. You want to know which products cost you the most, which products did you make the most money on, and so forth, depending on different scenarios. So let's try one more. Highest cost. This one is a bit separate from this, from the ones we've just done. We want to know out of this whole list, which one has the highest cost and which one has the lowest cost. And there's a function we learned for that. Again, let me throw the question back to you. Which function do we need to use to get the highest amount from a range? Max value, that's correct. So we have max equals, and max, open the bracket, highlight the range to pick the highest value at range. So 17,000 was the most expensive thing. It was a Land Cruiser, Toyota Land Cruiser. Then the lowest cost, we will use mean function, open a bracket, highlight this, then it gives you the lowest out of those figures. So the lowest was 3,875. Again, you can format this as, because this is currency. Generally with currency, we tend to put two decimal places. So if you look at it, this one has no decimal places, so I can quickly format all of them, select the whole range, then add some decimal places. Okay, so that makes it 2 decimal places. This one, I can make this 2 decimal places as well. and format it to have a comma, so I can see clearly where the thousands are, or in some cases where the millions are. So let me put a comma there as well. Kind of makes it easy to read. Okay. So a number of functions we have reviewed there. Just a quick run through of what we have done so far. If you recall the duty, we started with the duty. We used the if function. The if function in this case had three parameters, three things inside the function. So what I'm calling parameters are these things. There are three sections. There is the logical test. This is the test it will carry out. Then it will give you this value if that test is true. If that test is false, then it will give you that value. So it has three options. The condition, what will happen if the condition is true, and what will happen if the condition is false, right? So that's a basic if function. You could make it a little more complicated, but for our purposes, we will just be using relatively straightforward if functions. We will not use very complex if functions. There are some that are nested. You can make it have very, very many options, but for our purposes at the moment, we just do an if function with a condition. What happens if the condition is true? What happens if the condition is false? So that was the if function. For shipping, we didn't use a function, we just use a formula to calculate the percentage. The thing with the percentage that we have emphasized for the last two lessons is that you use a percent sign that is on your keyboard, Shift and 5. Okay, then you click on the number on the figures rather than type them. That is useful for when you want to autofill. Okay, so if I make the mistake of typing 2,500 here, then I'll have a problem. The first answer will be correct, and the rest of the answers will be wrong. If I did that, it gives me the same thing, which makes everything else wrong. So instead of typing 2,500, I click on it, the center, then I can autofill. I get the other answer, correct answers, right? Then the total, of course, we did a sum function, we added all of them. So far, if function, sum functions, function. Then when we came to the analysis section, we've added three functions: count if, average if, then sum if. And with some practice, you'll be able to see the application of this. Like I can see Twagrimana there is getting the hang of it. And we said there is also these functions that we talked about, I think, in the last lesson. If I was to count the number of vehicles, like the total number of vehicles, so I say total number of vehicles. Let me just call it total number. Okay, I want to count everything on this list. It depends on what I want to count. If I want to count by the make, notice that this is text. These are text values, not numbers. What would happen if I did count? If I did count, then highlighted this section, I get a 0. Then I would be very frustrated if I'm a student who has forgotten how to count text. So to count text, I need to add an A there. Small change, it gives you the correct answer. So count A is a function that is used to count text values. If I was to count this range here, if I counted the cost for whatever reason, you want to use that range to get the number of vehicles, then in that case, if I did this, let's see what will happen. I want to count this. This is money. Let's see if it will work. It still works. So you can use count A to count both. But in this case, because they are numeric values, even count by itself will work, right? So count A specifically for counting a string or text characters. right? Then in the same session, we have looked at formatting. Formatting is also an important aspect of spreadsheets. You can apply borders, which is part of the exercises I sent you. Applying borders is the home tab, going to borders and selecting all borders. Sometimes you will need to remove borders if you're asked to remove some borders, then same place, and I say no borders. But in many cases, you will want to do borders, right? So that turns it into, if I wanted to print this, it's a bit neater. So if I went to File, Print, then the presentation is a little better than when it has no borders. Okay, look at it. Even color coding makes it a little better when you're printing. Just one more thing before while we're still talking about printing, if you look at this, at the moment, it's portrait orientation. So some things are running to the next page. So if I wanted things in one page, I'd probably need to make this landscape. I can make it landscape by going to page layout, orientation, and turn that into landscape. Okay. I do not want to print the tasks. These were for our use. So if I move this out of the way, you will notice there is a dotted line there. So if I go to print preview now, that dotted line shows you what will be on the page. So you notice all of these fits now, and this part, some parts are outside, but for the sake of illustration, we didn't need to print to show the other bits. So the part that is missing is just that one there, which we can force that to get into the print area by moving this up. Okay, so we also mentioned something about printing. Now, as for the next lesson, I'm targeting to start looking at slightly more, I won't call them complex, but they will be a bit more advanced functions. So we'll start looking at something called the VLOOKUP function, which you expect to know. VLOOKUP. Then we will talk about things like pivot tables. We'll talk about some other functions that are more specific to accounts or finance, like PMT and so forth, a little more advanced. But we couldn't have gone to that extent without first understanding the basics. What I suggest is I will also, you have a copy of this already. So I suggest that you do the exercises. Take time to do these exercises. If you have questions, let's start with those the next time we meet. But just before we close again, while we are still on this, if I can quickly throw in something else, charts. We are supposed to learn how to make charts. So we can make, this looks like a good piece of some data to create a chart on. Suppose we wanted to create a chart based on the make and the total cost. It could be a bar chart, a column chart, a pie chart. So, but let's try exploring the different types of charts. If I wanted to select make and total cost, there are two ways to do it. One way is to select everything. Then I will go to insert and chart. Let's say it recommends that we do a clustered column chart, which is not what we want. Let's say we just want a simple column chart. Then we click OK. It gives me a column chart. Okay, so it is using, let me see that again. This is not what we were looking at. This is what we're looking at. So it seems to have picked duty and total cost. So let me go back there, then go to insert chart. I needed to see, I was expecting more columns. So if I do this and OK, then I get a chart looking like that. In this case, I don't need the line, so I get rid of it. Then it's showing me many variables. If you look at this, the blue one is the cost, the orange one is the category. Then we have many variables. So, but I just want the make and the total cost. So I can remove from this the things that I don't want. So I can remove, when I look at this, it says cost. I don't want this cost, get rid of it. Then this is the duty, and this is shipping. What I need to do is to edit this. I need to select different data. So I want it to show me this instead. So what I've done is edited directly. I've right-clicked on this, then gone to select data and highlighted the range I want. Okay. The alternative to doing that, like that looks a bit messy. It's a bit even confusing. Let's just not do that method. Method 2, you start by selecting exactly what you want. So I'll highlight that. Then I hold the control key on my keyboard. If I hold the control, then I can select this one to avoid the confusion of having to delete some columns, then the chart looks a bit more confusing. I have highlighted this first, then hold down control, then highlight the next one. Right? So that way, when I'm inserting the chart, I will only be dealing with 2 columns, and it will be very straightforward. So if I click this, then it shows me the total cost and by make. Even the title will be meaningful. Total cost by make, right? Then I can even choose to, if you formatted this, you can vary the colors by the different types of data they have. I want to this. I can do vary colors by point, and then it will be able to show me different colors for different cars. So that's just a bit of some additional information. We'll still do a few more charts. I just wanted to give you a bit of a sneak peek into charts because it's also one of the things we're supposed to cover. Now, what I want to do is, because I don't want to overload you with too much information, I will let you do a bit of practice before you go to sleep today. Try and redo the things we have done. So if there's no questions, we'll end it at that. We'll see you next lesson.
Hello learners, welcome today to session 3 or lesson 3 where we want to look at long run analysis of costs. Long run analysis of costs. Long run analysis of costs. So in the short run, we said that this is normally a period where at least one factor must be fixed and the other should be variable. In the long run is where all factors can be varied, and therefore we do not have any like law of diminishing returns to variable factor, because we are assuming that all factors can be varied. Varied meaning we can interchangeably vary the proportions of different factors. Why? Because they will not remain constant, as in the case of short run analysis. So what operates in the long run is the economies or these economies of scale. So when the firm factors can be varied, the firm can either experience economies of scale or diseconomies of scale. So in this lesson, we want to look at economies of scale in relation to internal economies of scale. So what are economies of scale? Economies of scale are simply those advantages that a firm enjoys after it has expanded. We normally have what we refer to as an optimal size of a firm. And an optimal size of a firm is simply that efficient size that a firm can have so that it's able to produce at the minimum or the lowest production cost per unit, so that it has no option of either increasing or decreasing its level of output. So in that case, we say that the farm is operating at its optimal size. And that's when economies of scale will come in. So in economies of scale, we want to begin with internal economies of scale. So what are internal economies of scale? These are those benefits, or I refer to them as advantages, that a farm can experience that are coming from within. They have nothing to do with the outside. What are the happenings that are happening in the organization, like when the farm has expanded, that can be a benefit to the farm? That's what we refer to as internal economies of scale. So they are as follows. We have what we refer to as technical economies of scale. So technical economies of scale, like when a farm increases in its size, it is normally able to use sophisticated or modern technology. And when it is using modern technology, it will be able to increase its level of output than that farm that has not expanded. And under technical economies of scale, we have such benefits like what we refer to as indivisibilities. So what are indivisibilities? Indivisibility is simply where a farm is able to take advantage of a process that cannot be reproduced on small scale. So one of the technical economies that a farm will enjoy is what we refer to as indivisibilities. And indivisibility is simply where a farm is able to take advantage of a particular process that cannot be reproduced on small scale. So that simply means this farm will have a process or a particular process which a small farm cannot have. Like, for example, when a farm has a particular machine that can enable it to produce, and when it is producing to in large scale or in large quantities which a small farm cannot be able to produce. Why? Because a small farm produces on small scale. We say it is enjoying a benefit of indivisibility. We have another one which we refer to as increased dimension. Increased dimension is where a farm can increase its equipment, can increase the capacity of its equipment so that it is able to produce a larger output without increasing costs. That is increasing without increasing production costs. So increased dimension is where when a farm has a particular equipment, it can decide to enlarge or to increase the capacity of that equipment so that it's able to produce a larger output than what it has been producing before without necessarily increasing the production cost. I can give an example, like for these commercial services, you have been having or owning a matatu, a matatu has one driver. And then because your business has enlarged, you now decide to bring in a bus. So a bus still will need one driver, but the capacity is more large than that of a matatu. So in that case, that benefit is called increased what? Dimension. You are producing more, but you are not necessarily increasing the production cost. And if it is there, then it is very minimal. And then number 3, Roman 3, still part of technical economies of scale, we have another benefit of linked processes. So linked processes is simply where a firm can link up its processes that can enable it, minimize its costs. So linked processes is where, like, we have firms that buy raw materials, and once they buy those raw materials, they use the raw materials in the production of goods and services. And then once they have produced goods and services, they again market for those goods and services before they are sold. So linked processes is simply where a firm can decide to supply for itself raw materials as well as produce the goods. It can even go up and do the marketing by itself, so that it is reducing costs such as fuel cost. You don't need to get raw materials from another supplier, bring them before you produce. You simply have a portion where you are supplying raw materials. So instead of buying them from outside, you simply use what you already have, and then you will be able to do what? To produce using minimal costs. Why minimal costs? Because we will cut costs to do with transportation, etc. Those are called linked processes. And then we also have another one still on technical economies called specialization. So specialization can be where a firm can specialize, like in terms of machinery and labor, so that it produces what's quality, so that it produces what is quality. So specialization is where a firm can simply decide to specialize on a particular machine. So it buys a special machine that will enable you to produce what is quality, or have a specific class of workers who are able to help in production of that which is quality. So when we talk of competition, what happens? Because they will be producing what is quality, their products will be more competitive than of those other firms. And then we can also talk about research, still under technical economies. Research is like when a firm has grown, it has an ability of conducting a market research. Like whenever it wants to introduce a new good or a new product, it can be able to know what are the needs, what are the tastes and preferences of the people before it can design and produce what is to satisfy the need of its customers, which may not be so with small firms. So research is where a firm will be in position to conduct a market research, which can enable it to produce that which satisfies its customers. And when that happens, that means profitability of the farm will increase. When customers are satisfied with what you produce, they will buy more, and when the more they buy, the more you'll do what? The more you will make profit. That was number one. Then number two, we have what we refer to as financial economies. So financial economies is where when the farm grows or enlarges, it normally has more in terms of assets. And for example, whenever it wants to raise like a loan or funds from a financial institution, it is in proper position to provide security or what we refer to as collateral. And because of that, they will always raise funds at a lower rate, like in terms of interest, than those that are small farms. So financial economies is where a farm is able to raise funds from financial institutions at a lower cost. Why? Because at a lower cost, because it is in position to raise assets that can be used as collateral. That can be used as collateral. Then number three, we have marketing economies. Marketing economies. So marketing economies is where when a farm expands, it will be able to like take advantage in buying in bulk. When a farm buys in bulk, it will enjoy quantity discounts. And when it enjoys quantity discounts, it means that it will buying at a lower cost than what others will be buying at. And therefore, it will be always saving in terms of purchase. And then it can also enjoy economies to do with packaging. When it is packaging in large quantities, it is more cheaper than when packaging in small quantities. And then when it comes to selling and even distribution, it will have that advantage. So marketing economies, these are normally in the form of like buying in bulk. This enables the farm to take advantage of quantity discounts. Hence buying at a lower price, which makes them to save in terms of the purchase price. We also have packaging. Packaging is where I can just say packaging in large quantities. Packaging in large quantities enables a farm to save rather than packing in small. Why? Because when we pack in large quantities, the cost is normally spread on those units that are packaged in that one package. But when you are packaging in small quantities, then that simply means that you will incur a higher cost than a farm that is packaging in large quantities. And then number 4, we have diversification. Diversification is where when a firm enlarges, it has an ability of even producing more products. Like it can introduce new products. Why? Because it has an ability to do that. So like for example, where there is competition or when it is facing competition with other firms, it can decide to introduce new new products which can enable it to fight that competition, and that enables it to continue remaining on the market. So diversification is simply where a firm is in position to introduce new products. A firm is in position to introduce new products that can lead to increased profits, as well as acting as a risk management strategy. And then number 5, we have risk-bearing economies. So what are risk-bearing economies? Like when a firm expands, it can be able to predict risks better than small firms. Why? Because like when it is conducting a market research, it will be able to know what are the advantages, what are the disadvantages of its product, who are the competitors, and because of that, it can simply be able to use SWOT analysis so that it is able to do what? To minimize its risks than a small firm. So risk-bearing economies, we say that a large firm is able to predict risks than a small firm. Why? It has an ability to conduct a market research. It can conduct a SWOT analysis than a small firm. So those are the internal economies of scale. And then we have disadvantages or these internal diseconomies. Can look at that shortly. Internal diseconomies of scale. So in our next lesson, we'll be looking at internal diseconomies of scale. So learners, have a good day. This ends or marks the end of our session.
Hi candidates, welcome to another session of Manifested Online Classes. We are still continuing with the topic of group account, and in this session, I want us to look on another concept of group accounts, and the concept is changes in group structure or disposal of interest. So when we talk about the disposal of interest, or basically changes in group structure, this whereby the parent company will sell all the shares held in a subsidiary, or basically sell part of the shares and retain some of the shares held in such what? A subsidiary. So therefore, what we're going to do here is we're going to look on how to prepare the group account whenever there is changes in the group structure, or basically we have now the disposal of what? Of interest. But before we even do that, we can have an introduction to this, and we say that changes in group structure occurs when the parent company sells the whole or part of shares, shareholding in the subsidiary company. So basically that's what we refer as the disposal of interest. So the parent company here will sell some of the shares, or basically all the shares which are held in what? Which are held in a subsidiary company. Now, generally, the disposal of interest can be broadly classified into two main categories. First of all, we have what we refer as a full disposal. A full disposal is whereby the parent company sells all the shares which are held in a subsidiary. That is a full disposal. But on the other hand, we have a partial disposal whereby the parent company sells some of the shares held in a subsidiary and retain some of the shares. So therefore, here we can talk of types of disposal of interest, types of disposal of interest. So when we say there are two types of this, we say disposal of interest can either be, number one, we have the full disposal, and then we have the partial disposal. Disposal. But in accordance with the International Financial Reporting Standard number 3, a disposal of interest basically occurs when the parent company loses control. So mean that once the parent company sells some of the shares which are held in a subsidiary company, and the parent company now loses control. So mean that the shares which will be held by the parent company in the subsidiary falls below 51%. So actually from 50% to 0. That is the time the disposal is deemed to have occurred in accordance with IFRS 3, in which case then the parent company is required to determine something called the gain or loss on disposal. So therefore, the gain or loss on disposal basically is determined when the parent company loses control. So therefore, you can say according to IFRS 3, International Financial Reporting Standard number 3, disposal of interest occurs when the parent company loses control. The parent company loses control. So basically what that means is that the shares now which are retained by the parent company, the subsidiary, or basically the parent company will sell some of the shares and retain shares which are less than 51%. So that is the time the disposal take place. And in such a case, then we are saying the parent company should proceed and determine the gain or the loss on disposal. What is important, therefore, to note as far as that point is concerned is that if the parent company has retained a control, when talk about retaining a control, this whereby we can be told A Limited, which held 80% of the ordinary shares issued by B, the parent company, we can be told like sold like 20% of the shares. 20% of the shares. What does that mean? It means that the parent company has retained 60% of the shares in what? In B. In such a case, you can see the parent company still having a control, because we said a company or an investor company will have a control of the investee, whereby the shares held by the investor company, the investee company, lies between 51% to 100%. So, but you're saying disposal in accordance with IFRS 3 occurs anytime the parent company loses control. It sells some of the shares here and retain shares which are now less than 51%, from 50% to 0. In which case we are saying a gain or a loss on disposal should be what? Should be determined. And therefore, you can say when disposal of interest occurs, that is when the parent company loses control, parent company loses control, a gain or loss on disposal should be computed or should be determined, we can say should be determined as follows. So how do we compute that particular gain or loss on disposal of interest? So gain or loss on disposal of interest. Disposal of interest. So to determine this gain or loss on disposal of interest, number one, we take the fair value of purchase consideration received. Purchase consideration received. So when the parent company sold some of the shares, or basically all the shares in a subsidiary, how much amount was received by the parent company? So that is now what referred as the fair value of purchase consideration received. To this, we add the fair value of investment which has been retained. Fair value of investment which has been retained. When talk about the fair value of the investment which has been retained, so this basically applies in case of a partial disposal whereby the parent company has not sold all the shares in a subsidiary. If, for example, the A Limited, which is the parent, which initially had acquired 80% shareholding in B, which is the subsidiary, if, for example, the parent company sells like half of these shares, sells 40% of the shares held here, it means that the parent company has retained a shareholding which is equal to 40%. So at the date the disposal took place, the remaining investment will have to be revalued at its fair value, and always that figure will be provided to you. That's what we refer to as the fair value of the investment retained. So after adding those two figures, we come here and we less, number one, the fair value of net assets, fair value of net assets held at date of disposal, at date of disposal. So the fair value of the net asset held at the date of disposal, and then to this we also add the parent company and impaired goodwill. The parent company and impaired goodwill. And after deducting those two figures, we can get a positive figure here. If a positive figure, that is a gain, but if a negative figure, this is a loss on disposal. A loss on disposal. A loss on disposal. Yes. So this is basically how the gain or loss on disposal is determined anytime the parent company has lost the control. The parent company sells some of the shares held in a subsidiary, and therefore it retains shares which are less than 51%, from 50% to 0. Always in such a case we compute the gain or loss on what? The gain or loss on disposal. So then next we can proceed and look on how we prepare the consolidated financial statement anytime we have changes in the group structure. So let's look on the preparation of group accounts. So in this case, we're going to look on how we prepare the group accounts at different types of disposal. So remember, you have said that disposal of interest can be broadly classified into two: partial disposal and the full what? Disposal. Let's start with the full disposal. The full disposal. A full disposal generally is whereby the parent company sells all the shares held in a subsidiary. Sells all the shares held in a subsidiary. Maybe first of all, you can say that this is a whole what? Disposal, or basically a whole sale of shares. of shares in a subsidiary. A subsidiary. So a wholesale of shares in a subsidiary company. Subsidiary, a company. And this one is basically governed by, governed by IFRS 5. So basically in terms of how the parent company should treat that particular subsidiary which has been free disposed, that should be accounted for in accordance with IFRS 5, meaning that that subsidiary now will be termed, or basically will be referred to as a discontinued operation. A discontinued operation, assuming we are told A Limited had acquired 80% shareholding in B Limited, and the parent company sells all these shares. So if that is the case, then this particular subsidiary is a discontinued operation, and should be accounted for in accordance with what? In accordance with IFRS 5. So what IFRS 5 requires is that the parent company should, number one, determine the gain or loss on disposal, and number two, the parent company should determine the gain or loss reported by that discontinued operation, and that one should be recognized, or those two items, the gain or loss on disposal of interest, the gain, the profit or loss from the discontinued operation, they should be recognized as separate items in the consolidated income statement. So therefore, we can say in this case, the parent entity or basically company should determine, or in other terms determine, number one, the gain or loss on disposal, the gain or loss on disposal of interest, and number two, the profit or loss from discontinued operation. From, we can abbreviate this as DO, from discontinued operation. And you are saying that these two items, that is the gain or loss on disposal and the profit or loss from discontinued operation, they should be recognized. This should be recognized as separate line items in consolidated statement of profit or loss. Should be recognized as separate line items in the consolidated statement of profit or loss. Let's maybe from our group structure here, we introduce another company here, that is C Limited. We also assume that the parent company had a shareholding of 75%. So, and also we are told that the parent company, that is A, had 80% shareholding in B Limited, but you are told during the current financial year, the parent company sold all the shares held in B. So we have said B is a discontinued operation. So therefore, when A Limited is preparing the consolidated income statement, the consolidated income statement, or the consolidated statement of profit or loss. So the parent company should first of all determine the profit or loss from the continuing operations. So the continuing operations will be the parent company and the NC, because you have said this one is a discontinued operation. So therefore, the parent company should determine what? The profit or the loss from continuing operations. Continuing operations include A and C. And for the parent company to do that, basically, in this case, we take the revenue of this, that is A, plus the revenue of C. And then we also take the expenses, including the cost of sales of A plus that of C, plus that of C. We less that now from the revenue. We get, whatever you get here will be the profit or loss from continuing operations. Continuing operations. And then we are saying that these two items here should be added to the profit or loss from the continuing operations. So then we have the discontinued operations. Discontinued operation basically you have said is this subsidiary which has been disposed. So two items will be included here. The gain or loss on disposal of interest. And you have to recall that this one is computed using that particular approach there, or that particular format there. And then we also have the profit or loss from discontinued operation. So how do we determine this profit or loss from discontinued operation? So we take the revenue of this company. For example, the parent company sold the shares held in B Limited, for example, 6 months from the start of the current financial year. So in that case, you take the revenue of B for the first 6 months and also its expenses for the first 6 months, and then determine the profit or even the loss which was reported by that subsidiary B which was fully disposed. You'll get the profit or loss from the discontinued operation. So if it's a profit, you add. If it's a loss, we do what? We less here. We less. And then we add that now to the profit or loss from the continuing operations. And then we get the profit for the year. The profit for the year. So that's basically how we deal with what referred as a full disposal. A full disposal. And basically, remember, these applies in preparation of a consolidated statement of profit or loss. Consolidated statement of profit or loss. So basically, when now preparing the consolidated statement of financial position, at the end of the year, the parent company will have fully disposed its shares in this subsidiary. So the parent company will not be having any control. Equally, there will be no NCI. So therefore, we can say that when preparing this consolidated statement of financial position, we can say there will be no NCI, or basically we can say assets and liabilities of subsidiary fully disposed are not included in consolidated statement of financial position. So the assets and liabilities of that subsidiary will not be included in the consolidated statement of financial position. And equally, as far as that subsidiary is concerned, there will be no NCI. The minority shareholders will not be entitled to share the net asset of that subsidiary as at the end of what? Of the year. That's basically how we deal with the what referred as a full disposal. Then from there we have the other type of disposal. Recall in our case here we have said that we have two types of disposal: the full disposal and the partial disposal. Partial disposal. Now here we have different types of partial disposal. Actually, we can say we have different scenarios of partial disposal. Number one, or number A, we have what referred as a disposal of a company which was initially a subsidiary and which still remains a subsidiary. Which still remain what? A subsidiary. A subsidiary company to a subsidiary. So when talk about a subsidiary to a subsidiary, this whereby we can be told the parent company had like 80% shareholding in B Limited, and the parent company, for example, sold sold 20% of the shares. So if it sold 20% of the shares, then it means that the parent company here retained 60%. Retained 60%. So therefore, you can see B Limited still remain what? Remain a subsidiary. So when it comes to preparing a consolidated income statement, what you do, you take the revenue and expenses of that subsidiary, you add to that of the parent. Actually, that disposal do not have any effect as far as the preparation of the consolidated statement of profit or loss is concerned. On the other hand, when preparing the consolidated statement of financial position, because this company is still a subsidiary at the end of the year, you take its asset and liabilities, you add to those of the parent. Actually, this particular type of partial disposal do not have any effect as far as the preparation of the group account is concerned. It's also important to note that here, because the parent company is not losing control, no gain or loss on disposal of interest is computed. This one is not computed because you have said we only compute that one anytime the parent company loses what? Control. So we can say no gain or loss on disposal of interest. On disposal of interest. Disposal of interest. So that is it about that scenario of partial disposal. So the other type of partial disposal, part B, is a disposal which makes a company which was initially a subsidiary to be an associate or a joint arrangement. So first of all, you have to recall from what you have discussed in our previous sessions that investment in associate, investment in joint arrangement should be accounted for in the same way using the equity method. That is something, first of all, you have to recall, and that's why you can see here we are talking of associate or the joint arrangement at one point. So this whereby we assume that the current financial year was ending on 31st of December 2023. That is the date of consolidation when the group accounts are supposed to be prepared, meaning that the year started on 1st of January 2023. We may be told that the parent company initially had acquired like 80% of the shares, 80% of the shares, like maybe A Limited had initially acquired 80% shareholding in B Limited some time back, but during the current financial year, maybe on 1st of July 2023, the parent company sold or disposed 40% or half of these shares. So mean that the parent company sold 40, and that means that the parent company then retained 40%. Retained 40%. So if it retained 40%, then it means that this company, which was initially a subsidiary, then becomes what? An associate. Becomes an associate. And therefore, in the first 6 months, the parent company, you can see, had 80% shareholding, meaning that this company was therefore a subsidiary. And then after selling half, the parent company retained 40%, meaning that in the last 6 months, that company was what? Was an associate. So how do we go about in this case, or how do we prepare the group account in such type of a partial disposal? Number one, when preparing the consolidated statement of profit or loss, in preparing the consolidated statement of profit or loss, number one, we have to compute the gain or loss on disposal. We have to compute the gain or loss on disposal of interest, of which this particular gain, if it is a gain, it is recognized as an in the income statement as an income. If it is a loss, it is recognized as an expense. Number two, we then consolidate the results of the subsidiary subsidiary company up to date of disposal. Up to date of disposal. Up to date of disposal. Like in this case, in preparing the consolidated income statement, we're going to take into account the revenue and expenses of B for the first 6 months when it was a subsidiary. And then in the last 6 months, because it was an associate, you have to recall that we don't include the revenue and expenses of associate in the consolidated income statement. So that's why we are saying consolidate it result up to the date of disposal, and thereafter include group share of its profit after tax, and that is in accordance with equity method. And that is in accordance with IS 28, because as far as the associate is concerned, we include, or what we include in the consolidated income statement is the group share or the parent company share of its profit after tax. So mean that you'll take the profit after tax of this company here, which is always given in its income statement, multiply that with 6 all over 12, so that you get now the profit after tax for the last 6 months when it was an associate, and then multiply that with the parent company shareholding in B, which is 40%. So that's basically how we prepare that. And then how do we prepare the consolidated statement of financial position? Consolidated statement of financial position. So in preparing the consolidated statement of financial position, our interest is basically the status of this company at the end of the year. So what will be the status of the investee company at the end of the year? At the end of the year, the investee company, that is B, will be an associate, and therefore in accordance with the equity method, what we include in the consolidated statement of financial position as far as the associate is concerned is something called the investment in associate. We don't include, or we don't combine the asset and liabilities of the parent and those of the associate in preparing the consolidated statement of financial position. So therefore, in preparing this, we say compute the investment in associate, investment in associate or joint arrangement, and included in consolidated statement of financial position as a non-current asset. So in that case, you compute, or we compute something called the investment in associate or investment in joint arrangement, and we include that in the consolidated statement of financial position as a non-current asset. So how do we compute this particular investment in associate or joint arrangement? So investment in associate or joint arrangement. So this one is computed using this approach here, or this format. So number one, we take the fair value of investment which has been retained. Fair value of investment retained. So the investment which has been retained here is 40%, and basically we have said that in case of a partial disposal, the investment which has been retained always will have to be revalued to its fair value on the date of disposal. That figure will always be provided to you. So you'll be told that the investment which has been retained on the date of disposal had this fair value. That's what you use here, and then to this we add the group share of post-acquisition net assets. Post-acquisition net assets, and whatever you get here is now what you refer to as the investment in associate, investment in joint arrangement, and you're saying that that should be taken to the consolidated statement of financial position as one of the item of the non-current what asset. Yes. So basically those are different scenarios of partial disposal, and basically how we deal with them specifically in preparing the consolidated financial what statement. So basically that's what you need to know. I want us to stop at that particular point. Once we come back in our next session, I want us to look on an illustration question regarding how to prepare the group accounts and also how to compute the gain or loss on disposal in case of disposal of interest. So see you in the next session.
Hello learner, welcome to Manifested e-learning platform. My name is Emily Ngwiri, and today, ladies and gentlemen, we are discussing Business and Data Analytics BDA April 2024 question 22. It reads as follows: Matrix Limited has provided the following data for the 6 months ended 31st December 2023. So you can see the 6 months have been provided to you over there. The revenues have been given, cost of sales, gross profit, operating expenses has been given. You have additional information relating towards the EBITDA, depreciation, amortization given to us there, the EBIT, the interest, earnings before taxes there. And you also have the 6 month period, inventory, receivables, payables, and bank balances have been given to you right there. You are required to summarize the above data with the following additional sections for the Chief Finance Officer dashboard. Sections for the Chief Finance Officer dashboards, excuse me. Number 1, total profit or loss for the 6 months. Number 2, various profit margins. Number 3, days of purchase using end of year balances, ignore averages. Days of inventory, DOI, using the end of year balances, ignore the averages. Days of sales, DOS, using the end of year balances, ignore the averages. Assume 360 days in a year and that inventory at the beginning of July was 900 million, 8 marks. In the second part of the question, part B, you are required to prepare a CFO's dashboard showing the following charts: revenue and profit, number 1. Number 2, profit margin. Number 3, payables levels. Number 4, inventory levels. Number 5, receivables levels. Number 6, number of days sales outstanding and the number of days payables outstanding. This question is also 20 marks, just like the previous question 21. So let's dive right into it. Solution, as usual, you always do it towards the left. And so we can then start out by now creating the statement, the income statement that is. And so we start by identifying the years. So part A, right over here, put it in braces like that. We are to prepare the relevant data. So here we prepare the relevant data. That. And which data is this? The data relates to the income statement. So summarized profit and loss. Summarized profit or loss. Oh yeah, of course, ladies and gentlemen, we are supposed to start with the revenue. And you can see when we've been given the revenue here. But first, let's put in the years right over here. So we just link it with that value there. Or we can link it like that, manually, like that. But we are not true accountants if we do it like that. This is too manual, guys. It will take. What if you have to go 5 years going like that? Just, repeating that information like so. I mean, it's not the best way to do it like that. How you do it as a professional, you just come over here, highlight all of this information over here, copy, and then you come right over here. Once we've copied this information right over here like so, we can just paste it right over here like so, and we paste special, please. Once we paste special over here, we want to paste the values, because of course we can see 6 months over here, and we transpose it over here, and it comes now across like that. You may see numbers right over here, and we're saying that we can just be able to now format painter over here. Format painter is right over here like that, and we put it in that format that is over there, and you can be able to clearly see that it has actually come exactly the way we want it to appear like that, 2023 from July through to December, right over there. The next information that we need to input, because of preparing the income statement. So here we pick the revenue. So we pick the revenues. You can see the revenues have been given to us right over here. So we just copy these ones the same way, copy, and we put it like so, paste special, that. We're looking at the values, and we say transpose, and we say okay. Transpose means we're putting it from a columnar format into one of the rows, like that. And we put it in the accounting format, like so, that. And then we can now term this as our revenue. So just put it like that here. Of course, these are in millions. Please note, because we've been informed that these are in millions right over here. So we put these ones as millions. We also proceed on to get the cost of sales. We've been given the cost of sales right over here. So we can just sort of put the cost of sales like so, that. And then once we put the cost of sales like that, we just copy this information right over here like that, copy like that, paste, click there first, right click, paste special like that, and then we are pasting the values like so. When you say, okay, we transpose, sorry, remember to check this, to check the box, put it like that, click the comma format, 2 decimal places like that, proper accounting format. That's what we need. Now, then we can move ahead and identify the gross profit, because we've obviously been told to compute the profit margins there. So we'll need to get the gross profit over here. And if you can see the gross profit over here, just to check gross profit, we don't even need to type anything there, because we said we've got the gross profit right over here. We enter like that, and obviously we just know the gross profit is just going to be that value minus that value like that. And you can see it's the same, this value over here, and you can see it's just the same like that. So we just sort of put it like that, drag it like that. This should be boldened true in a true accounting format. You come over here like that, and we also need to put a thick border like that to show that that's a total that's there. And then we proceed on to subtract the expenses. Any expenses, yes, we can see the operating expenses have been given to us right over here. So we just put in the operating expenses like so over here. And we know obviously that they're in millions. We just copy that, copy, and we come over here like this, paste special, we come to values, come to transpose like that, transpose them like that, so they're in millions, so that it can be able to enable us get the operating, the EBITDA. So gross profit less operating expenses, we should be able to give us this EBITDA right over here. So we just link it with that EBITDA right there, like so. And we're saying that we will need to copy these values right here, over here, or in a true accounting way, we just pick the gross profit and subtract that value like that. And you can see 720 is the same as that one there like that. And I'm sure even if I'm to drag it across like that, we should be able to get 670, and you can see 670, 630. The last one is 700, and you can see indeed it is 700 there. We put true accounting fashion, that EBITDA. Then we also proceed on to get the depreciation and amortization, because we've been given the depreciation and amortization right over here, so we need to subtract that. So allow me to just link it with that there. Depreciation and amortization should be like that. And then we fix in, because this is EBITDA, should be boldened, Control B, like that. Depreciation and amortization, we are saying, should be given to us right over here. So if I link it like that, we're not going to link just these values individually. We just want them the way they are right over here. And we paste it right over here, paste special, transpose values, then we transpose that and put OK like that. So that we can be able to get what is termed as now our EBIT, because we've removed depreciation and amortization over here. So it's EBIT, earnings before interest and taxes. Depreciation and amortization we'll have subtracted over here. So we're looking for EBIT right over here. So we link it with that one over here. And we're just saying it's just going to be that value we subtract that value like that. So we shift Control R like that, and you can see the totals have actually come, and these totals are the same as these values over here. You can see the 410 is the last one over here like that, and that means that we are doing as what the examiner is actually telling us to do, to prepare the relevant data in terms of the profit or loss. After the EBIT, which we are right over here, there we need to subtract the interest and taxes right there. So we subtract the interest. It means that we're just going to link it with that one over there like that. And then we slot in the values, because this is also a total right over here. Control B, that. Then we slot in the interest. The interest should be gotten from right here. Copy. And we come right over here, paste special. And we say that these ones are values. We transpose them, right, so, like so. Put them like that. So once we subtract the interest, we should be able to get the earnings before taxes over here. So we should just link it with that on the earnings before tax like that, and you're saying it's just going to be that value we subtract. So the EBIT, we subtract the interest there, so that we can be able to get the 310, and you can see the 310 is actually right over here. Like that. Just cross-check like that. Put it in totals. Excuse me for that. Should be this value should be put in totals. That boldened like that. Now once we have the earnings before tax over here, we can then of course compute. Have we been given information about the taxes? Can we proceed? Do we have anything to do with taxes? It's earnings before tax. Now we've gone to inventory, receivables, payables, cash at bank balances. We don't have the taxes. Do we have a tax rate given to us over here in part A? I don't see any information leading towards taxes here. So we just proceed on directly to get the profit margins. Profit margins, like so. And here we just put Control B like that, the profit margin, because we've been told by the examiner to compute total profit or loss for the 6 months, part 1. Part 2, various profit margins. The various profit margins can be gotten by starting by looking at, we have gross profit. Gross profit over revenue gives us gross profit margin. And we can start gross profit margin. That is gross profit. We pick the gross profit, which you can be able to see right over here, and then we divide that against the revenue, like that. It seems to be 0, no problem. We just click the percentage format here. It will give us 30%. You can see. So if you drag it across like that, those are the gross profit margins for the 6-month period. Then we can be able to compute the EBITDA margin. EBITDA margin, like so. And how do we compute the EBITDA margin? We're seeing that we just pick the EBITDA, which we have over here like that, and then we divide that against revenue, like that. And the EBITDA margin, of course, in a similar fashion like so, we need to first of all put it like that, and the format painter, put it like that, 21%, and if I drag it across like that, we can be able to see indeed the gross profit, the EBITDA margins have been presented to there very well. Proceeding on, excuse me, we can be able to then compute the EBIT margin. The EBIT margin is just going to be these values over here, or just say the EBIT margin. Like that. So just pick the EBIT here over revenue. Like that. We drag it across like that, and of course we just put it in a similar format painter. Come over there like that. Format painters, if we have any others, perhaps now it will just pick from the others. Now I can see we'll also need to get EBT margin. EBT margin. EBT margin, excuse me for this, EBT margin, that, so here we are saying is just going to be the EBT, that one divided by the revenue, EBT margin, that 9%, so shift, control R, that. And those are the margins that we actually need. So right here, I can perhaps put it in form of a well-presented Excel format where I can put in all borders like that, if you prefer like that. Or if you don't prefer it like that, we just leave it the way it was like that. I think it's better the way it was like that. Here is where you can be able to maybe perhaps put in all borders like that. Let's see what we've been told to do. The days of purchase, right over here. So then we will need to proceed on to get the statement of financial position items, because that is what is going to assist us to get the inventory, receivables, and payables, and so on and so forth. So that we can be able to compute the days of purchase, the days of inventory, the days of sales, and so on and so forth there. So we've been told to ignore the averages, and we have further been informed to assume a 360 days in a year, and that inventory at the beginning, July, was 900 million. So that is very key right there. So we come with statement of financial position items right here. Statement of financial position items, like so, yeah. So that we can be able to now, of course, put in the periods. You can just link it with that one there, like that. Over here. Like that. So over here, we'd also need to do the same. Always, it's always good to provide information systematically, because you're saying you're preparing profit margins, but for which years over here? So you need to be indicative of which years you're using right here. So statement of profit and loss, profit or loss, statement of financial position items, excuse me. Here we start by looking at the inventory. We've been given the inventory right over here. We've not been given non-current assets, nothing to do with non-current assets here. So we start with what we've actually been given right there. So we pick the inventory like that, and then we pick the specific figures right here. So copy, paste special values, transpose, you say okay, that. We have also receivables, payables, that, and then we also have cash and bank balances. Of course, these ones you can see they are all in millions. I just need to highlight that, so that even if I might be doing like this, I just need to highlight that. Please make sure that you understand that we're using millions here. And so once we've got that, all of these values like so, so the comma format like that, then I need to move it towards the right like so that you can condense it just a bit, like that. We then realize that we need to pick the receivables over here. So if I pick the receivables, or I pick the entire information here, copy, paste special values, transpose, okay. So you can see they've all been transposed like that, and this is correct because you can see this is 1,200. Over here, the last value is 1340, and over here is 1340. We have the last value is 900, and you can see there the last value is 80, like that. So we need then now to use this information to assist us to get the days of purchase, days on inventory, and days of sales. So from there, what happens is that we then just identify those values over here, days of purchase, as per this. So days of purchase, copy, let's come over here, put the days of purchase like that. Just for consistency, put it like that. Days of purchase, and then days of inventory, and also days of sales. days of inventory. Just copy this up to there. And then the days of sales right here. That up to there. And we need to also, so just sort of put it down here, we need to link it to the years. So this one should be, excuse me, this one should be bolded. Control B, let's see if these ones have been bolded. It's always good to have it consistent. Control B, that, no, it's not bolded, so you need Control B, yeah, now that's okay. This one should also be bolded. Good. So the days of purchase, now we need to link this with the July period like that. So shift that, Control R. So that now when you get the days of purchase right over here, the days of purchase should be gotten based on cost of goods, days of sales. So this is the days of purchase right over here, days of inventory and days of sales here. So that's what we have right over here. So for us to be able to get those figures right there, the days of purchase, the days of those figures right there, we can proceed on to get so we are saying that now to get the days of purchase over here, we'll need to get the payables, we divide by the purchases, and then we multiply by 365. But in this case, we have 360 given to us right over here, as you can be able to see. So what we're going to do, we're just going to pick the payables, which we have right over here. So pick the payables right there, and then we divide by the purchases. Do we have purchases given to us right over here? The purchases, that means we will need to pick the purchases will be based on the combination of 2 of 3 values here. So we pick the cost of sales, we subtract the opening inventory, and then we add the closing inventory like that. So here we divide by, so we'll open the brackets because we're looking for days of purchases. So we're saying that the purchases value, we've already been given right over here, the opening inventory at the beginning was 900 million over here. So we pick the cost of sales. The cost of sales is given to us right over here, 2,400, that. And then we subtract the opening inventory. The opening inventory was the one that we've actually been informed right here is 900 right over here. So 900, that. And then we add now what we're saying, the closing inventory. The closing inventory given to us over here was how much? Closing inventory, you can see the closing inventory rate over here, 980, and this is the inventory which we have put over here like that. We add like that. That is the way we are saying we're going to get our purchases right there. I'll repeat that again. To get the purchases over here, we will need to first of all start from the opening inventory right over here, or from the cost of goods sold. The cost of sales over here, we add the opening inventory, the cost of sales, we add the opening inventory, or we subtract rather, we subtract the opening inventory, which we've been told is right over here, the 900 million, and then we add the closing inventory. The closing inventory as a 31st, as a July, end of July is 980 like that. So that's the value of the purchases over there. And then we multiply that with how many years? 365? No. We've been told 360 right over here. So 360, that, enter. So I'm getting the days of purchases as 104.52. So once we have that, we can then now proceed on to just drag it, because it will pick the values like that, like so. And we are saying that we will need now to make some adjustment right over here, because we are saying that the opening, the cost of goods, so the cost of sales for the year like that is this one over here. And then we need to subtract the inventory itself. So we're saying the inventory, which is going to be, the previous inventory is going to be the 980. So this one should actually come right there like that. That's what you're saying. The closing inventory is this one. As of July 23rd, the closing inventory is 980. But now that 980 becomes the opening inventory where? In August 2023. And like I have said over here, that we will pick the cost of sales, we subtract now the 980, which is going to be now is this one is going to be, I'm going to change this, we subtract this value over here, we subtract that value, and then we add what? We add the closing inventory. The closing inventory is supposed to be not J24, it's not this J24 twice, plus the closing inventory, which is going to be that one there like that. Yes, now that's what I'm saying that we have. I repeat. We are saying that in the first case over here, our opening inventory was given to us here as 900. So for us to be able to get the days of purchases right over here, we will pick, first of all, the payables, and we divide that with the purchases. So how do we get the purchases? The purchases is gotten by getting the cost of sales. We subtract the opening inventory, which we've been given right over here as 900 million over here, and you can see the 900. And then we add the closing inventory, 980. So that's what I'm saying now, even the second year over here. We will pick, to get the days of purchases, we'll pick the payables, that is it here. Payables. We divide that against the purchases. How do we get the purchases? We start with the cost of sales, which is that one over here, K87. We subtract the opening inventory. The closing inventory over here, which was used previously here, becomes the opening in this period over here. So we subtract the opening inventory, and then we add then now the closing inventory right here, which is this value over here like that. And we multiply by 360. So that now we can be able to get the days of purchase there. And now I can be able to confidently come over here and track them like that. So once we have that, then we can be able then to calculate the days of inventory. Next, the days of inventory is given by the closing inventory divided by the cost of sales, and we multiply by 365. In this case, we've got 360. So we're not going to use the 365. So let's put words into action. So the days of inventory, we first of all start by looking at the closing inventory. The closing inventory is this one over here, the inventory given us at this period over here. So we pick the closing inventory, and then we divide that with the cost of sales, and we've got the cost of sales for 2023 as computed right over here, the cost of sales, that one over here, and then we multiply with 365, but in this case we're going to multiply by 360. That. Where do we get the 360? We've been informed right over here we're using 360 days for a year. That. So I'm getting 147. So these ones should also be in whole numbers. It shouldn't be, of course, decimals like that for completeness. So we do not want them in like that. We better put them like that. We drag them, we put them like that. Now finally, we want the days of sales, because we've been called the days of sales right over here. Days of sales. So the days of sales will be gotten by, we'll need to pick the receivables now. The receivables, we divide by revenue and then multiply by 365. In this case, 360 days. Let's put words into action. So we pick because we're calculating the days of sales, we will need the closing receivables here. And then we divide that with the revenue here, and multiply by 360. Not 365, now in this case it's 360. So we just drag it across like that. Of course, we do not want it in that kind of format. We want it in accounting format complete, like that. So this looks presentable now. Like that, we can put like that in form of margins like that. Even this one you can put it in form of margins. Like that. Just make it look presentable like that, appealing to the eye. These ones should be boldened, Control B. And then we are done with part A. We are further informed that we need to prepare a CFO's dashboard showing the following charts: revenue and profit, profit margin, payable levels, inventory levels, receivable levels, the number of days of sales outstanding DSO, and the number of days payables DPO over there. So for the revenue and profit, we just pick that, the period, this period there. We've been told the revenue, pick the revenue, and the profit. Have they said which specific profit? They haven't told us which specific profit, revenue and profit. So for my thinking, we'd pick the earnings before tax there. By here, that. And we insert, of course they're in millions, recommended charts, and we can maybe perhaps develop a chart like this one that's shown over here. And we can decide to put a secondary axis on this, so we change the chart type, so that now we can be able to at least now make sure that this one is maybe close to each other there. Come to combo chart, and we put the earnings before tax, this orange one, as a secondary axis, like that. It looks at least more presentable like that. Revenue and profit. That. Click there. Put it just beside on our left hand side right here. Revenue and profit. Like that. Put it like that. So remember, because we do not know, I could be using the blue one to use this. No. We need to indicate, we need for completeness. We need to make sure that this is the one that we're using, earnings before tax, as the secondary axis over here. So EBT, we put RHS on the original information right over here, earnings before tax. So you can put EBT, and then we put in brackets RHS, like that. So that now you can see here EBT, right hand side. So we're using the orange one to look at that one there. It's 300 at that point over here, not 3,500. No, we're using this point for the secondary axis there. So we are saying that we can proceed on to look at what we've been told to do. Profit margins. So profit margin, we already have the profit margins here. So you can decide to put all of them. Or you can put maybe 2 or 3 of them. It's entirely upon you. I've not said which specific one here. So you can put it like that. Profit margins. Profit margins. In this case, we don't need to put, secondary axis. You can decide to expand it over here, like so, up to there, that point. What else have you been told to do? You've also been told to put payable levels, inventory levels, receivable levels. So we can combine all of those in one chart. Payables, receivables, and inventory levels, could combine that. Insert recommended charts like that, and we put it, perhaps you could change the graph, put it to clustered column like that. And so we are saying that we can then sort of put it like this, right there close by, expand it a bit like that, and we call it inventory, receivable, and payable levels. Inventory, payable, and receivable levels. It's not properly written. Receivable levels, like so. And with that information, we can, so for payable levels, that, and we're saying that we'll need then to also proceed on to calculate the number of days of sales, DSO, number of days of payables, right here, and they are all here. You can see them right here. So just proceed on like that. Insert recommended charts. Just perhaps maybe change the chart type. I put bar chart, and you can put it like so, like that. Come down here, present it like that. The graph should always be labeled. Just call it days of purchases. Of course, we've already provided the description right over here, what DOP means. DOS and DOI, that. So someone should not be able to, at least over here, you should be able to just follow through from this segment right over here. Just to confirm that we've actually answered everything that the examiner has asked us to do. We have done everything on this left-hand side over here. Let's look at it again. You can see the days of sales, days of purchases, days of inventory, inventory, payable and receivable levels, profit margins, revenue and profit. We've also constructed the information that we need over here in a much more presentable format over here, and we have also computed days of purchases, days of inventory, and days of sales. Thank you for being with Manifested Publishers, guys. Bye bye.
To pick the highest value at range. So 17,000 was the most expensive thing. It was a Land Cruiser, Toyota Land Cruiser. Then in the lowest cost, we will use mean function, open a bracket, highlight this, then it gives you the lowest out of those figures. So the lowest was 3,875. Again, you can format this as, because this is currency. Generally with currency, we tend to put two decimal places. So if you look at it, this one has no decimal places, so I can quickly format all of them, select the whole range, then add some decimal places. Okay, so that makes it two decimal places. This one, I can make this two decimal places as well, and format it to have a comma, so I can see clearly where the thousands are, or in some cases, where the millions are. So let me put a comma there as well. Kind of makes it easy to read. Okay. So a number of functions we have reviewed there. Just a quick run through of what we have done so far. If you recall, the duty, we started with the duty. We used the if function. The if function in this case had three parameters, three things inside the function.
Greetings, candidates. Welcome to the study of the subject leadership and management. And in my hand, I have the KASNEB syllabus that was released in 2021. 2021 KASNEB revised syllabus for paper number 13, leadership and management. This paper was renamed from strategy, governance and ethics. And in our today's lesson, I'm going to do an adumbration of this subject. The unit description is as follows. The syllabus reads that this paper is intended to equip the candidate with knowledge, skills, and attitudes that will enable him or her to apply and demonstrate leadership and management skills to grow an enterprise under various circumstances and environments, including under uncertainties. That is the main objective of studying leadership and management. It is to equip the candidate with knowledge, skills, and attitudes that will go a long way to enable the candidate apply and demonstrate leadership and management skills in order to grow an enterprise under various circumstances, various environments, including uncertain environments. The syllabus also lists 5 learning outcomes. A candidate who passes this paper should be able to, number 1, demonstrate an understanding of leadership techniques and management principles. Leadership techniques and management principles. Number 2, apply knowledge of leadership and management theories in organizations. Number 3, effectively undertake management functions. Number 4, make rational management decisions in an organizational context. Then lastly, embrace and manage strategic change. These are 5 learning outcomes. Now, candidates, the content is organized in 12 topics. 12 topics. The first one is Introduction to Management. Number 2, Evolution and Development of Management Thought. Number 3, Leading as a Function of Management. Number 4, Other Functions of Management. Number 5, Environmental Analysis. Number 6, Leadership Approaches and Strategy. Number 7, Decision Making. 8, Enterprise Management. 9, Project Management. 10, Marketing Management. 11, Leadership and Strategic Change. Then lastly, Case Studies in Leadership and Management. Case Studies in Leadership and Management. These are 12 topics. 12 topics. And candidates will be covering each topic at a time. Each topic at a time. For example, the first topic, Introduction to Management, we will study the nature of management, importance of management, levels of management, multidisciplinary nature of management, roles of management as advocated by Henry Mitzbach, the changing roles of managers and management, qualities of an effective manager, management and administration. These are the subtopics under the first topics. Then In topic 2, there are 3 categories of evolution and development of management thought. Is organized in 3 subsections. Number 1 is the classical approaches to management. Number 2, behavioral management approach. Then modern management theories. The third topic, leading as a function of management, will study differences between management and leadership. We'll study attributes and skills of a good leader. We look at the delegation, responsibility, and accountability. Then we will cover power, authority, and accountability. In topic number 4, which is known as other functions of management, we will discuss the planning function, the organizing function, the staffing function, and the controlling function. Topic number 5, which is environmental analysis, we are expected to cover microenvironment, macroenvironment, internal environment, external environment, and tools of environmental analysis. Then in topic number 6, leadership approaches and strategy, we look at the leadership traits, leadership styles, leadership skills, formulation of an organization's strategic direction, differences between transactional leadership and transformational leadership, conflict resolution mechanisms, then ethics in leadership. In topic number 7, we'll discuss the importance of decision-making models, types of decisions, decision-making process, problem-solving skills, decision-making under different conditions, challenges in decision-making, effective, and lastly, effective decision-making. In topic number 8, we are expected to study the meaning and concept of entrepreneurship, entrepreneur development, enhancing creativity and innovation in organizations, methods of generating ideas, introduction to business plan, protection of intellectual properties. That is the last subtopic in the study of enterprise management, protection of intellectual properties. In topic number 9, candidates are expected to cover number 1, project management concepts. Number 2, characteristics of a project. Number 3, importance of projects. Number 4, features of projects and baseline surveys. Number 5, illustration of the project life cycle. Number 6, project planning and organizing. Number 7, project resources and costing. Then lastly, number 8, project completion and evaluation. In topic number 10, known as marketing management, we will discuss the meaning and importance of marketing. We will look at the marketing management orientation and or philosophies. We study the marketing mix. We'll discuss the development of marketing information. Number 5 is the marketing strategies. Then we have marketing research and intelligence. And lastly, international marketing and e-commerce. Topic number 11, leadership and strategic change. We will consider the meaning of change, theories of change, types of organizational change, managing resistance to change, the organizing the change context, levers for strategic change, methods of introducing strategic change, problems of formal change programs, leading change is the last subtopic under leadership and strategic change. Then lastly, there is a case studies in leadership and management. Case studies, we will discuss or look at different case studies in leadership and management. So candidates, these are the areas that you are expected to study in your endeavor to gain knowledge, skills, and attitudes that will enable you to apply and demonstrate leadership and management skills to grow an enterprise. And that should be done under various circumstances you're expected to manage an enterprise under various circumstances and environments, including uncertain environments. So I hope, candidates, you will be joining us in all the lessons. We are going to cover each and every aspect of this syllabus. It is expected that as we go through this syllabus, when you join these classes, make sure you take down notes. If you have questions, you are free to post your questions. Below this syllabus, there is a comment section where you can ask questions. Make sure you also practice active recall. Carry out continuous revision. Over and above the video lectures, we have also developed the study materials, study texts, and revision books based on the revised syllabus that was promulgated in the year 2021. The books are updated and they cover all these areas that we've mentioned. So make sure you study ahead. Study ahead. Always study ahead. Make sure you familiarize yourself with the various aspects of the syllabus, and as we progress with this coverage of this syllabus, make sure you always go back, answer questions, past paper questions, because some of the topics in leadership and management were retained, because I remember I said that this subject, leadership and management, was just renamed. In the old syllabus, the paper was known as strategy, governance, and ethics. There are certain topics that were maintained, like the first one, introduction to management. There is a topic on evolution and development of management thought. Other functions of management were also retained, like the planning function. We covered it in the previous syllabus, organizing function, the staffing function, controlling function, and even leadership approaches and strategy. These are some of the topics that were retained in this current syllabus. All right. The only new topics that were introduced here I can see is enterprise management. Some subtopics are enterprise management. Project management is also a new topic, including marketing management. Though candidates in the old syllabus, when some of us were studying this course, we studied project management and marketing management. These topics have been reintroduced in the syllabus. So you can see, candidates, we have past paper questions from these areas that I've mentioned. So as we progress, make sure you revise, look at the past paper questions from our revision partners. Check our revision partner. We have past paper questions with solutions. So as we progress with the coverage of this syllabus, make sure you carry out continuous revision. Don't wait at the last minute in order to revise. No. Continue revising. When, for example, when you are done with topic number 1, go to the revision books, look at the questions that have been tested in the past under this topic, because in the revision books, we have organized the questions topically. So it's very easy for you to locate questions based on the topic that have been that we are covering in the subject leadership and management. So candidates, thank you for choosing to study with the Manifested Publishers. We endeavor, we plan, we are ready to help you gain the required skills, the required attitudes and knowledge that will enable you meet the objectives that I read here. Remember, by the end of this training, number 1, the syllabus states that you should be able to demonstrate an understanding of leadership techniques and management principles. Number 2, you should be able to apply knowledge of leadership and management theories in organizations. Number 3, you are expected to effectively undertake management functions. Number 4, a student or candidate who passes this paper should be able to make rational management decisions in an organizational context. Then lastly, you are expected to embrace and manage strategic change. It's not just about knowing the principles or memorizing a few concepts. No, at the end of the training, it is envisaged that you should embrace and manage strategic change among the other objectives that I have read. So that is our intention. That is our purpose, to equip you with the knowledge, with skills and attitudes that will enable you to apply and demonstrate leadership and management skills that will enable you to grow an enterprise under various environments or circumstances, including environments and circumstances that are uncertain. So you can see, candidates, the training is not limited to you passing the exam. The skills that you gain here should enable you to demonstrate, to practice, to manage, to apply, to embrace, to make rational management decisions in an organizational context. So thank you one more time, and hope to see you as we continue studying leadership and management. Bye-bye. Hello and welcome back to the platform. Today we continue with the subject Principles of Marketing and Communication. In this lesson, we are going to discuss basic marketing concepts. We are going to discuss 5 basic marketing concepts. But first of all, we need to define the meaning of marketing concepts. What are these fundamental or basic marketing concepts? Now, basic marketing concepts refers to the fundamental business philosophies or ideas that guide how an organization approaches the market, customers, and the selling of its products or services. So these are ideas or beliefs that companies hold that then guide them on how they approach the market. In other words, the basic marketing concepts explain how a firm believes customers behave and how the firm should respond in order to achieve its objectives, such as sales, profit, or growth. You understand, candidates? These are business philosophies. So basic market concepts are business philosophies that guide how an organization approaches the market and its customers. And each concept reflects a different belief about what customers value most. First, you need to understand what these the meaning of basic market concepts, which I have explained. Then we can move into these philosophies or concepts. And one such concept is the production concept. Production concept is the first marketing concept. 1, production. Production concept. I've said there are main 5 concepts. 1 is the production concept. The second one is the product concept. Number 3 is the selling concept. Number 4 is the marketing concept. Then lastly, we have the the societal marketing concept. So those are 5 concepts. But let's first discuss the production concept. Now, the production concept is a belief or a concept that is based on the belief that consumers prefer products that are cheap, widely available, and easy to obtain. You understand? Production is a word that is derived from the word produce, producing, production. So production concept, I repeat, is a concept that is based on the belief that customers or consumers prefer products that are cheap. It is a belief, it is a concept that is based on the belief that consumers prefer products that are cheap and easy to obtain. Products that are cheap, products that are widely available and easy to obtain. So this is a belief that a producer may have or a company may have. So if you are running a company and you believe that consumers prefer products that are cheap or widely available and easy to obtain, then you as the producer, you are going to focus on, your focus will be on mass production. You'll focus on mass production, producing goods en masse. Why? Because you believe that customers prefer goods that are cheap, that are widely available and easy to obtain. So you embark on the process of producing goods in mass. You may also focus on cost reduction. If you are a producer and you believe that customers prefer goods that are cheap, then you have to bring down the cost of the goods that you are selling. So you'll focus on cost reduction because of the belief. Because you always say, candidates, that action is preceded by belief. Before you do something, then you must have a certain belief. Human beings, we are guided by beliefs. Actions stem from beliefs. If you want to know the belief of a person, in other words, you can check the actions or the behavior of the person. So if you come across a company that is producing goods in large quantities, then that is a company that believes that producers or consumers prefer products that are cheap, that are widely available and easy to obtain. So such a companies will engage on mass production, producing goods in large quantities. That will be their focus. They'll also be focused on efficient distribution. Because if you engage in, or if you believe that customers prefer goods that are widely available, then you must have an efficient distribution strategy so that these goods can reach a large number of people. You understand, candidates? And it's not hard to tell the companies that would have the belief that customers or consumers prefer goods that are cheap, widely available, and easy to obtain. So if you know a company that produces goods in large quantities, a company that produces goods that are cheap to obtain, a company that has a wider channel distribution, then that company is being guided by the production concept or the production philosophy, business philosophy. It's a business philosophy. You understand? Yes. Now, a good example is it could be a water bottling company. A water bottling company that focuses on producing large volumes of bottled water at the lowest cost and then distributing it to every shop, distributing it to every kiosk, distributing it to every supermarket, distributing it to every school, distributing it everywhere. And consumers buy it because it is cheap and readily available, not necessarily because it tastes the best. There are times we buy products because they are readily available, right? I'll give an example of bottled water, or it could be beverages and so on. Such companies are operating from the belief that consumers prefer products that are cheap, that are easy to obtain. So if that is your belief, that consumers prefer goods that are cheap, then you will focus on cost reduction, reducing the cost so that these consumers can afford the product or service. Now, one limitation of this the production concept is that companies may focus on, may ignore the tastes of customers. That is the downside of the production concept. Ignoring of the taste of the and preferences and even quality. The concept may ignore customer preferences. They may ignore the quality, because here we are talking about cost reduction. You cannot have a product of high quality when the cost is cheap or when it is being produced in large numbers. So do you understand? So that is the downside of the production concept. So that is one basic marketing concept, production concept. Number two, the second concept is known as the product concept. Product concept or philosophy. Product. Now, the product concept assumes that customers or consumers prefer products that offer the best quality. Consumers prefer products that offer the best quality. Consumers or customers prefer products that offer the best quality. We've seen that the production concept ignores the quality, but the second one here, customers prefer products that offer the best quality. So if you are a producer and you believe that consumers prefer products that offer the best quality, then that will determine how you approach the market. Because you recall, don't forget, candidates, that marketing concepts are fundamental ideas or beliefs, all right, that guide producers on how to approach the market. So if you are a producer and you believe that customers prefer products that offer the best quality, then what will you focus on? What will you focus on? If you believe that consumers prefer products that are of high quality, then your focus will be different from the producer that believes that customers prefer goods that are cheap. You've seen that here, consumers prefer products that offer the best quality, the best performance and features. Let me add that, performance and features. Performance and best features. Now tell me, candidates, if you have such a company that has this belief, then what will be the focus? What will be the focus? What will be the focus? What will this company focus on? Focus. What will the focus? Such a company will focus on what? Tell me. One is continuous improvement. Okay? Continuous. The focus will be on continuous improvement. A good example is manifested publishers. We believe that our customers or our clients prefer products that offer the best quality, performance, and features. That's why we keep on innovating. We keep on coming up with new products. We keep on improving what we offer to the clients. So that's why we focus on continuous improvement, improving the products every day. Such a company also focus on innovation, because you cannot talk of quality without innovation. You have to keep on innovating, improving the product, innovating. You may also focus on superior design. Focus can be on superior design, superior design. And the belief is that consumers will automatically choose the best product. That is the belief. Companies that are driven by the product concept believe that consumers will ultimately go for the product that offer the best quality, performance, and features. That is the belief. They believe that consumers will automatically choose the best. Are you understanding, candidates? Yes. Now, a good example is a smartphone manufacturer that adds high-resolution cameras or powerful processors or premium materials, assuming that customers will buy the phone because it is technologically superior, even if it is expensive. That's why we have phones like the iPhone. iPhone is driven by the product concept. They keep on improving and increasing the prices of the products with the belief that the consumers will automatically go for top quality smartphone manufacturer. Now, the downside or the limitation of this philosophy is that focusing too much on product features may lead to what we call marketing myopia. It may lead to marketing myopia. Marketing myopia, where customer needs such as price or usability are ignored. Because if you focus only on the quality, you may ignore the price, you may ignore other factors. That is the only downside of the product concept. That is the second basic marketing concept. Now let us discuss the third basic marketing concept, which is the selling concept. 3, selling belief or concept. Now, what is this concept? The selling concept is based on the belief that consumers will not buy enough. It is based on the belief that consumers will not buy enough unless they are aggressively persuaded. It is based on the belief that consumers will not buy enough unless they are aggressively persuaded. If you are a company and you believe that consumers will not buy your product unless they are aggressively persuaded, then what will you focus on? Firms who believe that buyers cannot buy enough unless they are aggressively persuaded, then such firms will emphasize one, advertising, aggressive marketing, aggressive advertising, coming up with sales promotions, aggressive sales promotions. We've seen companies do aggressive marketing, sales promotion, moving around the estates with girls dancing on trailers, loud music, banners, aggressive marketing. Those are firms that are driven by the selling concept, the belief that consumers will not buy enough unless they are aggressively persuaded. And aggressive persuasion may be done through advertising, aggressive sales promotion, things like personal selling. We have personal selling and so on. Here, the goal is to push products to the consumers. To push products to the consumers. When you're walking, you meet people telling you about this product, this other product, forcing you to buy, and so on. That is the belief that consumers will not buy unless they are aggressively persuaded. That is the selling concept. Now, the limitation of this concept is that it focuses on short-term sales and may lead to dissatisfied customers and weak long-term relationships. You understand? Yes, that is the selling concept. Then the fourth basic marketing concept is what we call the marketing concept. The marketing concept. The marketing concept states that business success comes from one, identifying customers' needs, two, designing products to satisfy those needs, three, doing so better than competitors. Get it clear, candidates, that the marketing concept. This marketing concept, you are just deriving it from the meaning of the word marketing. You recall we defined marketing here. Marketing begins with identifying the consumer needs. So the marketing concept says that business success comes from, first of all, identifying customers' needs, then designing your products in such a way that those needs are met. Then number three, doing better than competitors. So if you have a company or you are running a company and that is the belief that you have, that for you to succeed in the market, first of all, you have to identify the needs of the customers. You have to design products that meet those needs and also make sure that you beat the competitors. Then there is a certain way you behave in which these other businesses may not behave, who are believing in the product concept or the production concept or the selling concept or and so on. So the marketing concept, that's what it entails. An example is, say, an online learning institution like Manifested that asks students what they struggle with most in exams, then design courses that will address those issues that are raised out of the concerns of the students. Manifested publishers, I repeat, may, if it believes in the marketing concept, if the company believes in the marketing concept, if the company holds that the success of its success will come from identifying customers' needs, then Manifested may ask students what they struggle with, then designs courses with recorded lessons, with flexible schedules and revision support, which leads to high pass rates and repeat enrollments. So the marketing concept focuses on identifying customers' needs. The focus here, the focus is one, identify customer needs. Then you design the products to meet the needs. Then you do better than competitors. You outshine the competitors. So that's the marketing concept. That is the marketing concept. And you can see it is different from these other concepts. Then lastly, number 5, we have the societal marketing concept. Societal marketing concept, number 5. Societal marketing concept, which is an extension of the marketing concept. It goes beyond customer satisfaction and profits by considering the long-term well-being of the society. Here, the societal marketing concept balances customer needs, business profits, and environmental welfare. So it is societal marketing concept. So the other one, number 4, is a marketing concept. Societal marketing concept is an extension of the marketing concept. It goes beyond customer satisfaction and profits. It goes beyond customer satisfaction . It goes beyond customer satisfaction and profits. Because we have seen that the marketing concept here, the focus is on the customer needs, satisfying customer needs in order to make profits, outshining the competitors in order to make profits. That is the marketing concept. But the societal marketing concept, it goes beyond the fact that the company should focus on customer satisfaction and profits, because it, apart from customer satisfaction and profits, it also considers the long-term well-being of the society and considers the long It goes beyond customer satisfaction and profits and considers the long-term well-being of the society, because it balances the customer needs, it balances it balances the customer needs or customer satisfaction, the profits, and considers the long-term well-being of the society. Because customers are satisfied, the business gets profits, but it does not stop there. Because we know the marketing concept stops there, where customers are satisfied and the business makes profit. But the societal marketing concept goes beyond that and also considering the long-term well-being of the society by balancing the needs of the customer, the needs of the business, and the social and environmental welfare. A good example is a company that shifts from, say, printed study materials to digital content in order to reduce paper use while still providing affordable education. Because that benefits the students, it benefits the business, and also benefits the environment. So a company that believes in societal marketing concept will focus on customer satisfaction, the consumers. It will focus on the welfare of the business through profits, but it does not stop there. It also considers the societal and environmental welfare. It ensures that the environment is not polluted, the environment is sustained, and so on. And one advantage of the societal marketing concept is that it enhances corporate image, it promotes sustainability, and also builds trust with the society. So candidates, you can see, these are the 5 basic marketing concepts, which we have defined are fundamental beliefs or philosophies that guide producers on how to interact with the market. They guide how an organization approaches the market, the customers, and the selling of its products. These basic concepts, as you have learned, explain how a firm believes customers behave and how the firm should respond in order to achieve its objectives. And we've given examples as we've been explaining. We started with the production concept, which you have said is a concept that believes consumers prefer products that are cheap, widely available, and easy to produce. If that is the belief that a company has, then the company will focus on mass production, cost reduction, efficient distribution. Then number 2, you have the product concept, where consumers prefer products that offer the best quality, the best performance, and the best features. If a company believes that consumers prefer products that are of high quality, then the focus will be on continuous improvement, innovation, superior design, and so on. The third concept is the selling concept, where consumers will not buy enough unless they are aggressively persuaded. And the focus will be on massive advertising, sales promotion, personal selling, and so on. The marketing concept, on the other hand, focuses on identifying the needs of the customers, designing the products in order to meet these needs, then doing better than the competitors. Then lastly, we have discussed the societal marketing concept, which you say it goes beyond the customer satisfaction and profits and considers the long-term well-being of the society. That is all for today's lesson. Thank you for attending. God bless you. Bye-bye. Greetings to you all and welcome to the lesson. The subject is business and data analytics. We've been studying the first topic, Introduction to Data Analytics. So far, we've done the CRISP, which is an acronym for the Cross-Industry Standard Processing for Data Mining Framework. Under that subtopic, we discussed the data concepts, the conceptual concept, logical concept, physical, and also physical data models. We went through the stages in data life cycle. Then in the second subtopic, we've begun looking at big data and data analytics. We, in our last lesson, defined big data. In our today's session, we're going to describe the 5 V's of big data. The 5 V's of big data. And to remind you, candidates, big data, as the name suggests, is data that is very large. Big data is defined as very large data sets having large, varied, and complex structure, with difficulties of storing, analyzing, and visualizing for further processes or results. So big data is a combination of the unstructured data, the semi-structured data, and the structured data. All right? Big data is a combination of data that is unstructured, semi-structured, and structured. Unstructured, semi-structured, and structured. Do you understand? And big data can be mined to gain insights, leading to predictive modeling and other advanced analytics applications. Big data can also be used to improve operations. Big data can be used to provide customer service. Big data can be used to create personalized marketing campaigns. And all that increases value. Okay? And as an example, big data can provide companies with valuable insights into their customers that can then be used to refine marketing techniques to increase customer engagement and conversion rates. And organizations that use big data have a potential competitive advantage over those that don't have, since they make faster and more informed business decisions as provided by the data. So in our today's lesson, we are going to describe the 5 V's of big data. So by the end of the lesson, you should be able to describe the 5 V's of big data. And these V's also help us to understand characteristics of big data. The V's are: 1, volume; 2, variety; 3, velocity; 4, veracity; 5, value. 5 V's. 1 V, 2, 3, 4, 5 V's. The first one is volume. Volume refers to the quantity of data. Volume refers to the quantity of data. It refers to the amount of data that exists. And volume is like the base of big data, as it is the initial size and amount of data that a company can collect. And if the volume is large enough, it can be considered big data. But we know what is considered to be big data is relative. What is big data to company A may be small data to company B. And may also change depending on the available computing power that is on the market. So volume refers to the quantity of data. Number 2, variety. Variety, on the other hand, refers to data types. Refers to data types. Because we have diverse types of data. We have diversity of data types. An organization may obtain data from a number of different data sources, which may vary in value. Data can be obtained from outside an enterprise, or data can be obtained from within the enterprise. We saw earlier we have unstructured data, which we know is data that is unorganized and comes in different files or formats, such as texts, audio data, we have video format, log files, and so on. We have data that is semi-structured. This is data that may not have been properly organized into specialized repository, but it may have associated information. And it makes it easier to process it as compared to the unstructured data. But structured data, meanwhile, is data that has been organized into formatted repository, meaning that such data is made more addressable for effective data processing and analysis. So there are various data types depending on data that is received from different sources. Data may be in form of text, it may be verbal, it may be written, it may be in video format, data may be in audio format, data may be obtained from without the organization, data can be obtained from within the organization. So this is a characteristic of big data. And I've said data that is structured is easier to process and analyze such data as compared to data that is unstructured. Then thirdly, we have velocity as the third V of big data. Velocity. Now, velocity refers to the time that is taken to process and analyze data. It refers to how quickly data is generated and how quickly data moves from point A to point B. And velocity is an important aspect for companies that need data to move quickly. There may be need to have quick data flow so that such data is available at the right time to make the best business decisions possible. And an organization that uses big data will have large and continuous flow of data that is being created and sent to different destinations. All right? Big data being generated quickly. Big data being processed quickly or sent to different destinations for processing. And we say that data could flow from sources such as machines, such as networks, such as smartphones. Data can flow from sources such as social media. And such data needs to be digested and analyzed quickly. And at times, such data ought to be analyzed real time. And I can also say that it may be better to have limited set of collected data than to collect more data that an organization can handle. Why? Because that can lead to slower data velocities. For what is the point of having big data that is not analyzed or that is not processed? So it's rather you have a limited amount of data that can be processed, that can be digested, that can be quickly analyzed, if possible real time, because at times information may be required, decisions may be required to be made real time. Therefore, data has to be made available for making such decisions. Velocity refers to how quickly data is generated and how quickly data is moved or flows from point A to point B. The fourth V is veracity. Veracity. Veracity refers to the accuracy of data. The accuracy of data. The correctness of data. The quality of data that is gathered. So gathered data could have sometimes missing pieces. Data gathered could also be inaccurate. And it may also not be able to provide real valuable insight. So veracity refers to the level of trust that a leader has in the collected data. Because sometimes data can be messy. Data can be messy, data can be difficult to use. And large amount of data can cause more confusion than insights, especially if such data is not complete. So veracity refers to accuracy, refers to the quality, refers to the trust that the leader has in the information that is gathered. The correctness of data. So data that has missing, that is not accurate, that is data that cannot be relied upon in making decisions. So veracity is a very important feature of big data. Then we have value. Value. Value refers to the value that big data can provide, the added value that big data can provide, and it relates directly to what organizations can do with the collected data. Because big data is only relevant or important if it adds value. Being able to pull value from big data is a requirement, as the value of big data increases significantly depending on the insights that can be gained from them. So it's not enough to have big data. It's not enough to just gather data and have data. The question is such data valuable to the organization? And organizations can use the same big data tools to gather and analyze the data, but how they derive value from that data should be unique to them. All right? So here data refers to the quality of data. The value, this we said refers to the quality of data. This is value added. Veracity refers to the quality of data. The quality of data. The accuracy of data. So, candidates, these are the 5 V's of big data. 5 V's of big data. The first V, volume. Volume. The second V, variety. The third V, velocity. The fourth V, veracity. Then lastly, value. We've said volume refers to the quantity, the amount of data. Variety refers to the data types, which could be unstructured, semi-structured, or structured. We say that data comes in different types, could be in different formats: audio format, text format, video format, log files, and so on. Velocity refers to the time that the organization takes to generate big data and to process or analyze big data. Veracity, on the other hand, refers to the accuracy or quality of big data. Veracity. Then lastly, value, which we've said refers to the value that big data can provide. We've said that it relates directly to what organizations can do with the data that is collected. We said collecting data is not enough. What is important is what value do you derive from the data that has been collected? And that brings the lesson to an end. The objective of this lesson was that by the end of this lesson, you, the learner, should be able to describe the 5 V's of big data, and that will form the basis of our today's assignment. Describe the 5 V's of big data. Thank you for attending this lesson. I hope to meet you in our next lesson. We'll continue to share knowledge in business and data analytics. Thank you. God bless you. Bye.
Just a recap of what we were saying when you talked about digital content monetization. We basically say that offering for payment, entertainment, you can offer entertainment for payment, social, literal, or artistic, or education material through what you call electronic media or channel. So say digital content monetization refers to offering for payment, entertainment, offering for payment, that is entertainment, offering for payment, that is entertainment, offering for payment, that is entertainment, a social, we have the literal, artistics, or we can say, or what do you offer? Other materials, we say other materials, electronically, we call it electronically through any media, through what we call any media, any medium, or channel, So that is what we call digital content monetization, when you offer entertainment through electronic media for payments, that is digital content monetization, like the musician. And then we can talk about in the following forms. In what forms? In the following forms. What are these forms that we talk about, What are these forms that we offer them for payment? We know that fees earned from crowdfunding, what you call fees and from what you call crowdfunding, That is one of the forms, fees earned from crowdfunding. licensing of content, licensing of content, or what you call the photographs, photographs, licensing of content, including what you call the photographs, music. When you license them for payment, that is one of the form. Payment to content creator, payment to content creator, payment to content creator for promoting. We say for promoting what you call a brand. Payment to content creator for promoting what you call a brand. A payment that is done to the content creator for promoting a brand. We can also talk about advertisements. We have what you call number 4, advertisements. Advertisements. What you call advertisements? Advertisements on websites, on what you call websites, advertisements that are basically made on website, and social media platforms, and social media platform, and social media platform, what you call the social media platform, by partnering, by what you call partnering, coming into partnership, coming together with other people, with brands, by partnering with brands, by coming together with brands, including endorsements. And to say including endorsements. So what are the forms of what you call entertainment, social, literal, artistic? They come in the form of advertisement on websites and social media where you partner with a brand, or payment to a content creator for promoting a brand. And we can also talk about what you call subscription, payment to access, what you call subscription payment, what you call the subscription payment to access. We say to access what you call content, to access what you call a content of a content creator, to access a content of a content creator, to access a content of a content creator, including the membership, where we have platforms where these content creators have exclusive membership, including what you call exclusive membership programs, including exclusive membership programs, including what you call exclusive membership program. But lastly, as we discuss, we can talk about what you call affiliate marketing. Very common, affiliate marketing, where influencers paid every time they fan likes a product. Affiliate marketing, where an influencer is paid that every time a fan clicks the product they are promoting. That is also a form of monetization. When you talk about entertainment. Then we go to challenges. A very common question you can be asked: challenges. We talk about challenges facing implementation of the digital taxes. Challenges. What you call challenges faced by government. Challenges faced by government, faced by the government, in taxing, what do you call in taxing? Digital, we call it the digital, in taxing the digital economy. What are some of the challenges that basically government face in the quest to tax what you call the digital economy? challenges that the government basically faces in taxing what you call the digital economy. One of the issues is what you call enforcement. What you call enforcement. Enforcement. How do we enforce the digital platform? And that is tax authorities are faced with challenges of enforcing compliance in taxation, especially on digital platform, enforcing what you call compliance on in taxation of the digital platform because of borderless nature of digital transaction. Why? Enforcement difficult because of what you call borderless enforcement difficult because of the borderless, what you call the borderless enforcement difficult because of what you call the borderless digital borderless nature of what you call digital transaction, borderless nature of the digital transaction. Enforcement basically is difficult because of what you call the borderless nature of getting the borders of where it lies, borderless nature of the digital transaction. We also have what you call identification of the tax base. Number 2 is what you call identification of what you call the tax base. Identification of what you call the tax base. Identification of what you call the tax base. For example, intangible nature of digital products. Intangible nature of digital intangible nature of the digital products and services. Intangible nature of the digital products and services makes it difficult to quantify, makes it what they call difficult to quantify. Makes it very difficult to quantify, make it difficult to quantify the value, what they call the value of the tax base. Makes it very difficult to quantify the value of the tax base. Makes it very difficult to quantify the value of what you call the tax base. And say lack of location. Lack of what you call location. Lack of location. What you call the lack of location. And when you talk about lack of location, digital economy present challenge in difficult identifying. Challenges in identifying. We say in identifying. The challenges basically, in identifying the locality of business, identifying the locality of business, where is the business located, locality of business for the SAM, or business for site visit, by revenue authority. Because platform we can have even foreign companies on those platforms. So identifying location by revenue authority stroke what you call officer authority stroke office or officers stroke officers. Then we call what you call profit shifting. Lastly, we have what you call profit shifting. Lastly, we have what you call the profit shifting. So digital transactions are usually associated with the international organization who can use complicated transaction, to shift profit to country with low tax rates, to shift the taxes. When you talk about the digital platform, we know that digital platform is basically composed with international organization. And this international organization, basically, they can shift the taxes to countries with low tax rate. That is what we call the profit shifting. And lastly, we have what we call tax jurisdiction. What we call the tax jurisdiction. Tax jurisdiction. What we call the tax jurisdiction as the last challenge. Digital economy allow business. We know that allow business to operate. We say to operate in what we call multiple countries. Basically allow a business to operate in what we call multiple countries without physical presence. Without physical presence. That you can operate in even 5 countries without physical presence, and say this basically, we say that this brings, where do you take the tax? This brings a challenge of allocating. Challenge brings a challenge of allocating what we call a tax rights. Allocating what we call tax rights, because you can be operating in multiple countries. So where are the tax rights? Which country does it go to? So those are some of the challenges that are basically enforced by the digital economy. In as much as our quest is to have the digital economy, because we know that the digital economy basically increases the tax base. These are some of the challenges that basically emanate from the digital economy. That is how we basically handle what we call the digital taxes.
Hello learner, welcome to Manifested eLearning platform. My name is eLearning Ngwiri, and today, ladies and gentlemen, we are discussing business and data analytics December 2024, and focus will be on question 21. Let's read through together. Workwe Limited is a public entity which has grown in recent years by acquiring established business entities. The directors of Workwe Limited have identified 2 potential entities targeted for a takeover. The directors believe that the shareholders of the 2 target companies would be receptive to a takeover. As a prerequisite to the takeover decision, the directors have tasked a firm of consultants to carry out a cross-sectional analysis of the financial statements of the 2 potential target companies which operate in the same industry sector. The financial statements of the 2 entities as of 30th September 2024 are shown below. The statement of profit or loss for the year ended 30th September 2024, you can see for the 2 companies, and this is an abridged profit or loss statement for Remi Limited and Pepino Limited. We also have an abridged statement of financial position as at 30th September 2024 for both Remi and Pepino Limited. So we have the assets, the current assets, the total assets. We obviously know that the total assets should equal to the total equity and liabilities. We also have now the equity, non-current liabilities, current liabilities, and total equity and liabilities. You are required A, common size statements of profit or loss for the 2 entities for the year ended 30th September 2024. B, common size statement for the financial position as at 30th September 2024. And C, advise the directors of Workwe Limited on the best company for takeover. And just as the way we've been doing in terms of the developing solutions, we will move towards the right over here so that now we can be able to develop the solutions together. And so right over here, I can be able to just talk about Remi Limited percent over here. So you can just pick this component like that. Remi Limited. Of course, I will maybe perhaps just need to move it towards the right here so that we can visualize it better, like that. And we talk about the percent. That. So once we have that, then we can bolden this, Control B, and then on the right over here, we are saying because we have both Remi and Pepino Limited like that given to us over here, they can just maybe perhaps squeeze it right over here through. I hope you don't mind like that, because we can be able to see everything given to us right over here. So we just push this, or rather, excuse me for that, we just push this one up to somewhere there like that. So what we'll do, because we're conducting what is called a common size statements for profit or loss for the two entities, we are going to hold the revenue constant. Meaning that if I pick the revenue and divide that against the revenue, which is going to be common size statement over here, and we lock the denominator F4 like that, we are going to be realizing a percent. So here we are saying if I can just allow me to maybe perhaps put it as a percentage like that, now it shows me 100% because it's following side by side to each other, Remi and Pepino Limited. I can just then drag it. You wait for that plus sign like that. You see, this is the white plus sign. The bottom right hand. Until you get that plus sign that looks like that, you can just drag it across like that. But you see, there's one thing that you need to change, because you're seeing we are holding this one constant. So we will need then to drag this one to that part right over there. So it can be C17 over $C, $17 like that, so that can represent 100%. And if we drag now this going down like so, you can be able to see what happens right there up to that point. So this part is the profit for the year. Profit for the year divided by the revenue over there gives us 14%. And even right over here, we are saying that if you divide the for Pepino, profit for the year divided by the revenue gives us that percent like that. And that's what we are required to do for part A. So statement of profit or loss and percent, rather the common size statement for profit or loss. Part B, so we can be able just write over here, A, put it in form of a bracket like that. And then now we move on to B over here, B, like so. And we are saying that with part B, we are supposed to do the same common size statements for financial position, for the statement of financial position as at 30th September 2024. So now in this case, what we're going to do, we are going to hold the total assets as our reference point now. So we're going to base it on the total assets here. So we do the same, we just pick Remi Limited, like that, copy from there, wait for that plus sign that looks black, like that, drag it like that. And then we also drag, when we wait for it to be black, this is white, our cross should be black, we just drag it down like that, so percent. So we can be able perhaps to put it to merge, to center it like that. And even this can also be centered, you can center it like that. And we can bolden it, Control B, like that. So for part B then, we are saying, since we know that now we are holding the total assets as our constant right over here, we can start by looking at maybe perhaps just for completeness sake over here, we can put in these values right here. Like so, it's always good to be complete. We're preparing these financial statements for the second person in mind. That. So the revenue, we are basing it as a percent like that. So even if we move it towards the right like this, at least you can even see that the revenue percent is given over here. The cost of sales is given to us over here like that. Gross profit as a percentage of revenue, you can see 24% and so on and so forth. But the way it was before, like so, no one would know exactly what we're talking about over here. We are preparing this, and I emphasize on this, for the second person in mind. So let's do that also for this statement of financial position. And so I'll do the same. First of all, let me get the ratios over here like this. I pick the ratio right over here. Which ratio am I talking about? I'm picking the property, plant and equipment. So that value, picking the PPE, and I divide that against the total assets right here. The figure is right over here, like that. And I lock that value. So F4. For some laptops or some PCs, you'll need to press function button. Fn, F4. I've always emphasized on that. So you can see it's 29% right there. And if we were to drag it, or we were to do the same for Pepino Limited, right over here, we'd pick the one for Pepino Limited, we'd pick this one right over here, Pepino, and divide that against the total assets, which you can be able to see is right over here. Oops, excuse me, it's not that one. I'll need to pick the correct value. Seeing we're talking about this value here, the property, plant and equipment. It's that value there. And we divide that against these total assets right over here, and we lock that. We're getting 16%. So now that we have that, allow me to, just pick the entire values, these values right over here. We talk about property, plant and equipment right over here like this, up to this part right here. So copy, drag it down like so. So these are the total non-current assets. Over here we're going to talk about, so I'll drag it just moving down like so. See 0%. And over here we can put total non-current assets. Total non-current assets. Assets like that. And then, of course, we bolden this, Control B like that, and then once we drag it down, it will obviously pick. It will pick what? It will pick the percentages like that. If you double click it, you can see the total non-current assets is right over there. We do the same for the inventory. So we will pick the values right over here, just down below over here. So you can talk about current assets, so non-current assets. So always good to be complete like that. That's non-current assets, and this of course will be the values there. So down over here we pick the current assets like that, enter, and because it's picking from there, so you can just drag it sort of like that, total assets like that, and then we'll pick the values. So we start with inventory, so Control B, that we pick the values, we pick the inventory percent, so this is the inventory right over here, we divide that against this total assets figure that is right over here, and we lock it, F4, that it's 17%, and we pick it like so. As you can see, it's 100%. So it's 100% over here because we're basing the PPE, the owned plant, the rights of asset, trade receivables, whatever that is there under the non-current assets section, the current assets section, and we divide it by the total assets. So this should naturally be 100%. So even if I'm to do the same for here, for the inventory, now for Pepino Limited right over here, it's the inventory and I divide by the total assets right over here and I lock it, F4. It's 18%. Then we drag it down like so, and you can be able to see it is totaling to 100%. So this is the part where we need to put double underline. We need to double underline as true accountants. We need to do that, and also this value right over here for the total assets right over here, I need to put it as I put bottom border like that, so that now it can show that that is coming to be a total like that. Total assets, Control B. Now we do the same for the equity and liability section. It will always be based on total assets like that. And we are saying that because it's based on the total assets, because of course the total assets will have to balance. This value has to balance with that value there. So for this part, I can be able to just come down here and come to equity and liabilities. So just come to equity. Where was it? Equity, right there. This, and then I can just drag it down like this, like that. And then we proceed on to get the percentages. So the percentage. So this is control B, bold and that. So you're getting the ordinary share capital. The ordinary share capital, I'll pick the ordinary share capital, which is right over here for Remi Limited. And you can see it's right over here. And I divide that against, I can either divide it against the total equity and liabilities right down over here, or the total assets. But we're saying that the total assets is our, it has to balance with the total equity and liabilities. So I divide that against that component right there, and I lock it. That, so you can see it's 10%. Drag it down to total equity, and I can see that that's what I'm getting as total equity. If I'm to do the same now for Pepino Limited right over here, I'll be able to just do the following right over here. We're not dealing with the inventory, we're dealing now with the ordinary share capital. It's that value, and I divide against the 66,500, and I lock it like that so that it remains stationary. Like that. So here, I just put sort of the bottom border like that. So that's the total equity. And then I'll need then to now analyze the rest, the remainder, non-current liabilities. So if I pick the non-current liabilities right here, like so, oops, excuse me, I just drag it down, the non-current liabilities, like so. Like that. So until lease liabilities, until trade, until right here. So I need to insert here, down, so that now it can create a space. So these are the non-current liabilities, control B, and these are the current liabilities, control B, like that. The non-current liabilities, we talk about the lease liability. Lease liability is right here. For, we're talking about Remi Limited. Lease liability is that we divide that against the total assets value there. We lock it. And then we drag it down like so. But here we're also seeing there's going to be 10% loans. So we are saying that it should be in percentage form. So this may not, it should be, we should continue down like that and put the percent. Yeah, you can see now it becomes better, 47%. And then if I drag this one across like that, of course, it's not going to give us the correct values because you're saying that we've locked this one in. What I'll do, I'll just drag that one over there like that. And once I drag it like that, then now it will give us, rather, this one will give us the correct value because it's that, this value over the blue over the red. What am I talking about the blue? I'm talking about the lease liability divided by the total assets for Pepino Limited right over there. And once I've corrected that, if I drag this one down, it will actually correct everything like so. So what about then the current liabilities right over here? We're talking about the current liabilities being, or the trade payables, specifically the trade payables. We pick the trade payables right over here. Trade payables, we're talking about right over here. That value, and we divide by that value, like that, and we lock it. So we drag it down like so. And here we talk about the total equity and liabilities right over here. Of course, this one should be bold and control B like that, and of course double underline. I want it at top and bottom double underline. So this one will be for Pepino. This is for Pepino percent. We're talking about trade payables for Pepino. It's that one over total assets there, and we lock it 11%. Should continue. I should have continued downwards. Yes, it should be like that. And then I format painter, come over here so it can be consistent like that. Now, that is part A and B. As you can see here is B. Control B. Let me bolden that. Control B. The examiner wanted us to conduct what is called a common size analysis for both statement of profit or loss, the two entities, common size statement for financial position as of 30th of September. Obviously, it has to be for the two entities there. And in part C, we're supposed to advise the directors of Workway Limited on the best company for takeover. And what we can see now, based on that, based on these common size statements right over here, we can see that the best company for takeover is Remy Limited. Why? Because it has a lower cost of sales ratio. And cost of sales ratio is going to be something good. This cost of sales ratio, because it represents a cost which magnifies the gross profit. And to some extent, even if we may have administrative expenses being slightly lower or even higher, the operating profit is also high. And we're also talking about profit before tax is higher than Pepino Limited. As well, we're also saying that the profit for the year is much higher for Remy Limited as compared to Pepino Limited. So in part C, we can come over here and say that, control B, and we mention something right there, that the best company for takeover is Remy Limited, because it has a lower cost to income sales cost of sales ratio, cost of sales ratio as compared to Pepino. So that's the statement that control B, like that. So all I just want to be bold and is that one. That's all I just want. The best company for takeover is Remy Limited because it has got a lower for takeover. Is Remy Limited because it has a lower cost of sales ratio as compared to Pepino. And you can see cost sales ratio over here. So this one should also be bolded, control B, and then you put a double underline like that, because you can see the cost of sales ratio is much lower. That helps it to magnify the gross profit right over here. And having said that, this brings us to the end of today's question 21, where we were discussing about the Workway Limited, which came in December 2024. We are here for you, and thank you for being with Manifested Publishers.
Greetings to you all and welcome back to the lesson. Today we are continuing with the subject strategic management. We've been studying business strategies and models. We've covered the generic competitive strategies. Today we move to the interactive strategies. Now, in studying interactive strategies, we are going to consider the interactive price and quality strategies. Then there is the cooperative strategy and the game theory. But first of all, what do we mean by interactive strategies? Interactive, from the word interact, to interact. Interactive strategies refer to a competitive framework where a firm's strategic choices are made based on the anticipated actions and reactions of other market players. This is unlike the generic strategies which focus on internal positioning. Greetings, candidates. Welcome to the study of the subject leadership and management. And in my hand, I have the KASNEB syllabus that was released in 2021 KASNEB revised syllabus for paper number 13, Leadership and Management. This paper was renamed from Strategy, Governance and Ethics. And in today's lesson, I'm going to do an adumbration of this subject. The unit description is as follows. The syllabus reads that this paper is intended to equip the candidate with knowledge, skills, and attitudes that will enable him or her to apply and demonstrate leadership and management skills to grow an enterprise under various circumstances and environments, including under uncertainties. That is the main objective of studying leadership and management. It is to equip the candidate with knowledge, skills, and attitudes that will go a long way to enable the candidate apply and demonstrate leadership and management skills in order to grow an enterprise under various circumstances, various environments, including uncertain environments. The syllabus also lists 5 learning outcomes. A candidate who passes this paper should be able to, number 1, demonstrate an understanding of leadership techniques and management principles. Leadership techniques and management principles. Number 2, apply knowledge of leadership and management theories in organizations. Number 3, effectively undertake management functions. Number 4, make rational management decisions in an organizational context. Then lastly, embrace and manage strategic change. These are 5 learning outcomes. Now, candidates, the content is organized in 12 topics. 12 topics. The first one is Introduction to Management. Number 2, Evolution and Development of Management Thought. Number 3, Leading as a Function of Management. Number 4, Other Functions of Management. Number 5, Environmental Analysis. Number 6, Leadership Approaches and Strategy. Number 7, Decision Making. 8, Enterprise Management. 9, Project Management. 10, Marketing Management. 11, Leadership and Strategic Change. Then lastly, Case Studies in Leadership and Management. Case Studies in Leadership and Management. These are 12 topics. 12 topics. And candidates will be covering each topic at a time. Each topic at a time. For example, the first topic, Introduction to Management, we will study the nature of management, importance of management, levels of management, multidisciplinary nature of management, roles of management as advocated by Henry Mintzberg, the changing roles of managers and management, qualities of an effective manager, management and administration. These are the subtopics under the first topics. Then in topic 2, there are 3 categories of evolution and development of management thought. Is organized in 3 subsections. Number 1 is the classical approaches to management. Number 2, behavioral management approach. Then modern management theories. The third topic, leading as a function of management, will study differences between management and leadership. We'll study attributes and skills of a good leader. We look at the delegation, responsibility, and accountability. Then we will cover power, authority, and accountability. In topic number 4, which is known as other functions of management, we will discuss the planning function, the organizing function, the staffing function, and the controlling function. Topic number 5, which is environmental analysis, we are expected to cover microenvironment, macroenvironment, internal environment, external environment, and tools of environmental analysis. Then in topic number 6, leadership approaches and strategy, we look at the leadership traits, leadership styles, leadership skills, formulation of an organization's strategic direction, differences between transactional leadership and transformational leadership, conflict resolution mechanisms, then ethics in leadership. In topic number 7, we will discuss the importance of decision-making models, types of decisions, decision-making process, problem-solving skills, decision-making under different conditions, challenges in decision-making, effective, and lastly, effective decision-making. In topic number 8, we are expected to study the meaning and concept of entrepreneurship, entrepreneur development, enhancing creativity and innovation in organizations, methods of generating ideas, introduction to business plan, protection of intellectual properties. That is the last subtopic in the study of enterprise management, protection of intellectual properties. In topic number 9, candidates are expected to cover number 1, project management concepts. Number 2, characteristics of a project. Number 3, importance of projects. Number 4, features of projects and baseline surveys. Number 5, illustration of the project life cycle. Number 6, project planning and organizing. Number 7, project resources and costing. Then lastly, number 8, project completion and evaluation. In topic number 10, known as marketing management, we will discuss the meaning and importance of marketing. We will look at the marketing management orientation and or philosophies. We study the marketing mix. We'll discuss the development of marketing information. Number 5 is the marketing strategies. Then we have marketing research and intelligence. And lastly, international marketing and e-commerce. Topic number 11, leadership and strategic change. We will consider the meaning of change, theories of change, types of organizational change, managing resistance to change, the organizing the change context, levers for strategic change, methods of introducing strategic change, problems of formal change programs, leading change is the last subtopic under leadership and strategic change. Then lastly, there is a case studies in leadership and management. Case studies, we will discuss or look at different case studies in leadership and management. So candidates, these are the areas that you are expected to study in your endeavor to gain knowledge, skills, and attitudes that will enable you to apply and demonstrate leadership and management skills to grow an enterprise. And that should be done under various circumstances. You're expected to manage an enterprise under various circumstances and environments, including uncertain environments. So I hope, candidates, you will be joining us in all the lessons. We are going to cover each and every aspect of this syllabus. It is expected that as we go through this syllabus, when you join these classes, make sure you take down notes. If you have questions, you are free to post your questions. Below this syllabus, there is a comment section where you can ask questions. Make sure you also practice active recall. Carry out continuous revision. Over and above the video lectures, we have also developed the study materials, study texts, and revision books based on the revised syllabus that was promulgated in the year 2021. The books are updated and they cover all these areas that we've mentioned. So make sure you study ahead. Study ahead. Always study ahead. Make sure you familiarize yourself with the various aspects of the syllabus, and as we progress with this coverage of this syllabus, make sure you always go back, answer questions, past paper questions, because some of the topics in leadership and management were retained, because I remember I said that this subject, leadership and management, was just renamed. In the old syllabus, the paper was known as strategy, governance, and ethics. There are certain topics that were maintained, like the first one, introduction to management. There is a topic on evolution and development of management thought. Other functions of management were also retained, like the planning function. We covered it in the previous syllabus, organizing function, the staffing function, controlling function, and even leadership approaches and strategy. These are some of the topics that were retained in this current syllabus. All right. The only new topics that were introduced here I can see is enterprise management. Some subtopics are enterprise management. Project management is also a new topic, including marketing management. Though candidates in the old syllabus, when some of us were studying this course, we studied project management and marketing management. These topics have been reintroduced in the syllabus. So you can see, candidates, we have past paper questions from these areas that I've mentioned. So as we progress, make sure you revise, look at the past paper questions from our revision partners. Check our revision partner. We have past paper questions with solutions. So as we progress with the coverage of this syllabus, make sure you carry out continuous revision. Don't wait at the last minute in order to revise. No. Continue revising. When, for example, when you are done with topic number 1, go to the revision books, look at the questions that have been tested in the past under this topic, because in the revision books, we have organized the questions topically. So it's very easy for you to locate questions based on the topic that have been that we are covering in the subject leadership and management. So candidates, thank you for choosing to study with the Manifested Publishers. We endeavor, we plan, we are ready to help you gain the required skills, the required attitudes and knowledge that will enable you meet the objectives that I read here. Remember, by the end of this training, number 1, the syllabus states that you should be able to demonstrate an understanding of leadership techniques and management principles. Number 2, you should be able to apply knowledge of leadership and management theories in organizations. Number 3, you are expected to effectively undertake management functions. Number 4, a student or candidate who passes this paper should be able to make rational management decisions in an organizational context. Then lastly, you are expected to embrace and manage strategic change. It's not just about knowing the principles or memorizing a few concepts. No, at the end of the training, it is envisaged that you should embrace and manage strategic change among the other objectives that I have read. So that is our intention. That is our purpose, to equip you with the knowledge, with skills and attitudes that will enable you to apply and demonstrate leadership and management skills that will enable you to grow an enterprise under various environments or circumstances, including environments and circumstances that are uncertain. So you can see, candidates, the training is not limited to you passing the exam. The skills that you gain here should enable you to demonstrate, to practice, to manage, to apply, to embrace, to make rational management decisions in an organizational context. So thank you one more time, and hope to see you as we continue studying leadership and management. Bye-bye. I welcome you once again to the Manifested eLearning platform. The subject is Principles of Marketing and Communication. Today, we are proceeding with the first chapter, and we are going to learn the importance of marketing. That is our focus for today. We will be discussing the importance of marketing, and therefore, by the end of this lesson, we should be able to explain the importance of marketing. If you recall, in our last session, we defined 3 key terms of marketing. One being market, number 2, marketing, and market research. We defined a market as a group of all the actual and potential buyers of a particular product or service. We went ahead to define marketing as the process through which organizations identify customer needs, engage customers, and also build strong relationships by creating value for customers in order to earn value in exchange. So that's the meaning of marketing. Today we want to discuss the importance of marketing. And marketing, we know, is vital to both business organizations and also the economy, and it performs various roles. And the first role or importance of marketing is identifying customer needs. 1, identifying customer needs. That's one reason why marketing is important. Identifying customer needs. Marketing helps organizations understand what customers want through market research and feedback. For example, by providing or studying customer preferences or income levels, or by studying tastes and buying behavior, organizations are able to design products and services that meet real market needs rather than guessing. So instead of guessing, a company can, through marketing, identify customer needs. For example, an institution like Manifested Publishers, which offers KASNEB online tuition, may survey students to know their preferred study times and course formats. And the course format could be online format or physical format. And that ensures that services meet students' needs. So instead of just guessing what students may want, marketing may help the organization to first identify the needs of the customer, then develop products that meet the needs that they have been identified. So that's one reason why marketing is important. Identifying customer needs. Number two is creating awareness. Marketing creates awareness. Marketing informs customers about the existence, the features, and even the benefits of products and services. And that can be done through advertising, through promotions, through social media, and marketing with the products of the company, creating awareness. You recall we did mention that marketing is very broad in scope, and it includes not only identifying customer needs, but it extends to promotion, to distribution, and so on, including customer relationship management. So through marketing, the organizations or companies can create awareness of their products. They can create awareness of the features of the products, the benefits of the products, and so on. You understand? For example, advertising the KASNEB online tuition or classes on social media platforms helps students become aware of the available courses and the enrollment periods. I know some of you came to know about Manifested through marketing. Manifested may have done marketing on social media, which caused you to know the existence of the products at Manifested Publishers. So that's one reason why marketing is important. Creating awareness. Creating awareness. Number two or three, marketing promotes profitability and sales. Promotes profitability and sales. If you are running a company and you want to increase your profits, that can be done through marketing. Effective activities stimulates demand. Effective marketing activities can stimulate demand. You understand? Yes. Marketing activities can stimulate demand, leading to increased sales, leading to increased profits. Effective promotion, pricing, effective distribution strategies encourage customers to purchase products, which then improves the revenue and business growth. The company may offer discounts on say television, on if it's a company that is selling televisions, the company may offer discounts on the televisions or any kind of product, which then promotes profitability and sales. Number four, marketing facilitates exchange. Facilitates exchange. This is exchange of value. Marketing links producers and customers, which then enables the exchange of goods or services for money. The value that the customers get from the product would be from the companies is it's a products or services. The companies sell value in form of products or services, and the companies receive money or loyalty in exchange of the products that are sold to the market. So through marketing, there is that exchange of value between producers and the consumers. You understand? Through proper distribution channels, through pricing and communication, marketing ensures products reach the right consumers at the right time. The products reach the consumers at the right time. That is one reason why marketing is important, because you know there are times when you may have products and the products may not be needed at certain times. The products may come late or even later when the need has already been met, or when the times are not for the products to be consumed. For example, online platforms allow students to register, to pay, and also access study materials, which makes the exchange process very smooth and efficient. So marketing facilitates exchange of value. Number 5, encourages innovation. Marketing encourages innovation. And how does marketing encourage innovation? Now, marketing feedback drives product improvement. It drives product development of new products. You understand? When you get feedback from the market, because marketing involves also studying the needs of the customers. When the company studies the needs of the customers, the company gets ideas on how to improve their products, and that encourages innovation. Product development is made possible through marketing because of the feedback that the company gets from the customers. The company may also receive complaints from the customers. Customer complaints, suggestions, and also the changing tastes may guide the business in improving existing products or introducing new ones. For example, students requesting recorded lessons may lead to the introduction of pre-recorded video lectures. You understand? A company may introduce pre-recorded video lectures as a way of responding to feedback from the students. So that encourages innovation in form of coming up with the pre-recorded lessons. Then the 6th reason why marketing is important is that it enhances customer satisfaction. Marketing enhances customer satisfaction and customer loyalty. Through marketing, customers may become loyal to a company, or they may be satisfied with the products or services that are offered. Marketing helps build long-term relationships with customers. Through marketing, a company can build long-term relationship with its customers. For example, by meeting expectations and offering, say, after-sales support, firms create satisfied customers who remain loyal and make what we call repeat purchases. So through marketing, customers get satisfied, and that leads to customer loyalty. That's why marketing is critical. You understand? 7, marketing supports economic development. And how does marketing support economic development? Now, marketing contributes to overall economic growth because it creates demand for goods and services, leading to increased production, and increase in production leads to increased employment. It leads to income generation. Increased production may also lead to tax revenue. You understand? For example, at Manifested, because of the introduction of online educational classes or services, that has created jobs for lecturers, it has created jobs for video editors, it has created jobs for the support staff, and that in itself increases what we call or supports economic development. We have IT support staff, we have content creators who are then graphic designers who contribute towards economic development. So these are 7 reasons why marketing is important. Today we've studied the importance of marketing. One is that marketing identifies customer needs. Through marketing, the consumers get to know about the existence of products, the features of the products, and so on. Number 3, marketing promotes profitability and sales. Number 4, marketing facilitates exchange of value between the producers and the consumers. Number 5, marketing encourages innovation. And this innovation is made possible as a result of receiving feedback from the market. When companies receive feedback from the market, from customer complaints, from customer suggestions, that drives innovation. Then 6, marketing enhances satisfaction and loyalty of customers. And lastly, marketing supports economic development. So these are 7 reasons why marketing is important. Thank you for attending the lesson. In our next session, we continue with our lesson on marketing and communication. Bye-bye.
Hi candidates, welcome to another session of Manifested Online Classes. We are still continuing the topic of group accounts, and in this session I want us to look on different types of group structure, and basically how we go ahead and prepare the consolidated financial statement in case of those different types of group structure. Now generally we have 2 types of group structure. The first one is called the horizontal structure, whereby the parent company do have a direct shareholding in a number of subsidiaries, and then we also have another type of a group structure which is called a vertical group structure. So in case of a vertical group structure, this whereby the parent company will be having a direct shareholding in a subsidiary and also having indirect shareholding in something called a subsidiary. So therefore maybe in this case we can say that there are different types of group structure, including number 1, we have the horizontal structure. Number 2, we have the vertical structure, and also number 3, we can talk of the mixed structure, or basically the mixed group structure. So these basically are the different types of group structure. Maybe you can start with the first one, that is the horizontal structure. So when talk about the horizontal structure, this whereby the parent company do have or is having direct shareholding in a number of subsidiaries. For example, in this case, we can be told that A Limited, which is basically the parent company, has acquired some shareholding in B Limited, C Limited, and also D Limited. So mean that the parent company here do have direct shareholding in a number of subsidiaries. So therefore, you can say that this is where the parent company, remember also the parent company here is called the investor because it has invested in other entities. The parent company or the investor has a direct shareholding, in two or more subsidiaries, subsidiaries. So the parent company here is having direct shareholding in 2 or more subsidiaries. So a good example of a horizontal structure, let's assume that we have A Limited, and which is the parent company, So this company may have direct shareholding in a number of subsidiaries. For example, B Limited or A Limited may be having 80% shareholding in B Limited. A Limited also may be having something like 60% shareholding in C Limited, and also A Limited may be having like a 75% shareholding in another subsidiary, say D Limited. Now, this particular type of group structure, we refer to it as the horizontal group structure, because you can see the parent company, which is A, is having direct shareholding in 3 subsidiaries, B Limited, C Limited, and also D Limited. Now, in this case, when preparing the consolidated financial statement, we prepare them in the normal way, just like a case whereby the parent company is having a single subsidiary. Basically, what that means is that when preparing the group account, we add similar items of asset and liabilities of all the companies here. That is the parent company, B Limited, C Limited, and also what? D Limited. So therefore, you can say, in this case, the group accounts are prepared in the normal way, i.e. by adding similar items of assets, liabilities, revenue, and expenses, of the parent company and its subsidiaries. So therefore, in case of what we refer as the horizontal group structure, the group accounts are prepared in the normal way. Basically by adding similar items of asset, liabilities, revenue, and expenses of all the companies within the group. The group. So let's move and look on the other type of group structure, which is number two, and that is the vertical structure. So in this case, when we talk about a vertical structure, this whereby the parent company is having a direct shareholding in a subsidiary, and then also having indirect shareholding in what we refer as a sub-subsidiary. So therefore, you can say that this is where a parent company is having direct shareholding in a subsidiary company, and also indirect shareholding, shareholding in a subsidiary. So the parent company here will be having a direct shareholding in a subsidiary company, and also indirect shareholding in what we refer as a sub-subsidiary. So what do you mean by that? Let's assume that we have 3 companies, and A Limited here, we are told, for example, acquired 80% of the ordinary shares issued by B Limited, and then in turn, B Limited here has acquired a 60% shareholding in another company here, which is called C Limited. Now, this particular type of group structure, we refer to it as a vertical group structure, because the parent company here, which will be which is A, is having direct shareholding in this subsidiary, and then A Limited, which is still the parent, is having indirect shareholding in C Limited, of which C Limited in this case is referred to as the sub-subsidiary. is referred to as a subsidiary. Now, when preparing the group account, or basically the consolidated financial statement, in case of a vertical group structure, there are some important points which now the candidate must be able to know, and which basically will help them in terms of preparing the group account of such questions having that type of group structure. So these are some of the important points to note. Number one, when dealing with a vertical group structure, these are some of the important points. Number one is that the candidates must compute the parent company indirect shareholding in the subsidiary. That is the first thing to be done. Compute the parent company indirect shareholding in the subsidiary. Indirect shareholding in the subsidiary. In the subsidiary. So how do we compute that particular parent company indirect shareholding in this particular subsidiary? So what we do, we take the parent company shareholding in the subsidiary. So for example, assuming A Limited, which is the parent company, has 80% shareholding in B, which is the subsidiary, and then B, which is a subsidiary or basically do have a shareholding of 60% in C. So to compute the parent company indirect shareholding in C, we take the parent company shareholding in the subsidiary, which is 80%, and then times the subsidiary company shareholding in the subsidiary, which is 60%. So in this case, or here we are going to get a rate which is 48%. So here we say that the parent company indirect shareholding in C, or basically in the subsidiary, is 48%. But in this case, despite or even if you get a rate which is less than 50%, still we say that the parent company is having indirect shareholding, or basically indirect control in C Limited, simply because A Limited controls this one, A Limited controls B, A Limited controls B, and then B Limited in turn controls C. Controls what? C. And because this controls this one, and this one controls this one, then in this case we say that this company here, that is A Limited, do have indirect control over the operating and financial decisions which will be made by C Limited, and also A Limited will be having indirect control as far as the composition of the board of directors of C Limited is concerned. So therefore, what you are saying is that provided this company is controlling this one and this one is controlling that one, even if you get a rate which is less than 50%, then that company is still a subsidiary. What that means is that when preparing the consolidated financial statement, you have to consolidate, you have to combine, you have to add together similar items of assets, liabilities, revenue, and expenses of all the companies. So that is the first thing when dealing with a vertical group structure. Compute the parent company indirect shareholding in the subsidiary. Number two is you need to identify the date, identify the date when the subsidiary became a member of the group. So number two, we can say identify the date when the subsidiary became a member of the group. Became a member of the group. Became a member of the group. And basically that particular date is very, very important, because when, for example, preparing number one, when computing the goodwill of the subsidiary, you compute it on this particular date when the subsidiary became a member of the group. And also when preparing something like the consolidated income statement, you prepare, or basically you take into account the result of the sub-subsidiary from the date it became a member of the group. That is why we are saying it is very, very important for you to be able to identify the date the sub-subsidiary became a member of the group. And actually, the sub-subsidiary is said to have become a member of the group on the later of the two dates between the date when the parent company acquired the subsidiary and the date when the subsidiary acquired the shareholding in what? In the sub-subsidiary. So therefore, you can say that the sub-subsidiary becomes a member of the group, becomes a member of the group on the later of the two dates, on the later of the two dates. So which are those particular two dates? We are talking of the date when the parent company acquired the subsidiary, and the date the subsidiary acquired the sub-subsidiary. So basically we are saying that the sub-subsidiary will become a member of the group on the later of these two dates. The later of the date the parent company acquired the subsidiary. So like maybe let's assume that we are told A Limited acquired shareholding in B maybe on 1st of January, like 2021, and then B Limited acquired 60% shareholding in C on 1st of January 2022. Therefore, in this case, we are saying the sub-subsidiary will be deemed to have become a member of the group on the later of the two dates. The date which is later. Basically, the date which is later is basically this one. That is 1st January 2022. So therefore, when computing now the goodwill on acquisition of this particular sub-subsidiary, we compute it on that date. That is 1st January 2022. And also when preparing now the group account or the consolidated financial statement, we must also know that we are going to consolidate the result of that particular subsidiary from that particular date. That is the other important point when dealing with a vertical group structure. Other than computing the parent company direct shareholding in C, you also need to identify the date when the sub-subsidiary became a member of the group, of which you have said it must be the later of the two dates. So the other important point number three, is regarding the cost of investment. Cost of investment in the sub-subsidiary. So when talk about the cost of investment in the sub-subsidiary, we are talking of the purchase consideration which was paid by the subsidiary in acquiring the shares of the sub-subsidiary. The sub-subsidiary. Now, this particular cost of investment in the sub-subsidiary usually is split into two parts. So first of all, we compute the amount due to the parent company, or we compute amount due to a parent company. So when talk about the amount due to the parent company, this is actually the amount which is regarded or which is assumed to be paid by the parent company in acquiring the shares of the sub-subsidiary. So how do we compute that amount due to the parent company? So this one is computed by taking the cost of investment in the subsidiary. We compute this by taking a cost of investment in subsidiary times the parent company shareholding in subsidiary. A parent company shareholding in the subsidiary. Parent company shareholding in the subsidiary. Like in this case, assuming we are told that B Limited, in acquiring the shares of C, may be paid 100 million. Paid 100 million. So how do we compute the amount deemed to be paid by the parent company? So we take the cost of investment in the subsidiary, which we are given there as 100 million, and then multiply that with the parent company shareholding in the subsidiary. So the parent company shareholding in the subsidiary is 80%. So in this case, we get what? We get 8 million. So this is the amount deemed to be paid by the parent company in acquiring shares of the subsidiary. And this particular amount which we get here is the one which is then used in the computation of goodwill. So we can say that this is the amount used by parent company in computing the goodwill of the subsidiary So therefore, that this particular amount here, we use it in computing the goodwill of what? Of the subsidiary. Then from there, we also compute the amount of purchase consideration due to the NCI. It is important to note that in this particular subsidiary company here, the parent company is having 80% shareholding, meaning that the remaining 20% of the shares in this particular subsidiary here are held by the minority shareholders. And basically we said the interest of the minority shareholders in a subsidiary, we refer to it as NCI, non-controlling interest. So therefore, what we do next here is to compute amount due to NCI. Compute the amount due to NCI. So how do we compute this particular amount due to the NCI? So we take the cost of investment, investment in subsidiary, and then we multiply that with the NCI shareholding in a subsidiary. NCI shareholding in the subsidiary. For example, in this case, assuming the cost of investment in the subsidiary is 100 million, so we have to multiply that with the NCI shareholding in the subsidiary. NCI shareholding in the subsidiary is 20%. 20%. So this will give us what? This will give us 20 million. So this particular amount of 20 million is then deducted from the NCI at the end of the year. So we can say this is deducted from NCI at the year end. NCI at the year end. So when computing the NCI at the end of the year, so that particular amount due to the NCI, we are saying, will be deducted from what? From the NCI. So therefore, it is very, very important to note that when dealing with a subsidiary, for example, in our case here, C Limited, number one, in computing the goodwill on acquisition of a subsidiary, we have to compute it on the date the subsidiary became a member of the group. Actually, we have mentioned something here to do with identifying the date when the subsidiary became a member of the group, of which that should be the data of the two dates. That is the first important point as far as the computation of goodwill of the subsidiary is concerned. Number two is that when taking into account the cost of investment in the subsidiary, we don't take the full amount. If, for example, B Limited had paid 100 million in acquiring the shares of C, that is not the amount we use in computation of goodwill, but we use the amount which is regarded to be paid by the parent, because it is the parent company here which compute the goodwill on acquisition of C. The goodwill on acquisition of C is not computed by B, because it is important for you to note that in a vertical group structure, here we can say generally we have two parent companies. So A is a parent company to B, and then B is a parent company to C. But this company here, that is B Limited, in accordance with IFRS 10, it is exempted from preparing the group account because it is a partially owned subsidiary by A Limited. The company which is
Hello, candidates, and welcome to the Advanced Auditing and Assurance Learning session. The subtopic is Audit of Banks. To remind you, the general objective of the Advanced Auditing and Assurance paper is to enable the candidates to gain knowledge and skills to undertake advanced audit and assurance engagements in compliance with regulatory frameworks and international auditing standards. The subtopic Audit of Banks candidates. By the end of this study on the audit of banks, it is expected that you will gain knowledge and skills to enable you to undertake audit and assurance engagements which are in line or in compliance with the regulatory frameworks and international auditing standards. In the study of audit of banks candidates, we will study audit objectives, the terms of engagement, planning the audit of a bank, the internal controls. On internal controls, we will consider the policy paper that was issued by the Basel Committee on Banking Supervision, dubbed Framework for Internal Control Systems in Banking Organizations. Then we will also study the substantive procedures that are required in the audit of banks, then the audit report on the financial statements of banks. So, candidates, welcome to the session, Audit of Banks. I just stated that in auditing of financial statements, the auditor should pay attention to the regulatory frameworks and international auditing standards. That is regulatory frameworks and international standards on auditing. The Banking Act of 2015, Section 24, requires that every institution to appoint annually an auditor who is qualified and approved by the central bank, whose duty is to audit and make a report upon the annual balance sheet and the profit and loss account, which are to be submitted to the central bank. That is Section 24 of the Banking Act. Section 24. Section 24 of the Banking Act of 2015. Now, Section 25 of the same Act talks about change of auditors, and such changes of auditors of a bank should be notified to the central bank. And Section 26 of the Banking Act is about auditors' duty of confidence. Auditors' duty of confidence. Now, the audit of banks is governed by the International Auditing Practice Statement number 1006. These statements is about the audit audit of financial statements of banks. Financial statements of banks. And the purpose of this statement is to provide practical assistance to auditors and to promote good practice in applying international standards on auditing of the financial statements of banks. Learners, it should also be noted that this statement is not intended to be an exhaustive listing of the procedures and practices to be used in such an audit. And therefore, in conducting an audit in accordance with ESAS, the auditors comply with all the requirements of all the international standards on auditing. But we all know that banks commonly undertake a wide range of activities. However, most banks continue to have in common some basic activities of deposit taking, borrowing, lending, settlement, trading, and treasury operations, and so on. So this statement, the primary purpose for this statement is the provision of guidance on the audit implications of such activities. I've mentioned the activities like borrowing, lending, settlement, trading, treasury operations, and so on. So before we get into the audit of banks, I think it's important for us to highlight some of the basic characteristics that generally distinguish banks from other commercial enterprises. Basic characteristics of banks. Basic characteristics of banks. Number one is that banks have custody of large amounts of monetary items. Custody of large amounts of monetary items. Large amounts of monetary items, including cash, including negotiable instruments, whose physical security has to be safeguarded during transfer and while being stored. They also have custody and control of negotiable instruments and other assets that are readily transferable in electronic form. So candidates, the liquidity characteristics of these items make banks vulnerable to misappropriation and fraud. Banks therefore need to establish formal operational or operating procedures that are well defined that have well-defined limits for individual discretion and rigorous systems of internal controls. So that is one basic characteristic of banking institutions that distinguish banks from other commercial enterprises, large amounts of monetary items. Then number 2 is that banks often engage in transactions that are initiated in one jurisdiction and managed yet in another jurisdiction. Transaction is initiated, for example, in one continent, and then the management of that transaction is done in another continent. Number 3, banks operate with a very high leverage. Very high leverage. That means that the ratio of capital to total assets is low. And this increases banks' vulnerability to adverse economic trends and increases the risk of failure. High what? Leverage. They operate with very high leverage, meaning that the ratio of capital to total assets is low. Then another characteristic is that banks have assets that rapidly change. Assets that rapidly change in value and whose value is often difficult to determine. Consequentially, a relatively small decrease in asset values may have a significant effect on their capital and potentially on their regulatory solvency. Another property is that banks generally derive a significant amount of their funding from short-term deposits, and these deposits may be insured or uninsured. Therefore, a loss of confidence by depositors in a bank's solvency may quickly result in liquidity crisis. May do what? May result in liquidity crisis. Liquidity crisis. Another feature is that banks have fiduciary duties, and these fiduciary duties are in respect of the assets they hold that belong to other persons. And these fiduciary duties may give rise to liabilities for breach of trust. So they therefore need to establish operating procedures, internal controls designed to ensure that they deal with such assets only in accordance with the terms on which the assets were transferred to the bank. Next point is that banks engage in a large volume and variety of transactions whose value may be significant. And this ordinarily requires complex accounting and internal control systems and widespread use of information technology. Another characteristic is that banks ordinarily operate through networks of branches and departments that are geographically located or geographically dispersed. This necessarily involves a greater decentralization of authority and dispersal of accounting and control functions, with consequential difficulties in maintaining uniform operating practices and accounting systems, particularly when the branch network transcends national boundaries. Next characteristic is in relation to transactions which often may be directly initiated and completed by the customer without any intervention of the bank's employees. For example, transactions that are carried out over the internet or through the automatic teller machines and so on. So these are some of the basic characteristics of banks that distinguish banks from other commercial enterprises. Now, learners, that will mark the end of our today's learning session, where we've introduced the subtopic audit of banks. And in this session, we've learned that an auditor should have knowledge and skills to undertake the audit and assurance engagements that are in line with regulatory frameworks and international standards on auditing. In this lesson, we also learned that the audit of banks is regulated or guided, or we can say auditors seek guidance, get guidance from the International Auditing Practice Statement number 1006. This statement is about the audit of financial statements of banks. In the lesson, we've gone ahead to identify some of the basic characteristics of banks. These characteristics are common to banks, and the characteristics distinguish the banks from other commercial enterprises. In our next session, we will study audit objectives of banks and terms of engagement. Thank you, and God bless you. Hi, candidates, and welcome to our today's learning session. The subject is advanced auditing and assurance. We proceed from where we stopped in our last session. Today we are going to study the International Standards on Auditing number 200 and number 210 as they relate to audit of banks. ISA 200, ISA 200, and ISA 210. The ISA 200 is about objective and general principles governing an audit of financial statements, whereas 210 is about the terms of audit engagements. So let's first look at the ISA 200, objective and general principles governing an audit of financial statements. This standard states that the objective of an audit of financial statements is to enable the auditor to express an opinion whether the financial statements are prepared in all material respects in accordance with an applicable financial reporting framework. The objective of the audit of a bank's financial statements, therefore, should be conducted in accordance with the international standards on auditing.
and it is to enable the auditor to express an opinion on the bank's financial statements, which are prepared in accordance with the applicable financial reporting framework. Therefore, candidates, the auditor's report indicates the financial reporting framework that has been used to prepare the bank's financial statements, including identifying the country of origin of the financial reporting framework when the framework is used, or when the framework is not used, or when the framework used is not, when the framework used is not international accounting standards. So when reporting on financial statements of a bank prepared specifically for use in a country other than that under whose rules it is established, the auditor considers whether the financial statements contain appropriate disclosures about the financial reporting framework used. That is the provisions of the International Standards on Auditing number 200. All right. Objective and general principles governing an audit of financial statements. I've said that the objective of an audit of financial statements, here we are talking of general statements of all the types of businesses, including banks. The objective is for an auditor to enable an auditor to express an opinion whether the financial statements are prepared in all material respects in accordance with an applicable financial reporting framework. How about ISA 210, which is in relation to terms of audit engagement? ISA 210, terms of audit engagement. Terms of audit engagement. Terms of audit engagement. Candidates, the engagement letter documents and confirms the auditor's acceptance of the appointment. All right, that's number one. The point is that the engagement letter does what? Documents and confirms the auditor's acceptance of the appointment. The letter also documents the objective and the scope of the audit, number two. Number three, the letter documents the extent of the auditor's responsibility to the client and the form of any reports. Therefore, candidates, in considering the objective and the scope of the audit and the extent of the responsibilities, the auditor considers his own skills and competence and those of his assistants to conduct the engagement. And in doing so, the auditor considers certain factors, such as, one, the use and source of specialized accounting principles with particular reference to number one, any requirements contained in the law or regulations applicable to banks. Number 2, pronouncements of the banking supervisory and other regulatory authorities. 3, pronouncements of relevant professional accounting bodies. For example, the International Accounting Standards Board. 4, the pronouncements of the Basel Committee on Banking Supervision. And finally, number 5, industry practice. So when issuing an engagement letter, apart from the provisions of ISA 210 on terms of audit engagements, there are other factors that the auditor needs to put into consideration. So I've mentioned one of the factors, and this is the use and the source of specialized accounting principles with the particular reference to the 5 aspects that I've mentioned. Then number 2 is the contents. The auditors should consider the contents and the form of the auditor's report on the financial statements and any special purpose reports required from the auditor in addition to the report on the financial statements. And this includes whether such reports refer to the application of regulatory or other special purpose accounting principles or describe procedures undertaken especially to meet regulatory requirements. Then number 3, the nature and any special communication requirements or protocols that may exist between the auditor and the banking supervisory or other regulatory authorities like the central bank. Then number 4, we have the access that bank supervisors will be granted to the auditor's working papers when such access is required by the law, and the bank's advance consent to the access. So those are some of the factors that the bank auditor should consider when issuing an audit engagement letter. And that effectively brings to conclusion of our today's lesson, where we've considered 2 aspects, that is the ISA 200 and ISA 210, the terms of audit engagements. In our next session, we'll commence our study on the audit plan of a bank, audit planning when carrying out the audit of a bank. Thank you and God bless you.
We proceed to the illustration on computation of VAT, that is August 2024, question 5C. We read the question. Explain the term reverse charge, that is basically already given on notes. Then you go to 2. The following information related to lesser. The following information related to lesser limited, a company engaged in supply of taxable goods for the month of May 2024. The company was registered for VAT on 1st May 2024. So we have inventory in trade as at 1st May 2024, valued at 13,000. So we, on the opening stock, we can claim input VAT. So the second, we are being told that the company purchased goods on credit. The company purchased goods on credit. and cash worth on credit. So credit is 4,750,000, and on cash is a figure of 2,980,000 respectively. So when you talk about purchase and the opening stock, those are basically input VAT. Those are VAT on purchases and expenses. So goods purchased on cash worth 180, goods purchased on cash worth 180, worth 180 did not have supporting fiscal receipt. So when you have these goods purchased on cash, we can do our working. Purchased on cash, goods purchased on goods, goods purchased, we say purchased on cash. So basically these goods purchased on cash did not have supporting documents. So those cash, we had a figure of 2 million. We had a figure of 2,980,000, we less the ones that did not have documentation. That's a figure of 180. A figure of 180. We pick our calculator. We basically have 2,980,980 minus 180,000 minus 180,000. So we have a figure of 2.8. 2.8. This is where we are going to claim input VAT. The ones that do not have the documentation, a figure of 180, we cannot basically claim input VAT on them. So then we proceed to additional information, number 3. The company sold goods worth, the company sold goods worth, the company sold goods worth 8,768,000 during the month. During the month of May, the company basically sold goods worth 8,768,000 during the month. These goods included exempt sales of exempt sales worth 3,670,000 and export to South Africa, which was 1.5. So we can get the standard rate sales. So we have our working two. We are getting the standard rate sales. Standard rate sales. So it tells that the total sales is basically what we have as 8,768,000. 8,768,000. We less the exempt, which is 3,670,000. This is basically exempt, and exempt, that is 3,670,000. Then we less the zero rated. Zero rated in this case is about a figure of 1.5. Zero rated is a figure of 1.5. So we get the standard rate. We get the standard rate. We get the standard rate. So for the standard rate, we pick that, and we will say 8,768,000 minus 3,670,000 minus 1.5. Minus 1.5. So we have the standard rate sales to be 3,598,000. 3,598,000. An explanation on that. So we know that standard rate, those are taxable, and the zero rates are also taxable or vatable. But zero rate, we know we claim VAT at 0%. Exempt rate, exempt sales, we do not charge VAT at all. But we're saying that these figures on sales are basically what we call output VAT, and I've explained that exempt, we don't charge VAT, not chargeable to VAT. Zero rate, import, export is zero rated. Then standard rate, we charge VAT at a standard rate of 16%. So then you're being told that the company received a credit note. A company received a credit note and a debit note worth 600,000 and 540,000 respectively. So if I just indicate here, just to indicate working 3, we say that a credit not received, credit not received Remember this, credit not received affect purchases. Affects purchases. We know that this basically affect the purchases. This basically affect the purchases, and credit note will reduce the purchases. Reduce the purchases. That will definitely reduce the purchases. Then the second we have debit note. Debit note received. Debit note received. That also affect purchases. And we know that debit note is used to correct an undercharge. So this definitely will increase purchases. This will increase the purchases. That is analysis for that. That definitely will increase what you call purchases. So then we are being told that during the month, the company purchased a motor vehicle on hire purchase at shillings 4.5 million to be used in business. The cash price was 3.8. If you have the hire purchase and the cash price, we basically use the cash price to claim input VAT. So the input VAT will be on the 3.8 and not 4.5 So we proceed to the additional information number 6. Additional information number 6. The company imported goods valued. 2.4, that is cost, insurance, and freight. They incurred clearing. They incurred what you call the clearing. They incurred the clearing. The company incurred the clearing and transport of for 50,000 and 150 respectively. Respectively, this import was not included in purchases above. The import duty rate during the year was 25%. The import duty rate was basically 25%. So we go to working for. Working for on import. Remember, when you talk about import, we say that import basically has a cascading effect, meaning that we charge VAT after charging import duty. So import duty is charged. Import duty is charged on what you call the CFI, cost, insurance, and freight. So we have the cost, insurance, and freight to be a figure of 2.4. So 2.4 to get the import duty 25%. So we get 25%, we can get the 25% and add, or we just have plus 125 over 100. Instead of getting 25, then we get 2.4, we get 2.4, 125 over 100, meaning the figure plus the import duty. We can test that with our calculator. So we have that 2.4. The figure is 2.4 times 125 over 100. So the figure is basically 3 million. But you know that imports are exclusive of VAT. Imports are exclusive of VAT. Imports are basically exclusive of VAT. And when you look at the figure for the transport and clearing, those are also input, but we're going to charge them. Those are basically input. VAT. So we proceed to 7. Additional information number 7. So the company incurred the following expenses. Expenses are basically input VAT. So the first expense is what we call legal expense. Legal expense is vatable. We charge input VAT. Salaries and wages are exempted from VAT. Office rent, that is chargeable to VAT. That's we claim an input VAT. Then we have water from the county. Water from the county, that is basically exempted from VAT. Water from the county, that should not be charged to VAT. Then we have electricity that is chargeable to VAT. Then we say 8, the company could not identify. We're being told that the company could not identify a goods sold as exempt when they purchase, and therefore restricted deductible input VAT. So we have restriction in that. Then the last additional information, that is additional information number 9, transactions are inclusive of VAT at a standard rate of 16%. So when you're told transactions inclusive of VAT, transactions inclusive of VAT. So means that VAT is already charged. So we say into bracket use 16 over 116. Use 16 over 116. If the transactions are inclusive of VAT, it means that VAT is already charged on that. So we basically use 16 over 116. So we proceed to what is required. Determine the value added tax payable or refundable to lesser limited for the month of May. So we can say VAT payable or refundable to lesser. We say to lesser limited, payable or refundable to lesser limited. Particularly on questions that we have restriction, one of the best approach to take, especially on questions that we have on restriction, is basically to do the output separate and do the input separate. Sometimes students mix them, but the best approach to take when it comes to questions that basically deals with restriction is to have the output separate, and also do the input separate. So we go to the output, we get the output VAT. So on the output VAT, we have standard rate. We have amount here, then we have the VAT rate, then we have the VAT. So we have item on that. So the first item is standard rate cells. And the standard rate cells, we had done the figure as we rotate the camera. As we rotate the figure for the standard rate, we less the exempt and zero rated. We had the figure of 3,598,000 times 16. Transactions are inclusive of VAT. So we have our calculator, and 598, then times 16 over 116. So the figure that we have for that should be a figure of 496,276. That is for the standard rate cells, a figure of 496,276. The next items on cells, we have what we call zero rated, zero export. And when you read the additional information number 3, export to South Africa. So export was a figure of 1.5. Remember zero. There's zero rated. So that is zero. That is zero on that. Then you have exempt. Exempt, we have at a figure of 3,670,000. We don't charge VAT at all. So then down here we have what we call total output VAT. Total output VAT. That should be a figure of 496,276. 496,276. We proceed to the input VAT. We get the input VAT. We proceed to what we call input VAT. We have what we call input VAT. So on the input VAT, we have item on this. Item, amount. We have the VAT rate. Then finally we have the VAT, and we move sequentially. So the first item that we had was credit sales, credit purchases. We charge VAT on the credit purchases. So credit purchases a figure of 4,750,000. The VAT rate, because it's inclusive, 16 over 116. So we pick our calculator, and we have that. We pick our calculator. So we basically, as we pick our calculator, we know that 4,750,000 times 16 over 116. So we have, on that we have a figure of 655 to all number that should be 172. 655, 172. We proceed to what we call the cash. We call it cash purchases. So on the cash purchases, there is a working basically on the cash purchases. There's a working on the cash purchases. We say that some of the purchases did not have physical document. So the working basically will less 180. So for the cash purchases is a figure of 2.8. So we have the 2.8 at this point. Then we multiply by the rate which is 16 over 116. We get the figure on that. So we have 2.8 times 16 over 116. So that should be about a figure of 386, 207. 386,207. To round it to all number. We proceed to the next. We had what we call credit note received. That's the reduction of purchase. So we have credit note received, credit note received. We had a credit note received. So on the credit note received, the company received credit note and debit note. So credit note received was a figure of 600,000. That is additional information number 4. So credit note basically reduces the purchases. So times 16 over 116. So what do we get when you have that? So 600,000 times 16 over 116. So that should be about a figure of 82,759. Then debit note received. That is used basically to correct an undercharge that should increase the purchases. So we have a figure of 540, 16 over 116. A figure of 540, 16 over 116. So 540 times 16 over 116. So the figure that you have, that should be about 74, 483. 74, 483. 74, 483 as the figure. 74, 483 as the figure. Then there was an entry that was not basically added, opening inventory. So we had the first entry on opening inventory. On the first month, you can claim that opening inventory. Opening inventory. So the opening inventory was, we had a figure of 813 times 16 over 116, the opening inventory. 813 times 16 over 116. So that should be a figure of 112, 130, 112, 138 as the figure. 112, 138 as the figure. So proceed to the next. We had During the month, the company purchased motor vehicle on hire purchase. We use the cash price. Motor vehicle, we have the motor vehicle. So motor vehicle is basically a figure of, we use the cash, which is 3.8, 16 over 116. 16 over 116. So we have the 3.8 times 116 over 116. So that should be about a figure of 524. That should be a figure of about 524. 524, 138. 524, 138. 524, 138. The next item was basically on import. We know that import, we have done the working. As we rotate the camera, import, we basically are done the working. Import plus import duty, we have a figure of 3 million. And you know that import are normally exclusive. Even if the question is inclusive, they're normally exclusive. So we have import. Import, a figure of 3 million. 3 million. Then that 3 million we have times 16 over 116. Times 16 over 116. So 3 million, 16 over 100, sorry, because that is exclusive. So that's 3 million times 16 over 100. So that should be definitely about 480. 480. That should be 480. Then you have those transport. We have the transport. Remember, those are the point of entry, so that those are basically inclusive. Transport cost, clearing. We have clearing cost. So clearing cost and transport clearing is for 50. So for 50,000 times 16 over 116, 16 over 116. So we're having 450 times 16 over 116 for the clearing. So the figure should be 62,069. 62,069. Then we have the transport. Transport is a figure of 150. 16 over 116 for the transport. So transport should be 150. 150 times 16 over 116. So we have a figure of 20,690. That should be a figure of 26,690 for that. So then we proceed to the additional information. We have legal. Legal, we said legal are not exempted. Legal, we have the legal expenses. So legal expenses, which we claim VAT. So that should be 350. 16 over 116. 16 over 116. 16 over 116. So 350 times 16 over 116. So the figure for the legal, that should be 48. We have 48 to 76. 48 to 76. 48 to 76. Then you have the next, salaries are exempted. You know, salaries and wages, salary and wages. We know that salaries and wages, these are basically exempted. So the figure was 133400. We know that these are exempted. Then we have office rent. Office rent. We claim input VAT. That should be 580. 580. 16 over 116 for that. 16 over 116. So we have a figure of 580 times 16 over 116. That should be about 80,000 for that. Then the next we have what we call, we don't even to put it there, that is water from the county that is basically exempted. Then you have electricity. We can have the electricity. Electricity is a figure of 54, inclusive of VAT 16 over 116. 16 over 116. So electricity is 54 times 16 over 116. So the figure should be, that should be 7448. So that was 655, 172 plus 386, 207, 386, 207, 207, then minus 82, 759, so start again, 655, 172 plus 386, 207, then minus 82, 759, then plus 74, 483. 74, 483 plus 112, 138, 112, 138, then plus 524, 138, then plus 480,000, for 80,000 plus 62, 069, 069 plus 20, 690 plus 80 plus 80,000, then plus 7448. When you add that, that provides total. We have a total input VAT, total input VAT of 2,367,000, 2,367,862. 2,367,862. 2,367,862. Look back at our statement. That is statement 8. The company could not identify goods sold as exempt when they were purchased and therefore restricted deductible input VAT. So there is restriction. So we need to restrict input VAT. So how do you restrict input VAT? We say that taxable supplies over what we call total supplies times total input VAT. So we say that taxable supplies is equals to standard rate plus zero rate. Standard rate plus zero rate. Then you say that total supplies is standard rate plus 0 rate plus exempt. And when we are restricting, when restricting NB, when restricting standard rate cells should be, say should be exclusive of VAT. When restricting, the standard rate cells should be exclusive of VAT. So we have a figure of the standard rate cells, the figure for the standard rate cells. This is a figure of 3,598,000. Remember, this figure was inclusive of VAT. So that implies that the figure is 116%. We make that figure exclusive. Exclusive is 100%. So 100%, basically we say 100% over 116 times 3,598,000. So exclusive standard rate exclusive of VAT. So we have that figure. So we have our calculator. That should be 100 divided by 116. Then we multiply by 3,598,000. So we have a figure of 3 million. We round it off. 724 as what we call the standard rate exclusive of VAT. So we can get taxable supplies. So we can get taxable supply, which is 0 rated plus 0 rated taxable supply, 0 rated plus standard rate. Taxable supply should be 3,101,724 plus 1.5, which is 0 rated plus 1.5. So that gives us total taxable supplies to be, so plus 1.5. Plus 1.5, we have a figure of 4,601,724. Then you can have total supplies. Total supplies, we say that should be a standard rate, which is 3,101,724 plus 0 rate, which is 1.5, plus 0 rate, which is 1.5, plus the exempt. Exempt is a figure, if you look at that paper, on additional information number 3 is a figure of 3,670. 3,670. So we get the figure. Then plus 3,670. So that should be 8 million. Total supply should be 8 million to 8 million. 271, 8,271, 8,271, 724. So we restrict. At that point we restrict. At that point now we can restrict. At that point. We have our formula for restriction. Taxable supplies. Taxable supplies is 4,601,724 over what you have as 8,271,724. Then times total input VAT, which is 2,367,820. 862. So that is deductible or restricted deductible input VAT. The input VAT, deductible input VAT. So we have a figure of 4,601,724 divided by 8,271,724. So the figure is 0.55 times 2 million, 367, 862. 862, having a figure of 1,317,289. 1,317,289. So then we can get to VAT payable or refundable. VAT payable, stroke refundable, That should be output VAT minus deductible, what you call the deductible input VAT minus the deductible input VAT. So we have the output VAT still here. That should be 496,276 minus 1,317,289. So we have, this is basically a refund. So when you say VAT payable, then you put it into bracket. But when you say refund, this is basically VAT refund. So that should be a figure of 821,013. When you say VAT payable, that should be into negative. That should be that. So that is how we particularly. But maybe just an emphasis on how an approach is very important. When you look at these values, remember what is of key is the entries. These are entries that are being marked. For exempt may not be marked. When you have this these figures are the ones that basically constitute the solution. The most important part is those figures, understanding those figures. That is what basically would provide us with the solution. So as a learner, very important to understand is that to follow the procedure. You may not understand a few points here and there, but as long as you are doing your entries perfectly well, you can have about, let's say, 80% to 100% of the entries, you are in a good direction. So the key thing is to understand those entries and make sure that you make as many entries as possible. And when we do that, we will perfectly be handling those questions pertaining to the administration of VAT. That marks the end of our session. We meet in our next session.
Welcome to Manifested Publishers.
Hello learner, welcome to Manifested eLearning platform. My name is F.A. Emlyn Ngwiri and we are discussing about portfolio management. The focus of today's class is on introduction to portfolio risk and return. So what we're going to do, we're going to narrow down that discussion to assess the determinants of required rates of return. Now the determinants of required rates of return can be broken down into three. The first determinant of rate of return is the time value of money. The second determinant of the rate of return is expected level of inflation. The third and final determinant of required rate of return is the risk itself. So we are going to break down or try to understand how those factors influence the required rate of return and also investment decisions for investors. So we move over on this other side and start off our class. We mentioned that investors' required rate of return, investors' required rate of return, investors' required rate of return is one of the factors to consider, is one of the factors to consider when selecting securities for an investment portfolio. Securities for an investment portfolio. Continue and say, it is the minimum required rate of return that an investor would actually require so that they can be compensated for deferring the usage of funds today. So we say that it is the minimum. It is the minimum rate of return. Rate of return. It is the minimum rate of return an investor should accept. An investor should accept. Minimum rate of return that an investor should accept from an investment in order. From an investment in order to compensate them for deferring consumption. From deferring consumption. So let's just recap what we've just written. Investors' required rate of return is one of the factors to consider when selecting securities for an investment portfolio. It is the minimum rate of return an investor should accept from an investment in order to compensate them from deferring consumption. So now since we've already now explained or introduced what the investor's required rate of return is all about, we now start by assessing the components. The first component that I had mentioned to you, number one, is time value of money. Time value of money. That's the first determinant that an investor should consider before investing or making an investment decision. So we say that the value is the value of the sum of money at a future date that has been invested at a certain rate, a certain rate of compound interest. Certain rate of compound interest over a certain period of time. We'll stop. Let's stop there. We are saying that TVM, time value of money, is the value of the sum of money at a future date that has been invested at a certain rate of compound interest over a certain period of time. A shilling today is not what it was a shilling, say, 10 years ago. So that is that concept of time value of money. Very important determinant for required rates of return. Investors therefore prefer to receive money more sooner than later. Why? Because investors can reinvest those funds or those proceeds they've actually received at a different at a different rate of return. So we can say that investors, we move on this to the side, prefer to receive money sooner rather than later. The reason being is that receiving money sooner can allow them to reinvest at prevailing rates of return so that they can be able to earn inflows as opposed to waiting to earn it much later on. The second determinant of required rate of return, very important, is number two, expected inflation. Expected inflation. This is the rise and fall of the level of purchasing power, or the purchasing power, whether it actually increases or decreases. When inflation levels actually go down, or when the inflation is, say, manageable or slightly low, it means that what you can buy with 100 shillings or 1,000 shillings is going to be much more as compared to when the inflation levels are actually high. This is an important factor to consider. How much money you'll actually receive. Will it have a higher purchasing power or will it have a lower purchasing power? So we say that the rise and fall of inflation, the rise and fall of inflation must be included in any calculation, in order to reflect the value of the investment, the value of an investment, value of an investment at a later date, Rise in prices, a rise in prices of general price of commodities leads to lower spending power, leads to lower spending power, and vice versa. So we note that the rise and fall of inflation must be included in any calculation in order to reflect the value of an investment at a later date. Nominal value, the real value. The real value factors in that element of inflation. A rise in prices of commodities leads to lower spending power. That is the second most important determinant of the required rate of return. The third one, ladies and gentlemen, is risk. Risk factors, we can say, risk factors may vary. Risk factors may vary from instrument to instrument, Risk of investing investor, so risk of investing in a venture capital firm might be high, but the expected returns from that investment need to compensate the investor for deferring the usage of funds today to place to make an investment or that investment in that risky venture. So we can say that the risk of investing in a venture capital firm, please note that a venture capital firm is considered to be maybe a firm that has just begun and that is actually considered to be, say, a startup, not a startup from the grass. So we are saying that it's like, so there at this level, it's moved from that level over there to this level over here, and in terms of the assets or in terms of say the size of the company has moved from that smaller level to this. So this is what we're considering a venture capital firm over here, or we can be able to say a venture capital firm is generally like considered to be a startup there. So the risk of investing in a venture capital firm is high, but returns should compensate. But returns should compensate. Returns should compensate for the higher risk taken, compensate for the risk taken. Risk taken right there. So we are saying that risk factors may vary from instrument to instrument, or from investment to investment, or from asset class to asset class. The risk of investing in a venture capital firm is high, but the returns generated from that investment should compensate for the risk taken, right there. And this brings us to the end of this subsection that we are talking about determinants of required rates of return. Three major ones, and the first one is the time value of money. The second one we've already discussed over here is the expected level of inflation, and the third one is risk. As usual, I will leave you with an assignment. So come over on this other side. Explain giving or citing examples, the determinants of required rates of return. The determinants of required rates of return. Required rates of return. That is the assignment that I have for you today. We hope you've enjoyed this class. Thank you and be blessed.
Welcome to Manifested Publishers.
We pick it up on illustration, that is the taxation of trustee. Our first question comes from April 2023. April 2023. Question 5C. Question 5C. April 2023, question 5C. We'll read the question. Malezi Trust was formed in the year 2021 for the benefit of Alex Malezi's two children, Mona and Nora. The following information was provided to you by the trustee in respect of the trust income and expense for the year ended 31st December 2022. Additional information 1. The trustee reported trading profit of 160,000 for the year. This was after deducting the following expense: printing and stationery, 1 million shillings, legal fee out of which 1,200 was in respect to defending, out of 1,200 was in respect of defending defending one of the trustee involved in illegal business deal. Then we have tax consultancy, a figure of 2.4. We have the next, that is purchase and installation of a software, a figure of 2 million. We have trustee salary as per the trust agreement, that was 10 million. Then you have loan repayment, into bracket, interest included, a figure of 1.1. The total was 8 million. Then you have lease charges were shillings 3 million, out of which 600,000 was in respect to drafting a 10-year lease agreement. Then you have what you call preliminary expenses in respect of the trust formation was 3.4. Then we move to the additional information number 2. The trading profit was before taking into account the following capital expenditure. A warehouse, that is from 1st April 2022, a figure of 3.5 million. Then we have delivery van from 5th May 2022. We have a figure of 1,750,000. We have saloon vehicle from 1st January 2022. The figure is 3.8 million. Then we have the sports pavilion from 1st September 2022. The figure is 1.2 million. So we're being told that trustee received a gross rental income from the commercial properties of 120 million. And the gross interest income from fixed deposit of 20 million. Then you're being told that fee paid to investment manager in charge of the rental property was a fixed deposit amount of 12 million. Additional information number 4. We're being told that each beneficiary is entitled to a quarter share of the net distributable income. That each beneficiary, we know that there are 2 sons, that is Mona and Nora, is entitled to a quarter share of the net distributable income. Then you're being told that the fixed annuity of each beneficiary was shillings 10 million. The figure is gross. Then you say that trustees made 6 million to Nora and 3 to Mona and 3 million to Nora as discretionary payment as per the agreement. Then required. One is that compute the income tax payable on the trust income for the year ended 31st December 2023. Then compute the amount due to each beneficiary for the year ended 31st December 2022. We begin the analysis. Malaysia Trust was formed in the year 2021 for the benefit of Alex Malaysia's 2 sons, that is Mona and Nora. The following information was provided to you by the trustee in respect of the trust income and expenses for the year ended 31st December 2022. So the first additional information, we're being told that the trustee reported a profit of 160 million for the year. This was after deducting the following expenses. At that very point, we noticed that for this particular question, the method that we need to get the taxable income is basically what we call the net profit method. And the reason that underlie that is because we have been provided with the accounting profit. So the first expense that was subtracted, we are being told that printing and stationery, a figure of 1 million, that should be allowable expenses, that should not be adjusted. Then I have our number 2, additional information 1.2, legal fee of 6 million, out of which 1.2 was in respect to defending one of the trustee involved in a legal business. So there's a 1.2 that we treat as an allowable. If we have a 1.2 that we use to defend a trustee that was engaged in illegal business, then that should be what we call a non-allowable expense. And note that we say that for this particular question, we are using the net profit method. It means that we need to add back a figure of 1.2, which is a non-allowable expense. The implication of subtracting a non-allowable expense is that you understated the net profit that was provided as 160. So we need to add back that figure of 1.2 to get the right position of profit. Then we have what we call tax consultancy fee was 2.4. We say tax expenses like the tax consultancy, those should be non-allowable expenses. By subtracting that 2.4, you underestimated the profit. So the correction would basically be to add it back. Then the next we have purchase and installation of accounting software. We know that accounting software that we've been told that is a capital expenditure. So we need to add back that figure of 2 million. Then you're being told that trustee salary as per the trust agreement, that's 10 million that should be allowable. Then we have loan repayment. We are told that out of that there's an interest of 1.1. So the loan repayment total was 8 million. So interest on loan is allowable expenses, but loan repayment is a non-allowable expense. So we can do our first amount. We get our first working. We say that loan repayment. We need to get the figure of the loan repayment. Loan repayment, less interest on loan, less interest on loans, less interest on loans. So we say that loan repayment is a non-allowable expense, but the interest that accrue from a loan is allowable. So if we had a figure of 8 million, we need to less minus 1.1. So this figure of 6.9, which is loan repayment, the figure of 6.9, which is loan repayment, that should be non-allowable. So non-allowable, we need to add it back to adjust it to get the taxable profit. Then the next, we're being told that a lease charge was 3 million, out of which 600,000 was in respect to drafting a 10-year lease agreement. So when you talk about a 10-year lease agreement, when you're drafting, renewing or drafting a lease that is less than 99, then that should be allowable. So the figure is allowable expense, so we do not need to adjust it. The next is what we call preliminary expenses. In respect to the trust formation was 3.4. Expenses that are incurred before the inceptions of the trust are basically an allowable expense. So the figure of 3.4, that is a non-allowable expense. The figure of 3.4 is a non-allowable expense. Then we have additional information number 2. The trading period was before taking into the consideration of the capital expenditure. One thing that we need to understand, that when you talk about the capital expenditure, when we talk about capital expenditure, we need to claim what we call investment allowance. In taxation, we do not have an expense called depreciation, but in place of depreciation, we claim what we call investment allowance. So being told that we have assets, we have a warehouse, we need to understand that warehouse qualify for an investment allowance called IBD, industrial building deduction, that we claim at the rate of 10%, that we claim at the rate of 10%, at the rate of 10%. But mark this, he said from 1st April 2022. I know this is a lot of time based on the present rate. We need to not to apportion. Initially, we used to apportion wear and tear and the IBD, but don't apportion. Claim the whole amount. For that warehouse, we have a figure of 3.5. So we claim 10% of the 3.5. I know if you look at some of the areas previously based on previous question, and sometimes you find these ones who are being apportioned, but based on the present rate, you need to claim the whole amount. Very important for learners to understand. Then we have delivery van, delivery truck. Remember that is wear and tear because that's motor vehicle at the rate of 25%. We need to claim it at the rate of 25%. At the rate of 25%. And we also claim the whole amount. We don't apportion. Previously, it was being apportioned. Then we have saloon car. Very important, you need to understand for saloon car and SUVs. We say that for saloon cars and SUV, if the value is more than 3 million, we restrict to 3 million. So we're going to claim 3 million out of that. We are going to claim 3 million out of that. That 25% of the 3 million. Then lastly, we have what we call the sports pavilion. Sports pavilion in this case, that is also IBD at the rate of 10% on the straight line. So then additional information number 3. The trustee received a gross rental income from commercial property of 120 million. That is additional taxable income, and a gross and what you call gross interest income from fixed deposit. that is an interest income that is subjected. We call it the non-qualifying interest, still subjected to further taxation. Fee paid to investment managers in charge of the rental property. We need to understand that we need to get the net, because fee paid to investment manager, that is allowable expense. We need to less it from what we call the gross rental income to get the net rental income. Then lastly, on additional information number 4, we are being told that each beneficiary